a.m. on Thursday, December 31st, 2020. This is Yahoo Finance Live. I'm Julie Hyman along with Miles Udland and Brian Sazi on this final trading day, this final calendar day of 2020. Let's take a look at what futures are doing here. What's our setup for this last day? We've got a mixed picture, but really very little change. It's not unusual, of course, to have very low volume of the final trading week and the final trading day of the year. That said, we made it. After this year that we have seen a stark divide between the coronavirus pandemic on the one hand and the financial markets outperformance on the other, when we track the K-shaped economic recovery, we're going to wrap up the final stats for 2020 in the markets. It was also, of course, unexpectedly as everything else, the year of the SPAC, the year of the IPO, and the year of Bitcoin. Overnight, the cryptocurrency once again touched a record high. We will discuss. And with semiconductors the size of pizza boxes, one rising competitor to NVIDIA is working to power the next generation of data centers with AI-powered chips. We're going to speak to the CEO of Graphcore. First, though, we got to get to some economic data out this morning. The last economic report of the year. Our Emily McCormick is here with the headlines on jobless claims. Emily.
Well, Julie, a surprise improvement in jobless claims to close out 2020. We saw those initial unemployment claims break below the 800,000 level for the first time since November. And specifically, those came in at 787,000 for the week ended December 26. That was better than the 835,000 that had been expected and a revised 806,000 during the previous week. Now, at the same time, at 787,000, that sum is still well above the pre-pandemic weekly average of about 200,000 new claims, but again, still at the lowest level in a month. We should also note that the 4-week moving average for new claims was upwardly revised by more than 17,000 to nearly 837,000 because of the slight upward revision that we saw to last week's data, as well as the elevated claims that we saw for much of December. Now, turning to continuing claims, that measures the total number of individuals still receiving unemployment benefits through state programs. Those also unexpectedly fell to 5.2 million, better than the almost 5.4 million anticipated, as well as the 5.3 million seen during the previous week. Now, encouragingly, all of this data is actually coming in before we get any impact from that newly authorized $900 billion stimulus package from Congress. But going forward, the labor market may actually see some additional improvement as we have those additional unemployment benefits and, more importantly, the loans through the Paycheck Protection Program, helping small businesses especially be able to keep their workforces on their payrolls in light of the ongoing pandemic. And then finally, a couple of other statistics I want to highlight here from this data. We still saw that as of last week, more than 13 million Americans were claiming benefits through the Pandemic Unemployment Assistance and Pandemic Emergency Unemployment Compensation Program, the latter of which is, of course, that federal program that provides an additional 13 weeks of benefits for those who have exhausted their state unemployment benefits. So those had been renewed again in that Congress's stimulus package. So we will still be seeing those benefits come through March for those claimants. But again, overall, a better than expected report to close out the year, Julie.
Well, that's a good piece of news. Thank you so much, Emily. Appreciate it. Well, Emily was talking about the effect of the aid package that just passed Congress. And of course, there are still some negotiations ongoing. It doesn't seem like they're going to end up much of anywhere because in part of Mitch McConnell. Our Jessica Smith has been tracking all the action there. Jess, what's the latest?
Well, Majority Leader Mitch McConnell has essentially ruled out $2,000 stimulus checks, at least in this Congress. On the Senate floor yesterday, he said he would not split up the issues that President Trump is pushing. So that is the $2,000 checks, the repeal of Section 230, and an election fraud commission. So that's not going to happen in this Congress. So that really dooms the $2,000 checks unless something changes. We saw Democrats try on the Senate floor multiple times yesterday to push a vote on the $2,000 checks. And each time Majority Leader McConnell or Senate Republicans shut down that debate. They said no, they would not vote on this. They say that they want relief to be more targeted than these $2,000 checks. It was quite the debate on the Senate floor yesterday. Let's watch.
The Senate's not going to be bullied into rushing out more borrowed money into the hands of Democrat rich friends who don't need the help.
We have a very unlikely ally in President Trump. Nobody here has disagreed with Trump more times than I have. And yet here is what the leader of the Republican Party says. He says $2,000 ASAP.
While this issue appears to be dead for now, unless something drastic changes in the next couple of days, the new Congress is sworn in on Sunday, and President-elect Biden has said that he wants to do another stimulus check, though he hasn't given an amount yet. So this debate will likely pick right back up in the new year. Julie.
Jess, thank you very much, and Happy New Year to you and to Emily as well. Let's get to one of the other big topics, the hot assets that we have been watching this year. Bitcoin, of course, has been near the top of the list. We have seen the cryptocurrency, just about quadruple in 2020. Our Dan Roberts tracks Bitcoin and the other cryptocurrencies, although Bitcoin really is the one that we talk about these days, Dan. And so I wanted to kind of ask you for your thoughts here as we close out the year. And we did not obviously see a late year crash like we did in 2017. Bitcoin has kept right on going.
Yeah, Julia, it's hard not to think that all of the factors are converging right now for Bitcoin's argument, both as an investment and even really as a technology. Now, that's not to say people are spending it. And in fact, for a long time, the argument that kind of mainstream investors would make against it is, well, it's not really a currency. You can't buy anything with it. No one is using it as a currency. Well, that's correct. The appeal right now is as an investment. That said, PayPal planning to add Bitcoin buying and spending with Bitcoin is an interesting one. Of course, as the price goes up, I don't think people are going to want to spend their Bitcoin. But PayPal and Square getting in was really big as well. You had a lot of mainstream real estate, Wall Street investors, I should say, hedge fund names kind of changing their tune this year. All of those sort of narratives converged. I mean, when we did this 3 years ago in 2017, it was a little bit more frenzied, a little bit more, what's the argument here? People kind of confused, people talking about it around the Thanksgiving dinner table. That was the joke. Should I buy some? The price hike was so crazy. And then the big crash in about February 2018. It hasn't happened this time. And I think that arguably it's because of a few things, right? First of all, there was an interesting report. Jared Blicker and I were tweeting about this yesterday, but a report that the supply of Bitcoin in circulation is much smaller these days. That is, a small number of whales and firms hold a large percentage of the Bitcoin, and they aren't selling it. And as a result, that makes the amount that's actually in circulation selling right now more scarce and more appealing. Of course, that could cause more price volatility, but arguably it should make it even more appealing and cause the price to continue to go up. That's not to say there won't be continued price corrections, but it is hard to see a dramatic crash happening again. Of course, no one knows what's going to happen, right? I mean, I always tell people when they're asking me about the Bitcoin price, don't believe anyone who says that they know for sure what is going to happen with the price. But again, a lot of narratives converging and a lot kind of going right. The other thing I should make sure to mention is, the argument that what governments have been doing amid the pandemic strengthens Bitcoin's appeal as an investment, as a store of value, as a hedge. Anytime there's kind of mainstream uncertainty and anytime you have governments printing money and giving stimulus checks, the argument is that makes Bitcoin more appealing since it has scarcity, since it's digital gold. So, I think you might see the price continue to rise. Anyone can throw a dart at the board and try and predict what the price is going to do in 2021. But this late 2020 surge is remarkable. I mean, think about it this way. Bitcoin took 10 years in existence to get to 20,000 on December 15. Now it has gotten to 29,000 in 2 weeks.
Dan, what about the other coins, particularly Ether, Litecoin? They're kind of the two, I guess, most credible altcoins. They're probably not even altcoins at this point. But, really 2017 was defined not only by Bitcoin, but Dogecoin, Dentacoin, Monero, all this other crap, basically, that kind of came up in the space. Where are we at with that? Because, when Jared pulls up that heat map, Bitcoin is just way bigger, and that tracks everything by market cap, right? Bitcoin is just the giant in this space, and it seems like we're not wasting our time here talking about stellar lumens and all that kind of stuff.
That's right. And, I do think, to be fair, Ether is still kind of seen as the number two to Bitcoin, and I mean that in a positive way. And you still have a lot of people who try and say, well, Ethereum, that is the blockchain, the Ethereum blockchain, is the one that has bigger potential for creating decentralized apps and bigger business application long-term than the Bitcoin blockchain. Now, I don't necessarily buy that because in the last few years, the biggest story about Ethereum was the network being clogged down by a very popular game. Remember CryptoKitties? Of course, people argue that Ethereum has strengthened since then. And since we're talking about price here, that's our real interest. Ether has really risen huge in 2020 as well. But that said, I do think that Bitcoin, if you want to throw in Ether, fine. They have sort of distinguished and differentiated themselves more than ever from the other coins, from the other altcoins. Boy, we could do a whole separate segment on XRP or Ripple, which of course we've all read about the problems happening there because Ripple, the company that created XRP, is now involved in a lawsuit with the SEC. So Coinbase and other big exchanges are suspending trading in XRP. XRP, one of the top 5 cryptocurrencies by market cap. So they all kind of have their different, some would say appeals, some would say problems. The companies and systems behind each coin would say use cases. But really, I kind of think there's Bitcoin, and then there's Ether, and then there's everything else. And I think you're right that for the most part, mainstream kind of finance and business media is paying less attention than before to those altcoins, or as some people call them, the word that rhymes with Bitcoin but starts with an SH, right, Miles?
Indeed, we won't say that here today, though, Dan Roberts. And of course, we didn't even talk about Coinbase going public possibly next year, as it intends to do at least. But we'll save that for 2021. Happy New Year, Dan! Thanks for chatting Bitcoin with us. All right, let's talk more about the broader markets here and what various money managers are talking about with their clients. I want to bring in Sandy Brager. She is an experienced partner and managing director. Sandy, thanks for being here. I want to kind of build off of that conversation we were just having about Bitcoin, because this year, interestingly, has been characterized by this sort of thirsty cash looking to chase these various trends, right? Whether it's Bitcoin, whether it's IPOs, whether it's SPACs. Are you, hearing from your clients, like, get me in this stuff? And are they complaining if they're not, and just sort of, only benefiting from the 15% or so gain that we've seen in the S&P 500?
Good morning, Julie. Yes, the reaction by our clients is across the board. There are certainly clients, and we work primarily with corporate executives, entrepreneurs, family business owners. So many of our clients are involved in startups, either creating them, working within them, or funding them. So there's been a lot of participation in the IPO space, which has been really exciting. So the concentration there from our part is helping clients think through diversification strategies for their concentrated stock positions, which is quite exciting. It's bespoke to each client and is really based on what's most important to them. On the other side of the range, clients are a little fearful of some of this froth, and they haven't wanted to have anything to do with it. And when we look at managing our clients' diversified portfolios, diversification is really key for us as we head into 2021. We think that being invested is really important. We're definitely not sitting on the sidelines in any way, shape, or form. But we are looking for corners of the market that haven't appreciated as much and haven't gotten as much attention. And lately, that's been the value stocks. They've had a really tough run for the last couple of decades. Up until the fourth quarter of this year, we've seen a rotation away from growth or toward value. We think that's going to continue into 2021 and beyond. So we've been making a lot of investments there. And we've also seen a rotation out of the United States and into overseas investments. And we're very excited about the overseas investments we're making. We're invested in China, Taiwan, Japan, the UK. A lot of diversification there, and in big names that people are aware of, Samsung, Tencent, Alibaba. So these are big companies. There's a lot of opportunities, but in the diversified portfolios, we are staying away from what we view could be a frothy situation. We're trying to be more balanced there.
So Sandy, on the first day of trading for the new year, what should investors do? What's their first plan of attack? Do they sell winners and go all in on value stocks? I mean, so many folks that we talk to, they're sitting on big gains in Apple, big gains in Tesla. And I know they think those gains are likely to continue, but really, who knows?
Yeah, well, the answer, Brian, is really based upon each investor's individual goals. What are they trying to achieve? If they're requiring the returns from those big investments to fund their financial objectives, taking some money off the table might be a good idea, and diversifying it into some of these value stocks or international stocks, as I mentioned, could be great. The idea of pushing it into 2021 is nice from a tax perspective because you have a whole nother year to make tax payments on the resulting gain. But it depends on each investor's longer term perspective. I think the important thing, as I mentioned before, is staying invested. And for those who have money available, to continue to make investments in the stock market. An easy way to do that is through retirement plans, and certainly maxing out 401k plans for people who can do that. And there's a great strategy that we love called a mega backdoor Roth conversion, which sounds a little nefarious and illicit, but it involves making additional contributions to a 401k plan when your employer allows that beyond the 19,500 that everyone can make, and then converting those. When you make the additional contributions, they're made on an after-tax basis, meaning you're using money that's left over after you've covered withholding and other benefits, and you're contributing that to the plan and then converting it to a Roth. So it's a tax-free exchange from after-tax money into a Roth. You can put away in total $58,000 per year in 2021 in 401k plans, including whatever match your employer might give. We think that's a really great way to start saving for the future and capitalizing on growth in the stock market over long periods of time. The sure money maker.
Yeah, Sandy, I love that phrase, mega backdoor Roth, because mega just makes it a lot more official, right, than I think it otherwise would have sounded. And I guess along those lines, I'm curious, how much your conversations with clients are about individual names or styles that you like, and how much is about, hey, we need to be in this kind of a strategy to minimize our tax burden, and we can let's just let that ride for 15, 20 years and then revisit. Or maybe we can carve out a side account where, you can play value stocks or whatever, but all that kind of stuff is really window dressing around, I think, some of this, planning stuff that you're talking about.
Right. And so, Miles, when we're investing portfolios for clients, we're definitely focused more on the asset class level and on the style level, as opposed to individual names. We think it's really important. We take a dynamic approach to asset allocation. So we're not suggesting that clients take a set it and forget it approach. We're making changes to the asset allocation as the market and our economic views change. So we think that's really important. And for clients who can afford to do so and want to take some risk and feel really, really passionate about certain stock names, we do open side accounts and help them make investments there when they don't otherwise fit in the portfolio. But I have to say, our portfolios are very broadly diversified. So we have a lot of the high growth names in the portfolio, just not as much as an investor would have if they were investing in a more passive, broad-based approach.
Sandy, thanks for being here bright and early on the West Coast. Appreciate it. Sandy Brager is Aspirient Partner and Managing Director. Thank you.
Happy New Year.
Well, coming up next, we are going to wrap up some of the big stats from the year. What have been the outperformers and underperformers? Stay with us.
All right, welcome back to Yahoo Finance Live on this New Year's Eve. Futures are mixed as we head towards the opening bell. So let's bring in Jared Blickery to give us a look back at 2020, some of the sectors, names, styles that outperformed this year. And, Jared, we'll get the final settlement after the bell today. But barring any crazy moves, we have plenty to talk about for the year just completed.
Yeah, we definitely do. And let's just go straight to the Wi-Fi Interactive. I'm looking at the S&P 500 year to date right now. And just thinking about that incredible drop, 35% down, and then this relentless pursuit to the upside that we've seen with only a few 10% corrections here, which seemed pretty disastrous at the time. But nevertheless, we are right by all-time highs going into the new year. And in the NASDAQ, we're sitting on some pretty nice gains, 43% year to date. And you look at the FANG heavy NASDAQ 100, 47%. So anybody who went to sleep exactly 1 year ago is feeling pretty good right now. The rest of us are not. Now, here's what happened yesterday, but I want to go straight to what has happened over the last month. Now, you can see some nice gains in most of these big cap FANG names, like Apple's up 12%, Amazon and Microsoft up 3%, but Alphabet and Facebook, part of the mega caps that really fueled most of this rally, not participating over the last month. Now, a lot of this has to do with the rotation that we've seen into value and cyclicals. But if we just take a look at the sorted performance here, you can see to the downside, names that were very strong throughout most of the year, Moderna, which is down 27% this month, and Zoom, 26%, way at the bottom. Those stocks haven't done as well this particular month. But then you go to year to date, and what a picture here. Up in the upper left, Tesla up 730%. And we'll just change this to a year-to-date chart. We know the story of Tesla because we talk about it just about every single day. Had a record high yesterday. Moderna up 468%. Peloton, kind of a story that people had counted as down and out. That's up 445% year-to-date. So a lot of the leaders here just still dominating in the year-to-date stats, but kind of falling off over the last month or two. It's going to be instructive to see where the rotation takes place early in the new year, because we have this huge event coming up, which is next Tuesday. That's the election. And I think there's going to be a lot of market moves around that. There's probably going to be some selling of volatility after all the dust settles. But if there is a blue wave, just be prepared for a possible 10, 15% correction. So here's the sector leadership for the year. Tech, XLK in the upper left, up 41%, followed by discretionary and communication services. No coincidence that these are the FANG sectors right here. And then you look at energy to the downside, off 36%. That has been the biggest loser of the year.
Yes, by a long shot. Although, as you pointed out to us, I think earlier in the week, energy has been an outperformer here this quarter. Yes. And, one of the themes that we've talked about this year also is the so-called thirsty cash, right? People are having trouble getting yield in the bond market, certainly. And people have stimulus checks. The people who have money tend to have more this year because of this K-shaped recovery that we have seen as well. They've been looking to put it to work. You've been showing us some of the places, but as we know, a lot of it was also flowing into IPOs, into SPACs and things like that.
Exactly. So let's go back to the Wi-Fi Interactive. I have our IPO 2020 heat map up here and some huge standouts. I mean, if you look at some of the bigger names, QuantumScape, now this is an EV play, battery play that we've been tracking. It's been off the last month, but it's up 892% year to date. And then you look at some other stocks like DoorDash, recently coming to market. That's down 26% from its IPO price. And then some of the other standouts that we can find here by sorting by performance. This is an issue that just came out yesterday, Danimer Scientific. Now you go back all the way to its $10 IPO, up considerably since then. And then some of the other EV plays like Laser, Luminar, that's up 254%. So it's been a really interesting year in terms of where these hot money flows, thirsty cash, as you put it, is flowing. And a lot of it has simply gone into the new listing space. And now we have direct listings, we have IPOs, we have SPACs, and now companies can actually bring money to market. They can actually get money from the public through a direct listing. So all kinds of opportunities heading into the new year, hundreds of SPACs looking for the next play. And, it's kind of been one of the great democratizers, SPACs, that you can actually get in at a pre-IPO price. So I'm really thinking that in the new year, yeah, crypto, maybe cannabis, IPOs. Nevertheless, there's still a lot of cash on the sidelines here, guys.
Yeah, Jared, I think that ruling from the SEC that you can raise new capital in direct listing has potential to be a really, really big game changer for this market. And again, I think a lot goes on in 2020, but that chart you showed or the month to date or quarter to date performance of some of those really high flying names, how they've sort of cooled off a little bit. Another very interesting dynamic to watch as we get into 2021. All right, coming up on the other side of this break, the opening bell here on this final trading day of 2020.
Tepid action, perhaps, to end the year, at least if you're looking at the futures here this morning, which not showing much of a move. But let's take a bigger look at strategy on the part of investment managers. Jeremy Bryan is joining us now. He's Gradient Investments Senior Portfolio Manager. Jeremy, thanks for being here. I'm paying a lot of attention over the past couple of days to increasing reports that the vaccine rollout is just not happening as rapidly as had been predicted. And we've also been talking to a lot of folks who are very optimistic on the market for 2021. And so putting those two things together, I'm just curious what risks you're concerned about, especially given the run-up that we've had this year that could derail things next year.
Yeah, I think you hit it exactly. I think vaccine rollout, because vaccine rollout is going to require, that's what's going to get us restarted, right? It's going to reduce the restrictions that are out there and allow spenders to become spenders again rather than savers that they've been in here recently, which will get the economy going, which will accelerate earnings. That's what we really see as the playbook for 2021 and to keep the markets going higher. So the real risk there is that we have delays and continued delays in the rollouts of these vaccines that don't allow us to do those kinds of things. And so if we start to see this, it's not emergency status right now. We weren't expecting a lot of people to be vaccinated right now. But as we enter into the late spring and summer months and we're still well behind and we still have a very low vaccine distribution rate, that could be a problem going forward. And that could bring the earnings estimate numbers down as a result of that. And then you're talking about a more expensive market.
All right, we see there live pictures from the floor of the New York Stock Exchange. Final opening bell of the year. Maybe by the end of 2021, we'll see a few more folks down there on the floor. And Jeremy, let's talk a bit about the outlook for 2021 as it relates to corporate earnings and what that might mean for the market. Right now, I think estimates are 22%, something like that, increase for the S&P over last year. Obviously, quite depressed from what we saw in 2020. But we've talked on this show and we've heard opinions both directions. These are either being too aggressive or maybe even too conservative, I think, given kind of the earnings power that some big corporates might have.
Yeah, a lot of that, I honestly think that there is dry powder for earnings to actually accelerate higher than even anticipated this year. I look at it in a couple of different sectors, industrials being one of them. In the cyclical place, there's a rebound already somewhat assumed in the market. Now, the question is how aggressive is that pent up demand coming from those? And, a lot of these companies have really reduced their cost. And so if you've seen it, they're operating better. And now they can get more demand coming through those pipelines. That could really reaccelerate their earnings. I think the other two markets or the other two sectors that I'm really looking at in that space for acceleration is consumer discretionary. Obviously, we're not doing things right now, right? We're not taking vacations. We're not doing those kinds of things that we historically have done. So there's an opportunity now to do that potentially in 2021, which could release some of that pent up demand again, accelerating their earnings. The last one I'm looking at is financials. And if we have interest rates that steadily rise, they don't have to go up aggressively. But if we are going to keep short-term interest rates low and the rising long-term interest rates, that could be really good for financials. They could actually start earning some spread from their money, which could accelerate their earnings profiles. And not only that, they can buy back stock as well. So there is a lot of avenues, frankly, in my opinion, for earnings to actually promote upside going forward, as long as distribution and the things we can do to recover continue to happen.
Jeremy, what's your probability that next year stocks flat out underperform, that they just go down? And what would trigger that?
Oh, there's always a probability of that. I wouldn't call it incredibly high based upon what we know now. What I always say is what we know now may not be, and 2020 was a perfect example of this, right? Is that last year we thought relatively calm. We were heading into an election. That was going to be the biggest concern. We did not know what the ramifications of COVID would be, and that had a dramatic turn. And then obviously, secondarily, it kind of worked its way through that. So in that regard, there's always a probability we could decline. I think the biggest things out there right now would be around delayed distribution of vaccines, delayed reopening. Those kinds of things are the ones that we see the most problematic with regard to, because again, I think we've already assumed some of that, right? I don't know how much, but we've assumed some of that happening already in 2021. The question is how fast and how far that'll go. If it ends up being below what we anticipate and numbers have to come down as a result of that, you're talking about an elevated valuation. And how far can you stretch that band is a good question. If we decide that the market is now anticipating too much growth and we look at valuations overall and we say, okay, now I'm paying a lot more than even I thought I was, that's where you could have a decent probability for a declining market during that period.
Jeremy, finally, you were talking about some of the financials and the other sectors you're looking at. You're also looking at some REITs here. And I got to say, what caught my eye was a senior housing REIT that you're looking at, NHI. Oof, this feels like stepping in front of a moving train, given some of the headlines that we've gotten about this sector. But you think maybe they've hit bottom and could recover next year?
Yeah. So the numbers aren't going to look great even this coming year. There's probably no question. But I think from my perspective, what I've seen is that we've hit a bottoming area from that perspective of things getting worse for them. You got to remember, at the end of the day, senior housing, as we roll into 2021, will be among the first to receive vaccines, right? So there'll be a normality to a certain extent of their business starting in 2021. Now, I don't know exactly when that will occur. And we're not aggressively going into these things, but we do now buy one because of that. Exactly what you said before is that we think that estimates have somewhat bottomed there. We think valuation is very cheap compared to their long term. If we think interest rates are going to remain relatively low, these things pay very high dividend yields as well. So in that regard, there's a lot of things it's one of the plays that we like to say, it's like, hey, it may not work in the next couple of months, but I think over the next few years, this is going to be a valuable space to own and a good piece of property to have as their business starts to normalize and they get back, and they could be among the first to get back to somewhat normality of their life going forward.
Interesting. All right, Jeremy, thank you so much. Happy New Year to you. Jeremy Bryan, Gradient Investments Senior Portfolio Manager. All right, we were going to bring back Jared Blickery. Now, we were just talking about some of the stats for the year as well as for the quarter. Let's focus on what's going on today on this last trading day of the year. Jared, what are you seeing?
Well, I'm looking at the indices around the world, and there's a little bit of red, but not a whole lot of movement here in the U.S. If you take a look at the Dow, the S&P, and the Nasdaq, all in the red, but Dow's down the most, 15 basis points, 50 points, really not a big deal. Here's what's happening month to date in the Dow, up 2.4%, still sitting on some gains here. S&P 500, almost 3%, and the Nasdaq, which is down a little bit today, up the most, up 5.5%. And just kind of thinking about what the main drivers of the rally, the recovery has been, it's really been about the FANG stocks most of the year, but also some latecomers as we saw this slow fits and starts rotation into value and cyclicals. So here we have Apple up 1/3%, Alphabet and Facebook each up more than about 0.75%, Microsoft slightly off, and Amazon down about 2/3%. But look out, also I want to point out Zoom. Now Zoom, our company of the year, not having the best month, down 27% so far, but you take a look at what it's done year to date, that's also pretty impressive, up over 400%. And so just thinking about the rotation that we've had, I want to go to some of our sentiment indicators. Now this is TAN. This is a solar ETF. This has been up quite a bit. If you take a look at what the driving forces in this month have been, that is a leader. And then you see BETS, that's up 10%. That's a gambling ETF. And then regional banks up 9.6%. And then XRT, that's a retail ETF. Emerging markets, biotech, software, all of these are outperforming along with chip stocks. So we've had this rotation, but we've also seen money pour into a lot of the existing leaders here. Now you take a look at what's happened with the software space, a little bit different story. It hasn't been the greatest month for some of these names that have been stalwarts of this rally. Zoom is down 26%. We went over that. Salesforce is down 10%. That's more of a story about the value, the cost that it's going to take to acquire Slack Technologies. But the chip space really has been, I think, one of the year-to-date best, most consistent performers. Anytime we've seen the slightest little bit of a dip in the chip index, that's the Philly stocks, we've seen it bought pretty quickly. Haven't seen much of a downturn in them. Just checking out year-to-date in the chip stocks, Taiwan Semi just really killing it, up 87%, stealing market share from Intel. Intel's a standout too because it's down 18%. We'll have to see if Dan Loeb can get some leadership changes in a new direction in the new year. Also checking out the travel sector because that's really bounced back. Now this is year to date, so you see a lot of red there. Carnival Cruise Lines down 58%. But in this last month, we have seen it up 5.5%. So sitting on some decent gains here, just clawing back some of those big losses we saw earlier in the year.
Indeed. All right. Thank you so much, Jared, for keeping track of everything for us. There's obviously a lot to keep track of this year. Should be interesting to see what 2021 brings. Thank you. All right. We are going to take a quick break. And when we come back, we'll be, oh, look, take a look at that. I believe that is North Korea where we are seeing them celebrate the end of 2020 going into 2021. We're monitoring the celebrations that are occurring around the globe, and there it actually looks like there are a bunch of people there. Here, of course, in the U.S., we will not see big mass celebrations this year. All right, when we come back, we're going to be speaking with the CEO of Graphico. Stay tuned.
welcome back to Yahoo Finance Live on this New Year's Eve day. We see markets mixed here in the U.S. in the early going. Let's go overseas for a look at how things are going in that market. And begin with the story. I kind of touched on something we discussed here, and that is vaccine rollout. Yahoo Finance's Kumana Ramanathan joins us now for the latest on how the military might get involved, something that we've heard some corners of the U.S. political discourse discuss as a necessity to get vaccines rolled out efficiently.
Exactly, Miles. And here the enthusiasm has not wavered at all. We have the defense secretary saying that he's willing to have at least 130 military planners as well as 250 more people on the ground just to get this campaign off the ground. All he's waiting for is the green light from the government, which we have yet to hear about. There could be some conversations happening behind the scenes. So who knows? It could happen at any moment. But what does matter is that the UK government is very excited about the Astra vaccine. There's a number of factors here. Of course, it's cheaper. We know that it can be stored at a higher temperature than its Pfizer and Moderna counterpart. So very significant overall. So this could be the game changer the UK is looking for, but I would take it one step further. For the world as a whole, as mass vaccination campaigns are the goal to really stem the tide with the COVID breakout. Now, also important that the knock-on optimism that has come as a result of the news of the AstraZeneca vaccine is very much vast here in the UK. Now, we saw the FTSE gain on the back of the news breaking yesterday, and then also we saw the trajectory for sterling heading up. Why is that? Well, the UK is very much a service sectional economy. So as the sort of sentiment opens up about the economy opening up, that means more people will be able to head out to go shopping, to go to restaurants, all of that. So collectively gains to be made.
And speaking of gains to be made, Kumana, the UK economy is actually set for record growth next year. I don't know how it's going to feel, though, considering there's Brexit, considering there's this sort of long slog here with the vaccine.
Indeed, Julie. I mean, it has been a hard year for all of us. Here in the UK, we've had looming restrictions. Of course, we've had heightened restrictions just put in place a few days ago for most of England. So the news that private sector economists say that the UK GDP is going to expand as much as 5.4% next year is positive overall, as we would assume. But what's important to note is that the unemployment rate is also expected to grow. And that is going to be the real clincher in terms of UK gains and what we're going to experience, of course, on a day-to-day basis. Now, this gain that we see for the economy as a whole is the biggest leap in modern history for the UK. So, nothing that we should be badgering around about and not thinking is not significant. Given the year we've had, though, people are really going to continue to struggle a little bit. But as I said in my previous response to the question, services sector hopefully is going to get that boost that it needs to get people out there, shopping sentiment rising, and overall steadier gains for the UK economy as a whole and the globe, really.
All right. Yahoo Finance's Kumana Ramanathan. Kumana, have a great new year, and we will talk to you in 2021.
Happy New Year, everyone.
All right, a lot more coming up here on Yahoo Finance Live right after the short break. All three majors lower in today's early going.
watching Yahoo Finance Live. I'm Julie Hyman, taking another look at what's going on in markets today as we reflect on 2020. A lot of reflection happening today. We are seeing all three major averages pull back very, very slightly. Of course, all three major averages are also still trading near records. We should note for the year, the S&P is up about 15%. The Dow is up about 6.5%. Call it the NASDAQ, of course, has been the outperformer with a gain of more than 40% on the back of the real strength that we have seen in the FANG stocks, and really the dominance of those companies has continued and been solidified this year. So many people have relied even more on large cap tech in terms of driving the work from home trend. But we're watching some other assets as well today, just as we have, of course, this year. We've been talking a lot about Bitcoin. Gold deserves mention as well. Gold, by the way, is up about 24% year to date, because even as we have seen stocks rally and this sort of risk on tone, it looks like people have still been hedging to some extent. And so that has helped to drive the trend upwards in gold, just as we have seen that trend upwards in things like Bitcoin. One of the other things that we don't talk as much about, but certainly investors are watching, is what's happened with the US dollar. If you look at the dollar index, the so-called Dixie, it is down almost 7% this year. And there are some strategists who are predicting that that underperformance of the dollar will continue. So something to keep an eye on as we head into this year. And finally, oil prices I wanted to mention as well. Oil prices down more than 20% this year. There you see the dollar index. We've seen many of the energy companies rebound in the fourth quarter, but we'll see if that continues as demand starts to pick back up again going into 2021. All right, that's a little bit of a roundup of what's going on with various asset classes. We'll be right back.
UK-based chipmaker Graphcore has flown a bit under the radar this year, but that unlikely will be the case in 2021 as the NVIDIA rival this week raised $222 million in fresh capital. The company is now valued at $2.77 billion. Let's welcome in Graphcore co-founder and CEO Nigel Toon for more on the company's plans. Nigel, good to have you here this morning. So for those viewers not too familiar with Graphcore, how is what you're doing different compared to some of the more names that they are familiar with, like an AMD and NVIDIA?
Yeah, we have developed a completely new type of processor built from the ground up, especially for AI. We have many more processor cores, inside the chip. We have a very different interconnect between those processor cores, and it really delivers a very different set of performance capabilities for customers, really accelerates for a wide range of AI applications just built exactly for that application.
So Nigel, this is a nice chunk of money that you did in fact raise this week. How you use that money change if an NVIDIA does go out there and they're able to get that deal, that $40 billion deal confirmed with ARM?
Well, I think for us, we are absolutely focused on running as fast as we can. We're driving a strong roadmap. We've already built the world's most sophisticated microprocessor. We have 59 billion transistors on our chip. We're delivering much higher performance than the NVIDIA GPUs. We're obviously concerned about NVIDIA buying ARM, not so much for ourselves, but more just because it's not good for competition. We don't think it's good for the industry. We think it cuts off access to this advanced technology potentially for other companies in the semiconductor space. And I think it will be bad for competition overall.
And then Nigel, kind of going back to the technology itself, I'm curious, maybe for a lay audience. I mean, I don't really know anything about semiconductors and chips and all that. What is the difference between the computing power that's necessary to run some of the AI applications that we hear so much buzz about, and how much different does what you guys are making need to be? How much more power, I guess, does it need to have than sort of what is out on the market relative to the goals, again, that I think the real evangelists for AI kind of see as possible in the next couple decades?
Yeah. Well, I think the big thing to realize is that for 75 years, we have been telling computers what to do step by step in a program. And now the computers are learning from data. And that is a completely different type of compute. It requires a completely different type of processing solution. And you can't just take what exists today and apply it. You can get some performance, but really you need to sit down and create a completely new type of processor for this new market. And that's what GraphCore has done. And that's why we're able to get this much higher level of performance. This is a processor designed to learn from data, designed to support artificial intelligence.
So Nigel, it's Julie here. That sounds expensive, again, to a layperson. Both sort of the R&D to develop that kind of chip and then perhaps the production of it. So talk to me about your cost structure. It's my understanding that you are not yet profitable. What would be sort of the critical mass that you would need to reach in terms of your sales in order to get there?
Well, we have about 500 people in the company today. We're growing still very, very fast. We have raised so far since the company started just 4 years ago, we've raised over $700 million, but we actually have nearly $450 million of cash at the bank. So we have all the resources we need to be able to grow our revenues and to really be able to build a very large business here. And obviously, these very large investors who are coming in and supporting the company, they can see the potential behind what we're doing and the huge market opportunity that is in front of us. So this is, very much about running as fast as we can, building this incredible technology and growing to become a major player in the marketplace.
Nigel, you're no familiar to doing deals. You sold a business, I believe, back in 2011 to NVIDIA. What are you more inclined to do? Do you see GraphCore being part of another major chip maker, or is 2021 the year that you continue to build your business and then IPO later in the year?
Yeah, I think 2021 would be too early for us to IPO. We need to really knuckle down and build our business over the next 12, 18 months, and then we'll see, where we are at that stage. But this is a massive market opportunity, and I think there is the opportunity to build a business that is designing and supplying these new types of processors for what will be the most important computing workload on the planet. AI is going to dominate a lot of new application areas, and there is the opportunity to create a specialist company that is focused in on that, just as we saw in mobile, just as we saw originally with computers. This is a new paradigm, and new companies will emerge here, and I think Graphcore is at the leading wave of that.
Well, we look forward to following your journey for sure in the new year. Graphcore co-founder and CEO Nigel Toon, Happy New Year. We'll talk to you soon.
Happy New Year. Thank you very much.
Thanks. All right, do stick around. Much more ahead on Yahoo Finance Live.
All right, just before 10 o'clock here in New York City on this New Year's Eve 2020. Welcome to Yahoo Finance Live. Miles Udland alongside Julie Hyman and Brian Sozzi. Let's take a quick look at the markets here. We are red across the board in the early going in the U.S. markets. We see the Dow is off about 27 points right now. The NASDAQ is off about 0.2%. Well, as is a fun little tradition here on New Year's Eve day, we can track where we are seeing New Year's celebrations across the globe. We had New Year's in Australia over the last couple of hours, and I believe we are looking here at live pictures from Pyongyang, North Korea, as they ring in 2021. Also, the new year being rung in South Korea, Seoul, and Tokyo, Japan as well. Tokyo, of course, has a big year coming up. The Olympics moved from last year to this coming summer. But again, as we see here on the screen, Pyongyang bringing in the new year in North Korea. Well, it's been an eventful year in markets. Certainly, S&P set for its second straight double-digit gain. The NASDAQ, as we were talking about with Jared Blickery earlier on in the program, up 40% this year. It's also been a wild ride in the fixed income markets. Treasury yields hitting record lows. The Fed emergency cutting rates to zero over about a 10-day period back in February and March. So let's keep our conversation there in fixed income. Jack McIntyre is a global fixed income portfolio manager at Brandywine Global, and he joins us now. So Jack, let's talk about the stimulus that just got through and how that might affect growth and I guess in turn, yields. We've seen the long end of the curve perk up a little bit. I mean, we're talking about 90 some odd basis points here, but do you see any upside risks, I guess, in terms of yields, again, particularly the long end that can be more sensitive to growth trajectories and maybe what the Fed does in the next couple of years?
Yeah, so expectations are for yields to sort of drift higher. What the catalyst ultimately and always is inflation. So we have to see what inflation is going to do next year. Certainly it's probably going to edge higher just on base effects alone. I don't think it's going to get out of hand. I view this year as sort of this war between the pandemic and the policymakers. The policymakers have certainly been winning. The last round of stimulus shows that they are probably have won the war. Obviously on the vaccine side of things is more important, but as it ties to fixed income, treasuries don't need to be the flight to safety that they were earlier this year.
Jack, I also want to ask you about fiscal policy for just a sec, because yes, we had that stimulus passed, and a lot of guests have been bringing up with us the special election in Georgia and what that's going to mean for the outcome in the Senate. The trading has behaved, and the conventional wisdom has been that Democrats would not win that election and therefore not take the Senate. But the numbers seem to be shifting a little bit. Do you think markets are going to follow, or do you think it's going to be sort of more down to the wire?
It's probably going to be down to the wire. It seems like everything on the political side is down to the wire these days. We're obviously going to know very quickly in the new year, January 5th. But as we manage our portfolios, we're making the assumption that the Republicans are going to maintain control of the Senate. Therefore, we're not going to see quite as much fiscal stimulus as we would if the Democrats controlled through all three houses.
Where can investors right now find yield with a reasonable amount of risk? We talked to a lot of investors, and that is one of their biggest challenges headed into 2021.
Yeah, so we're positioned in emerging markets, and we have two reasons for doing that. One is that there is a fairly significant yield premium. It's amazing that we have 18 trillion with a T of negative yielding bonds in our universe. My head kind of explodes when I think about that concept. So there is a huge amount of capital. Capital is going to slosh around into the global markets. It's going to search, I think, for yield, and EM sort of should attract that. And then I think, and I'm in that camp, I think the US dollar should have more downside. I mean, it's obviously not going to be linear, but we've had a bull trend in the US dollar since 2011. It needs to sort of weaken in here on a sustainable basis for 3 to 5 years. So we are positioned for EM, and I know sentiment in the short term is certainly probably a little too euphoric, but if you have a longer term time horizon, I still think that's a good place to be.
Jack, it's interesting. We go back to the beginning of the year, and the conversation pre-pandemic was about, this is the death of the 60-40. I mean, we're not, and then all of a sudden we saw this huge rally, in fixed income, and that portfolio actually worked quite well. And certainly that stat about negative yielding debt is concerning. But how difficult are the conversations now with trying to convince folks that there's still a place? We just saw it. There's still a very real place for fixed income within a portfolio. Not even just as a diversifier, but just as a source of, return, capital appreciation on some of those bonds, given the moves we saw.
Which you're right, and it's a conversation I'm having with my clients all the time, because fixed income, what is the role in asset allocation? And you're right, it is. It can be a diversifier. I mean, we're talking about the high quality bonds, treasuries, bonds, Japanese government bonds, et cetera. So yeah, you need a part of that because you don't know what the next sort of big catalyst for uncertainty is going to be. But having said that, though, and it goes back to what I alluded to about that negative yielding bonds, there's a gravitational pull of those very low negative yielding bonds to things that have a yield. And again, it comes down to inflation. And I just don't think inflation in the emerging world is going to get out of hand. If we're right about these currencies strengthening, then inflation in those countries, and I'm speaking very homogeneously in terms of EM, and you shouldn't do that. But I think inflation is going to be well behaved. And that means that you should continue to see yields decline in those particular bond markets.
All right, Jack McIntyre, Global Fixed Income Portfolio Manager at Brandywine Global. Jack, thanks for joining the show. Have a great new year.
Happy New Year.
All right, let's turn our attention now to the retail space, another area we've seen a lot of transformation this year, a lot of forced transformation. So what sticks around in the year ahead and what does not? Joining us now for that conversation is Sucharita Kodali. She is a retail analyst over at Forrester Research. Sucharita, great to talk with you once again. Something stood out in your notes about how the costs of this digital acceleration for a lot of businesses are quite high, and they may not, may not stick around as we get into next year. I mean, how are you trying to tease out which trends that were forced this year are durable and which ones might reverse? Is it the size of the business? Are small businesses not likely to be as digital, or is there something else?
Yeah, it's probably actually a little bit of the opposite. Some of the larger retailers, like the grocers that have really been forced to lean into digital, the big questions are which parts of digital do they continue to embrace and which ones are there for the long term. The truth is that sectors like grocery and even much of traditional retail is not great from a margin standpoint. And a lot of the efforts that have been, just part of the landscape in the last several months, like curbside pickup or delivery, are likely not long for the world. They are just simply not profitable. And unless there are major changes to the way that those businesses are set up altogether, it's really, really difficult to be delivering orders on demand from grocery stores or from restaurants. So that's really what I'm talking about with respect to what happens.
So Tarita, one well-known company that really is not playing in digital at all, or even buy online, pick up in parking lots, JCPenney. I mean, this is a real dog of a company, terrible online shopping experience. They just gave their CEO the boot this week after about 2 years. They just emerged from bankruptcy. Do you think they have any shot at true survival next year and even beyond?
Probably not. I mean, JCPenney has been on life support for years now. I mean, ever since the Ron Johnson years, it has just been on a steady slide down. And it has very, very little chance of recovery. It is not in great real estate locations. It is not well off financially. It has no brand resonance with consumers. And it's just not well positioned for the future. And it certainly has very little digital strength right now. So all of the cards that it has are not good. What is shocking is that it is still alive and that it has not died through the course of the pandemic. I think, if anything, that's a lesson in how resilient retailers are and how hard it is to really kill a retailer.
Sorry, Brian?
No, yeah, Sucharita, I'll even add on too, switching gears from a JCPenney. So much focus right now is on minimum wages, and minimum wages are going up in 20 states on January 1st. Are there any retailers that you think could really be hit hard by some of those minimum wage increases? To me, top of mind are the dollar stores.
Right. Well, a lot of retail and, a significant part of like big box retail, even some of the small box retail, as you mentioned, are already paying minimum wages. And so any kind of an increase there is going to have an adverse impact on their profitability. I think that the bigger questions are, how efficient do these companies become over time? How strong are they at being able to identify who are their better workers? What we've seen is some of the most progressive retailers, like say an Amazon, even arguably a Walmart, have already proactively raised minimum wages for their workers ahead of moves like this, in large part to both position themselves for greater automation and to try to get better workers to begin with. That's just I think, kind of historically has been one of the flaws of retail, is that they have not paid well. And it is often a dead end job. And as a result of that, there is a cycle of poor customer experiences because very few retailers have invested in the store associate as a communicator of great customer experience.
Sucharita, it's Julie here. I do want to talk about Amazon a little bit more. You just mentioned it with regard to the minimum wage debate. But not just Amazon itself, but the companies that sort of partner with Amazon and that whole ecosystem that exists around Amazon. Where do you see that going in the next couple of years in terms of what those partnerships look like?
So I assume that you're talking about some of the there are different ecosystems that orbit Amazon. There is the seller ecosystem, and those companies are likely not going anywhere because they're highly dependent on Amazon. But then there's a whole ecosystem of technology service providers that help to facilitate people's presence on Amazon, and those companies have essentially their entire bread and butter built on kind of facilitating Amazon sellers, providing data around Amazon. The challenge for those companies is that Amazon could displace them at any moment in time. Terms and conditions and what data they may have available could change at any moment in time. But most of these companies are relatively small. They're essentially agencies. A lot of them have been growing to support other marketplaces so that they are not entirely dependent on Amazon. But in general, I am not a big fan of any company whose entire business is dependent on Amazon, because it is just you're placing yourself in an extremely vulnerable position. It's the Porter's five forces, challenge where, kind of if everything is dependent on one outlet and that outlet holds the keys to distribution, that's a problem for you.
Yeah, most definitely. I want to ask about Amazon itself too, because while this has been a year where Amazon has really been dominant, it's also exposed some of its vulnerabilities, right? It has had shipping delays. It's not been immune from those issues. And we've also seen some of its competitors really heat up. I mean, Walmart has really been quite successful, particularly when it comes to fresh and groceries. Is Amazon imperiled in any way, or any parts of its business under more direct threat now?
I can't see any situation where the competitive landscape threatens Amazon. The biggest threat to Amazon at this point in time is some kind of a regulatory framework, some type of antitrust regulation or penalty that the company has to pay, some sort of forced divestiture of parts of their business. That's really the only threat that I see, even though they have not always delighted customers through the course of the pandemic. Many orders have been late, they've been out of stock. And there are perpetual questions around the quality of merchandise and inventory, because a lot of the merchandise in Amazon comes from retail arbitrage, where consumers and sellers are literally buying things and reselling them, which does not bode well for great quality merchandise. The truth is that it's indomitable right now. I mean, Amazon is top of mind, and it's a bit of a self-fulfilling prophecy where so many companies that I talk to just think that there's no other game in town than to sell on Amazon. I think that that leads to the behemoth that Amazon has become and will continue to be, which is why kind of regulation is really so important, and why these questions are very valid to be raised now. And that, I think, is probably the big theme, I think, in 2021 for all of the tech titans, is what happens from a regulatory framework. Will Europe lead the charge? And what ultimately, what impact does that ultimately have on the consumer experience?
Sucharita, it's interesting. My wife and I are eyeing up a semi-large appliance purchase, and I was like, we can't buy it on Amazon, it's probably going to be fake. And we haven't settled that debate yet, but certainly there's a lack of trust there. And speaking of a lack of trust and regulatory concerns, I want to finish with Alibaba. We have seen that story evolve pretty quickly over the last couple of weeks, with the Chinese government cracking down on Ant Group. And I mean, it seems Jack Ma personally is sort of being targeted here as well. What does that change for Alibaba, which, for viewers who might not know, owns 33% of Ant Group, which is really under the microscope here?
Right. It's what is happening in China, I think, is so fascinating. China is the largest e-commerce market in the world. Alibaba is the dominant player there. And it always struck me as strange that Alibaba had as much market share in China as it did, because if it were truly operating in a market economy where the best ideas kind of percolate to the top, there would have been more competition all along. So where I'm left with is the conclusion is that Alibaba had been propped up by the Chinese government all along, and what that did was that they essentially gave Jack Ma kind of substantially more, ability to impact commerce in China than probably they ultimately, which is what is happening now, than they probably realized was prudent. And what you essentially have is that the Chinese government basically pulling back on the free rein, the loose leash, so to speak, that they had given him. And the question becomes, I think, for Alibaba is, does the Chinese government now allow other players to have a greater role in Chinese e-commerce, or do they continue to have their faith and trust in Alibaba and everything that may be able to provide, like data on customers? And there are claims that Alibaba doesn't share any of that with the Chinese government, but I just don't know how we audit the truth or the reality of that. That seems highly likely to be happening. Is there another leader who they can put in instead of Jack Ma in that position and essentially still have their way, and get him out of the way, so that kind of anybody who critiques the government is no longer kind of an issue for them. So I'm fascinated to see how this unfolds, and what ultimately happens with the government.
Yeah, very interesting story that we'll certainly be tracking in the year ahead. All right, Sucharita Kodali, a retail analyst at Forrester Research. Sucharita, always great to get your thoughts. Have a great new year. We'll talk to you in 2021.
Thank you, you too.
All right, coming up, a lot more here on Yahoo Finance Live on this final trading day of 2020. Mixed market here, about an hour into the trading session.
we know that 2020 has been a time of unprecedented pain for the restaurant industry in particular, a lot of shutdowns, a lot of different regulations in different areas. There's one restaurant in particular, though, in the Boston area where the restaurant owner decided to give big bonuses, or collectively bonuses, to his employees. That's Leo Keka. He's the owner of Alba Restaurant. Leo is joining us now. So, Leo, you know, we're talking, what, about $30,000 in bonuses that you paid out to your staff. I guess my first question is, how did you do this at a time when, you know, cash is hard to come by at a lot of restaurants?
Well, good morning. Thank you for having me here. Well, we started this idea because we figured out it's a struggling time for all of us. So we decided, what can we do for our staff? Because they're the ones who've been there for us since we opened this business. So instead of giving a bonus to our customers this year, we decided we're going to do that with our employees. So each gift card people bought, our guests bought, we donated 15% to our staff.
And so in giving out these bonuses, I mean, I'm sure this was a surprise for your employees at a time where things have been tough. I mean, have your restaurants been open through all of this? What kind of customer flow have you guys seen, and what has the pandemic been like for you?
Well, since we announced this, I think the response has been great from our guests, and people really pitched in to help us, as well as our servers. And business has been really struggling. We've been 40% till now we're back to 25%. It's extremely hard for us. So the hardest part for us is right now to keep our employees. So with return of gift cards, people hopefully coming back, our business will come back and survive.
Leo, you have started to offer meal kits or deliver steaks to people's homes. And we've seen a lot of restaurants do similar things to try to bring in extra income. Has that helped? Has that become a sizable business for you?
Well, obviously, we all know on business and our restaurant business, your marketing, your margin is in your alcohol. So, you know, we try to do as much as we can food to go, but, you know, our experience in the dining, it's always been inside of a restaurant. So doing delivery and doing, you know, takeout, it's always been a great for keeping the staff together. But as far as profits, it's not there.
You know, Leo, as we wrap up 2020, obviously crazy year for your business, your peers in the industry, crazy year in Boston, crazy year here in New York. How confident are you that 2021 is going to look better? What kind of timeline do you have on, hey, I might be able to have 75% of my tables full? I mean, are you looking at, you know, May, June? How are you thinking about next year?
Well, people are coming up with a lot of different ideas when it comes to staying alive in the restaurant business. A lot of takeouts, a lot of fast kitchens, quick kitchens, they call them now as well. But I really think 2021, right after the COVID, right after the vaccine, things will change a lot. People come back. Obviously, the restaurants are a special thing for a night. It's not something you want to do delivery. You want to come inside and have a nice meal, a good service, and a great bottle of wine. Enjoy yourself. Restaurants are meant to go outside and have a beautiful dinner, not being delivered home, my opinion.
And not have to do dishes. That's one of the things I am
Absolutely.
really looking forward to going into next year. Leo Keka, thank you so much for being here. Happy New Year to you. And best of luck to you and to your employees. Leo Keka is the owner of Alba in Quincy, Mass. Thank you so much. Well, coming up next, we're going to be talking to Master P, entrepreneur, and of course, musician, not just about what's going on with his career, but also perhaps an effort to buy Reebok. We'll be right back.
Adidas has finally put Reebok on the sales block after years of failing to turn the sneaker brand around, and now one unlikely group of bidders has emerged. Percy Miller, better known as music icon Master P, and NBA great Baron Davis. Percy Miller joins us now, as does Yahoo Finance lifestyle reporter Reggie Wade. Good morning to you both. Percy, let me start with you. One of the questions, really quite simple, why Reebok and why now?
Yes, can you hear me?
I can hear you.
I think we having some type of problem. Can you guys hear me?
Percy, can you hear us?
Yeah, you guys sound muffled.
All right, we're gonna take a quick break, and we'll be right back on Yahoo Finance Live. Welcome back to Yahoo Finance Live. And we're still joined by Percy Miller, better known as music icon Master P, and our very own Reggie Wade. Percy, let me get back to you. So you have made a play for Reebok. Why now?
I just feel like Reebok has a lot of equity still in that brand. And if that company is black owned, I feel like these guys have tried. But if the majority of the ownership is African American, that we could do more with this brand. And also we can give opportunities for other designers. I feel like the brand needs to be made cool again. And I think that we have the plan to make this happen.
Percy, let me run some stats by you real quick, because I was shocked to find this too. So Reebok is owned by Adidas. They have been for some time.
Yes.
Now, Adidas has had knocks on its lack of diversity internally and even externally. You know, on their executive board is only 5 white males. On their supervisory board, there are 16 people. They have 11 white males and 5 white women. Now that you have gotten internally inside of Adidas, you've talked to them, you've looked at Reebok, you have kicked the tires. How big is that diversity problem in Reebok right now?
I mean, not only in Reebok, but in so many brands. I mean, African Americans spend more money on tennis shoes, and I feel like it's time to add diversity as ownerships in this business, but it's also time to be able to take the control and show other African Americans that it's time to open the doors. We're stronger together. When you look at the African American CEOs, just like you said, of companies, we only make up 0.1%. I want to change that narrative. I feel like we are able to give back to our community and our culture, because we know where to put the money back into the community. The more we make, the more we give. I feel like this is going to give. so many opportunities for other African American businessmen and women, an opportunity to say, if Master P could do this, we can do it. And I feel like after we open the doors with this, thousands will come and we'll be able to solve the poverty issues. We'll be able to go back to rebuilding our own communities through economic empowerment. I mean, you look at the riots and everything that went on, I think it's definitely time for the diversity, for us to be able to get a seat at the table. I started making smaller deals. It's like buying houses. You have to think bigger. I want my culture to start thinking bigger. Say, we went from making $1 million deals to $1 billion deals. I took a page out of Reginald Lewis' book when he did this in the 70s. He was one of the first African-American billionaires. And I feel like we need more at the table. I'm inviting, not only we have Baron Davis, but even to invite Shaq a seat at the table. We can really make this happen together. All the celebrities and entrepreneurs out there in the world saying we have to own majority of this company to make this cool again and make, Reebok need to go black. Like you say, the diversity is really needed when you talk about the tennis shoe business.
Mr. Miller, Reggie Wade here. You're not just talking the talk, you're walking the walk with this.
Yes.
What do you think Reebok needs to do to compete with the likes of Nike? Nike right now has a stranglehold on the athletic shoe market. So what would you do?
Well, like I said, we have to make the product, the technology as good as Nike. When you look at the shoes that Nike put out in basketball and even the lifestyle, being able to bring other brands and tie it in, give other people opportunities. Reebok has been shelved by Adidas. And like I said, this brand is struggling, but it definitely can be revamped. If you look at, people look at Allen Iverson the way we look at Michael Jordan for Nike, we look at Allen Iverson that way in Reebok. We need to bring him to the forefront. We need to bring in better designers. We also need to make this for the millennials. And I think that would be a game changer.
Last year, you came on Yahoo Finance and showed us your Magnati brand, just excellent craftsmanship on those shoes. If you do acquire Reebok, will you bring Magnati to Reebok? What would happen to that brand?
Yeah, that brand would be massive the way Kanye brought his Yeezys to Adidas. And I think that's what we're missing. These brands are not just about sports, even though we're going to get some of the top sports players in the world, but being able to bring high fashion to brands like that, to accent, to be able to say, if we took a Magnati and brought the right designers, the right team with this, that now we have a fashion brand at the same time. So you're touching every area of the business. And also, I just feel like we could make it cool again. We could make Reebok cool again. And I think it's a blessing for us to be able to get into a position like this. When you look at Aunt Your Mama, Uncle Ben's, when you talk about the diversity, we're talking about product. Me and my partner, James Lindsay, we was able to get rice into stores, noodles, cereal. I mean, the game is changing. So I think that a lot of these companies are opening up, and we're able to sit down at the table with a lot of these owners and say, bring some diversity in. Let's get some African-American owned product on the shelves. This is major for our culture if we're going to turn this around. And I'm just saying that this is not about a black thing. It's about empowering people, because it's not going to just be an African-American business. But I'm just saying the majority ownership should be African-American. I think that we could turn this company around.
Percy, Adidas has set a deadline by, I believe it's March 10th to figure out what they want to do with Reebok. But just hearing you talk, are you nearing a deal now? Do you anticipate them carrying this out until March 10th?
Well, even if they don't want to do the deal with us, I'm saying that this would open the doors for so many other opportunities where our culture, the millennials, know that we can do deals like this. They just need to be educated. I feel like this deal would be educating our culture, and it'll be opening the doors for so many deals, because this is not the only deal we have on the table. This is just one of many. And I'm saying next thing, we want to be able to open up banks. We want to be able to purchase commercial buildings. There's so much stuff that we want to be able to do to put other people's products on. I think this is just the beginning. So I hope that Adidas come to the table and say, we want to do business with you guys. If not, then guess what? We're going to make something bigger happen after this. And so this is a blessing. I feel like this is an educational process for our culture, letting them know that we can do this.
Mr. Miller, I know that last year you had your master class and you have restaurants and so many different businesses. How have they fared during the pandemic, and how have you had to kind of change your business model during these difficult times?
Yeah, these difficult times make you think. When you're uncomfortable, you have to figure out other kind of ways. And like I said, you got to put your trust and faith in God. But our restaurant is holding up. Big Papa's in Louisiana is holding up, and we will be franchising that soon. I think that you have to get creative, and a lot of restaurant owners are really getting creative, being able to help the community. It's not just about making money during a pandemic. We was able to feed so many people, feed the elderly in New Orleans. So I think that's a blessing, but it also made entrepreneurs think outside of the box. I watch a lot of restaurants. They turn into making hand sanitizers. They open up their doors. They realize that we have to come up with ways to be able to do other things inside of our business. So, I mean, it made me get creative, and it was a blessing and a curse, 2020. I'm glad it's over. 2021, we off to bigger and better things.
Mr. Miller, I know you grew up in the projects, as did I. What advice would you have for a young Black man growing up in the projects and wants to do something with his life? What would you say?
I would tell that person, never give up on your dreams and your goals. Don't be afraid to take a swing. That's the only way you're going to hit a home run. Consistency, be passionate about what you do, and don't be afraid to change. Don't be afraid to get better. Don't be afraid to grow. Believe in yourself, and others will believe in you. I tell people all the time, when I was in a project, most people only seen the mustard seed. They didn't see the tree. They didn't know my vision. They didn't know, that I could turn into who I am now. And when you're living in poverty, be thankful that you have life. I mean, a lot of people didn't make it. This is a time, the little things. And I feel like success is just temporary. Don't get caught up into the money. Have some integrity. It's a temporary success. It's about what you do with what you have. And I feel like God will bless you with a lot if he could trust you with a little.
Well said, and I'll say this personally, I've been covering for retail for some time. Reebok needs your help, and they need what you guys are in fact offering, so I hope you do certainly win out on this Reebok deal. Percy Miller, great to speak with you today, but really throughout this year, through this challenging year, we really appreciated all your insights. Happy New Year, and we'll talk to you soon.
Happy New Year.
All right, do stick around. Much more ahead on Yahoo Finance Live.
It's New Year's Eve, as we've been talking about. People are getting creative, aren't they, tonight, in terms of their New Year's celebrations. Since we will not have mass gatherings, people won't be going out to dinners, most of us anyway. You won't be going out, certainly, to see the ball drop in Times Square. And there are an increasing number of entrepreneurs who are trying to offer some solutions for these kinds of events, as well as just maybe a Friday night where you want to get a glass of wine with friends. Alexandra Streckengast is joining us now. She is the founder of Virtual With Us, which is a virtual kind of wine party company. Alex, thanks for being here. So basically what you all do is you actually send people the wine that they're going to drink, and then you hold this virtual event. So just tell me kind of how the event goes, what it looks like when people sign up.
Absolutely, and thank you for having me. Happy New Year. So typically how the events go is we work with retail partners across the country to fulfill, and we get wine to everyone's home. We work with a number of vendors for cheese and charcuterie and chocolates to really create a fun experience just from the comfort of your own home.
Alex, when you think about this, are you trying to get are you just trying to get us through the pandemic here, or are you trying to build maybe like a new experience? So in 2024, someone might prefer this method rather than the traditional wine tasting, kind of experience as we knew it, maybe in the before times.
Well, I think it goes two ways. There is going to be an evolution to the business, but the reason that this company really started and why I was inspired to do this was on the one end, my husband, who's in tech sales, was presented with a challenge. He was trying to network with his clients and his prospects and really couldn't find creative ways to do that. And on the other end, a lot of my incredible friends in the restaurant industry, a lot of the sommeliers were furloughed. And I thought, why not marry the two together and really create this opportunity for corporate America? The organizations that we're working with are going to maintain permanent remote status for the most part. And we have contracts through February of next year. And so this really, I think, is something that is going to stay and evolve and progress, where there's going to be an opportunity to virtually interact with everyone. And it's virtual hospitality. It's going to enliven what people might see as monotonous on the day to day. I realize the Zoom meetings are constant now, and this really creates a cocktail hour format with these amazing professionals that are used to lighting up the floor and showing you what wines that you should experience and what cocktails you should try. And it's really helping businesses maintain their business relationships throughout this. So I think it is going to stay, and it's going to be something that is going to progress in the coming years.
How do you think your business will change as folks do get back to work? I mean, obviously not. We're not all going back to the office. We're not all going back to the office holiday party or the cocktail party in the first half of next year. But how do you think that will change as we do go back to work next holiday season?
Well, I think it's going to be on two ends of the spectrum here. So I had the pleasure of speaking with a number of my clients last week, actually. And for the most part, most companies that we're speaking with anyway are letting go of their offices in major cities. They've realized that their overhead, they're saving a lot of money on that end. And additionally, T&E, it's no longer necessary to go away from your family and fly across the country to have that in-person meeting. So conferences will come back, and we will see that. And we have plans for a marketplace and in-person concepts as well. But the virtual landscape and virtual entertaining is going to stay for those smaller touches where you can create a fun experience for people online and they don't have to go anywhere.
And Alex, your clientele, I know, is a mix of companies and individuals, although it seems like it skews a little more to companies. What are the kinds of companies that are signing up? Is it large? Is it small? And how are they using these events? Obviously there's an educational component, it sounds like, with the sommeliers presenting, but obviously there's also a social component too.
Absolutely. So, really, we're working with Fortune 500 and Fortune 1000 companies to scale their business on the sales organization side. So there's a number of different departments that we're touching. So there's the culture clubs inside organizations that are really trying to create that team camaraderie, that water cooler talk that you wouldn't necessarily experience virtually. And then on the other side, there's sales organizations that need their relationships to help build their businesses, to help grow. So we've been able to scale programs for a lot of these organizations because we can host multiple events in one day. We've been able to work with, and lucky enough to work with, over 40 sommeliers thus far, and some incredible chefs as well. Scott Conant was on last week supporting and doing a cooking demonstration. We have Charles Jolie, who's a mixologist. So we were able to really tap different talents across the hospitality industry to create these experiences that are scalable for the organization so that they can host multiple events in one day and touch clients, current clients, prospects, and their internal team.
All right, cool stuff. Alex, thank you so much. Alexandra Streckengost is the founder and CEO of Virtual With Us. Appreciate it.
Thank you. Happy New Year.
And to you. And as we go to break, just want to tell you about some record highs that we have, record intraday highs at least, because the Dow is not still there. It's down now, but it touched an intraday high. And there's some individual stocks who have touched intraday highs that are notable as well. Tesla, after its incredible run this year, is ending 2020 by touching a record high. We've got Starbucks there as well. Monster Beverage, interestingly, is on the list. And Pinduoduo also, although it is down at the moment, earlier touched a record high. It's been a tumultuous month for it and some of the other Chinese stocks that we have been watching. We'll be right back. Well, as we ruminate on this year's winners and losers, certainly one of the losing stocks that we've been watching closely has been ExxonMobil. And the stock, not only have we seen the shares fall precipitously this year, they're down more than 40%, but it just came out with a filing that basically confirmed that it's going to take a write-down of as much as $20 billion of its upstream assets. And that means it's looking at a fourth straight quarterly loss. This has been a year in which obviously Exxon has been hurt by the decline in oil prices, but unlike some of the oil majors, it has really doubled down on traditional petroleum products, where we've seen, for example, the European majors sort of pivot a little bit more towards renewable energy. So far, the bet has not worked out well for Exxon. Brian Sazzi, I know that you've been paying a lot of attention to the dividend at ExxonMobil, which is, I mean, even with that 40% decline, one could argue there's a bit of a floor under the stock for people who still hang on to it for that very reason.
Yeah, guys, you chat up any sell-side analyst that covers Exxon and right now, and they'll tell you that this dividend is, in fact, in risk and at risk in the early part of 2021 of being cut. Because the other choice is this: They either cut the dividend to preserve their balance sheet, or they're going to have to raise more debt to continue this dividend, and that is not good. Obviously, Exxon is a severely indebted company, and they've continued to pile on more debt during this fall off in demand to keep this sacred dividend going. Guys, cut the dividend, shore up your balance sheet, make Wall Street happy. I would say a dividend cut would be welcomed by Wall Street just because it signals that Exxon executives have a clue on what they're doing. Because up until now, when you take a $20 billion write-down, something says you definitely don't know what you're doing.
Yeah, and I think what's interesting with this story is even outside of the Exxon story itself, I mean, it reminds you in some ways of GE, right? What we saw there a couple years ago. And okay, all the details are different maybe, and I'm not really sure Harry Markopolos is going to jump out and start talking about Exxon, but I think we forget the relative youth maybe of sort of American corporate history. We talk about corporate history, stock market history, and it seems like it's very long, but these are 100-year-old companies, and after 100 years, maybe that's kind of the time where what's the point of a company? It's to make a bunch of money and then return the money to shareholders over time. And we talked about this with Exxon, in this context. The whole point of Exxon is to exist to pay out a dividend to shareholders. That's what they've been buying for all of these years. And so I think it's interesting just to see a company at the end of its life cycle and what that looks like when it's in an industry that's in terminal decline. And I don't think any management brilliance at Exxon is right. It's really not going to change that future for the business.
No, definitely not. Well, if we're talking predictions, Miles, maybe we should broaden it out and talk about predictions for 2020 here. While we're talking about it, and as we kind of, as I said, ruminate or reflect on 2020 and look ahead to 2021, Brian Sozzi, as usual, has come prepared with bullet points in terms of his predictions. Hit us with them, Brian.
Brian, bullet point strikes again ahead of the new year. So I have 4 bullet points for you all. First, I will actually see Julie Hyman and Miles Udland in our office, big, beautiful studio again in 2021. And that would be the first time I would see either one of you in more than a year. Obviously, that would be post getting the vaccine in my right arm. Number 2, the 122 remaining Sears and Kmart stores, they will absolutely close in 2021. I have no idea how they're even open, but they will finally close and die a long sought after death. Number 3, Instacart will in fact IPO next year to, I think, a jaw-dropping valuation, which underscores how important they've become to many retailers. And last but not least, ex-President Donald Trump will in fact get a hole-in-one, and he will tweet in it. Why? Because he's going to be playing a lot more golf. That raises the potential for a nice big hole-in-one, guys.
Sozzi, that's a fun one. I like that one. I've thought about this. I'm definitely going to go left arm with the vaccine. I don't know why. Just I'm a righty, so I've gone left arm in my own mind. I've gone left arm already. Look, no one's going to remember this prediction, so it's fine. But I think the market's going to go up less than 5% next year. And I think the reason why is how the market tends to behave in years when earnings go up a lot. And we talked yesterday on the program about my chart of the year that sort of said, why has the stock market gone up? And it's because earnings expectations have gone up so much. But there's this piece of research from Bank of America. I have cited it 1.5 million times here on Yahoo Finance. Came out in 2018, and they said in half the years where the market is negative, market finishes the year down, and there's not too many through history. I think there's only about 30 years over market history where the S&P is negative. Earnings are up double digits more than half the time. And so the read-through is basically great earnings growth, which is what we expect next year, 22% to be exact, based on FactSet's latest estimates. It doesn't necessarily translate into great realized price return that year. So 5%-ish from here is about 3,900 on the S&P. Bank of America this year is about 38. 39 is the more conservative end of kind of where Wall Street has averaged out. So I always say stocks always go up, and stocks usually do go up. They go up over time. I expect that to be the case. But I think in a year where expectations are so high, it would make sense if perhaps there's a little bit of a pause.
It would make sense. A lot of different things would make sense, wouldn't they? I mean, here's where I come and say my annual, I don't do predictions. It's just, nope. I'm happy to listen to your predictions. I'm happy to listen to lots of people's predictions, but the stakes are such that I know I'm smart. I'm not smart enough to make wise predictions, unlike the well thought out argument that Miles just made. Maybe the one prediction I will make is that maybe I'll put on heels sometime in 2021, which is something that I haven't done in many, many months. But that is about as far as I'm willing to go. Guys, I will say, though, as we close out this year, it has been a pleasure spending the last couple of months with you since we began doing this 9 to 11 program, and with all of our viewers out there. Whew, it has been a tough one for many of us and many of you. Here's to peace, health, happiness in 2021. We're going to see all of you on Monday. On behalf of Miles, Brian, and myself, Happy New Year, everybody.
Happy New Year.
Welcome into Yahoo Finance Live, everybody. Happy New Year's Eve. Can't you just wait for this one to be over? I'm Zach Guzman alongside Akiko Fujita as we take a live look right now at the celebration underway in Beijing, where it is now officially 2021 over there. China, a lot to celebrate as we turn the calendar here on 2020. Stocks right now, when we look at the major indices here, a little bit less celebration here. Stocks trading mostly sideways. You can see the Dow there off by about 33 points. Still trading, though, near record highs. Even after we got the latest unemployment report, that showed a back-to-back weekly drop in jobless claims. We'll get to that report in just a moment. But first, down but not out. I want to spotlight the action we're seeing play out in airline stocks right now, limping across the finish line in 2020. You can see a lot of the majors there in the red to wrap up the year. But could 2021 be a snapback year for travel? We'll break that down and get top picks from one of our favorite airline analysts later on in the show. But first, to kick things off here, I want to highlight the hope of increased stimulus checks fading quickly for Americans as we look to wrap up those discussions here. Negotiations not making much headway, just days ahead of the congressional changing of the guard. And want to get to Yahoo Finance's Jessica Smith, who's been watching all that drama play out here in the Senate with the latest. Jess?
Yeah, Zach, Majority Leader Mitch McConnell has essentially ruled out $2,000 checks, at least in this Congress. He said yesterday on the Senate floor that he would not split up the three issues that President Trump has been pushing for. That would be $2,000 checks, a repeal of Section 230, and an election fraud commission. So that is not going to make it through the Congress in the next few days. Maybe eventually later they'll take up some of these issues, but it's not going to happen right now unless something drastic changes. Yesterday, we saw several Democrats try and bring up the $2,000 checks for a vote, but each time Majority Leader McConnell and other Senate Republicans would block that effort. They say if there is additional relief needed, it should be much more targeted. We saw quite the debate on the Senate floor yesterday. Let's watch.
The Senate's not going to be bullied into rushing out more borrowed money into the hands of Democrat rich friends who don't need the help.
We have a very unlikely ally in President Trump. Nobody here has disagreed with Trump more times than I have. And yet here is what the leader of the Republican Party says. He says $2,000 ASAP.
So it seems these $2,000 checks are likely dead, at least for now. But again, they could take it up again in the new year. President-elect Biden has said that he would like to see another round of stimulus checks, though he has not given an amount yet. So while this debate may be coming to an end here now, it's sure going to start again in the new year. Zach and Akiko.
So Jess, what kind of
Jessica
timeline
Smith.
are we looking at right now if we're talking about the $600, which ultimately sounds like that's kind of where things are headed in terms of those payments out to Americans?
Well, they've already started going out to Americans. They started earlier this week. I know paper checks were going to be sent out in the past couple of days. Some people have already gotten those checks, so they are already out the door, those $600 checks. So watch your bank account for those.
Yeah, it's something that a lot of people are obviously keeping their eyes peeled for. Jessica Smith out in Washington, D.C., appreciate you bringing us that. I want to turn over to the numbers we got on the unemployment front. Of course, the last update we'll get here in 2020. And for the second straight week in a row, initial jobless claims fell, declining by 19,000 in the latest print to 787,000. That was below what economists had been expecting at expectations for 835,000 claims. And for more on that, I want to bring in Yahoo Finance's Emily McCormick to dig a bit deeper into that report. And Emily, I mean, we focus so much on those initial claims, but also continuing claims and other pandemic assistance programs also worth spotlighting.
That's right, Zach. And we did see a surprise improvement in jobless claims, both those new jobless claims as well as those continuing claims. So you went through those new weekly unemployment claims, but taking a look at the continuing claims for the week ended December 19th, those coming in at 5.2 million. That was better than the almost 5.4 million that had been expected and 5.3 million from the previous week. Now, one other thing that I want to note on the initial claims side, those again coming in at 787,000. We should note that the 4-week moving average for new claims was still upwardly revised by more than 17,000 to nearly 837,000. And that was due to the upward revision that we saw for the previous week, as well as the elevated claims that we saw for much of December. Because remember that this past week's new jobless claims was the first time that we saw those actually break below the 800,000 level since November. Now, on the other hand, it is worth noting that this week's jobless claims report did not yet include any impact from the newly authorized provisions included in Congress's $900 billion stimulus package. So in other words, there was still some improvement even before that new stimulus rolls out. But going forward, we could see some additional improvement here as a result of these new measures, those augmented weekly unemployment benefits, as well as especially the increase or the replenishment of loans in the Paycheck Protection Program. So that might actually allow some of these small businesses especially to keep their workforces employed even amid the ongoing pandemic. Now, one other data point that I really want to highlight here from this morning's report was that the number of Americans claiming benefits through pandemic unemployment assistance and the pandemic emergency unemployment compensation programs actually declined. It came in at about 13 million. We saw that at about 14 million in the previous week's data, but it is still comprising the majority of the nearly or just over 19 million Americans that we have claiming benefits across all programs. Now, with Congress's new stimulus package, we will see these federal crisis era programs continue at least through March. So we are having, again, that additional lifeline here for the millions of unemployed Americans. Zach and Akiko.
Yeah, Emily, I mean, you talk about the average number of Americans filing for that 1.45 million a week this year. That's compared to 220,000 in 2019. And we didn't see that number top 700,000 even during the Great Recession, which is kind of a staggering number to look back on for this year. But that is the effect, I guess, of what we've gone through in 2020. Emily McCormick, appreciate you bringing us that. Let's dig into that a little bit more here and talking about what's been done on the stimulus front to counteract all of this and exactly what we were just talking about in terms of the unemployment numbers we've been discussing here with our markets guest today. Rick Edelman is the founder of Edelman Financial Engines, and he joins us once again. Rick, Happy New Year. Good to be talking with you. First off, I guess we'll just talk about what you saw play out in that latest round of stimulus. The discussions right now, as Jess highlighted, seemingly not going to get to that $2,000 number for checks. But what do you make of what's been done so far, and what more could be done when Joe Biden steps into the office?
Well, clearly, the amount of stimulus being provided to the lower band on that K is been way too late in coming, and it's not as much as what people need. We are in a tale of two cities this year, as we've all seen, the so-called K recovery. Those who are doing well are doing better, and those doing poorly are doing worse. And those who are doing worse needed more money. They needed it faster. And so the amount of money they're currently getting isn't going to be enough to really solve their problem. But there are concerns about the fact that as a result, you're likely going to see more stimulus coming from Washington. It largely is going to depend on what happens in the Georgia Senate races, because the Democrats clearly want to provide dramatically more stimulus than the Republicans. Will the Senate agree? And it depends who's controlling the Senate, so we'll have to wait and see.
No question, all eyes are going to be on Georgia come next week because of those Senate races. But Rick, you talked about how this $600 that were included in direct payments in this most latest stimulus bill certainly isn't going to be enough for those who are experiencing the most pain. Come January, if the Senate is not tipped and those $2,000 that's being discussed right now do not come, then how significant is the downside right now if you look at the overall picture?
Well, it's likely that, as everybody is telling us from the medical community as well as economic sectors, that the economy is going to get worse before it gets better. We're going to see an increase in infections, hospitalizations, and death rates over the next 2 months. We're going to see continued sluggishness in the economy as a result of all of that. And it could get a lot worse if there are going to be more lockdowns imposed by governors across the country. So this could get a lot worse before it gets better. But investors have been looking toward the other side of all of that. That's why the market has done so well since March. Investors are saying, we'll get through this. Once the vaccine is widely distributed and everybody's injected and we become inoculated, this too shall pass. And investors are putting all this middle ground environment, they're putting it to the side, saying it really doesn't matter. And that's why there's been such a big disconnect between the economy and the stock market. So the real question is going to be, what's going to happen next? Will corporate profits rise to match stock market expectations, or will there be a correction where stock prices have to come down to be consistent with where corporate profits are? That's the big question that has yet to be answered. And it's going to be a very interesting series of a couple of months to find out which way it's going to go.
Yeah, Rick, we've had a few guests come on here. Tom Lee talking about potentially a correction that we could see in the first half of next year. A few others mentioning the same thing there. It's tricky, I guess, to maybe pinpoint a catalyst, but it seems like the expectation has long been that those two Georgia runoffs are going to go the way, or at least one of them will go the way of the Republicans, giving them control of that chamber. So, I mean, is that maybe something that could trigger the correction you're talking about, or is it just maybe the delay in rolling out the vaccines that would be enough for investors to say, look, this isn't going as well as it should be if we're pricing things to perfection?
It could be either of those things, Zach. It could also be that this new version of the virus proves to be uncooperative regarding the vaccine, and that the virus is going to become worse or last longer, increasing infection rates and hospitalization rates, putting further pressure on the travel and hospitality industries and higher education, the state and local government budgets. The list goes on and on and on. Social Security is being impacted negatively, as is the Disability Trust Fund. So it wouldn't take much. It's a fragile recovery. The stock market has been pricing in all the good news and seemingly discounted all the potential bad news, the black swans that could occur. So it could be a natural disaster, a terrorist act, aggression regarding China or Russia, something in the Middle East. I mean, who knows what it might be that could alter investor sentiment, let alone just the mere notion of profit taking. So who knows what the trigger might be? There might not be a trigger. Any trigger might be short-lived. You might get a 20% correction followed by another market increase like we saw from March to May. So it's hard to say what's going to happen or when, but we do need to recognize that it's not nearly as good as those on the upside of the K argue, and it is worse for those who are on the bottom side of the K, and those two are going to have to ultimately get reconciled.
Yeah, I mean, when you talk about a black swan event, 2020 has taught us that we just can't see any of those coming, right? When you think about what the conversation was a year ago, nobody had a pandemic on the list of top risks. I want to go back to what Zach mentioned, though, about the slower vaccine rollout than anticipated. We're now looking at not being able to meet that 20 million that was initially expected, at least in this year. There was always a learning curve that was expected in this, but I'm wondering if the latest data around the vaccine rollout has changed your base case in any way. This expectation of the second half being a huge bump because all activity is going to resume. Is that still the case, or do you think that needs to be tweaked a little?
I think we need to temper our enthusiasm. It is an incredibly difficult logistic challenge to inoculate 320 million people here in the United States, and that's just the US. It has to happen around the world as well if we're going to resume global commerce the way that we had prior to the pandemic. So it's a logistic nightmare. And to suggest that we are going to be able to inoculate a third of Americans in 90 days, which is what President-elect Biden says he wants to do, that's a wonderful goal, and I think we all agree that we're hopeful he'll achieve it, but that is one heck of a challenge. And it's ignoring the notion that many Americans, a third, say still they will refuse to be inoculated. So what is going to happen? Are employers going to require that workers be vaccinated before they're allowed back to work? Is the government going to require vaccination before you're allowed to go into public? The way you currently have to have a driver's license to drive a car, or a hunting license to hunt, or a dog license to have a dog. Will the government require a license and evidence that you've been inoculated? And what will be the consumer reaction to that? So it's going to be much more difficult than I think many people are anticipating, and difficulty translates into delay. And will the markets tolerate the delay to the economic recovery that the market has priced in already?
Yeah, it could suggest more of a bumpy road, at least in Q1. Rick Edelman, the founder of Edelman Financial Engines. It's been great to have you on throughout the year. Wishing you a happy new year, and of course, hope to have you back on the show again soon. We are off for a quick break, but coming up, we are going to be turning our attention to the coronavirus, with a number of patients hospitalized from the virus reaching a grim milestone. This coming as health officials report yet another case of that more infectious variant of the virus, this time in California. We'll be right back. More than 220,000 new cases of the coronavirus reported here in the U.S. on Wednesday, with hospitalizations hitting a new record of 125,000 patients. Meanwhile, health officials here in California are reporting that highly infectious UK variant of the virus has now been detected in the state. Let's bring in Dr. Anand Swaminathan. He is an emergency medicine physician in New Jersey. Doctor, it's good to talk to you today. This month has just really been a brutal one from ICUs across the country. As we count down to the new year, give me a pulse check of what you are seeing on the ground there and whether things have leveled off from the highs we saw earlier in the month.
The numbers have been so high that I think we lose sight of what these numbers actually mean. 125,000 is a lot of hospitalizations, but when we're looking across the country, when I talk to my colleagues in other places, I hear the same thing over and over again. The hospital's full. We're at 140% capacity. We've turned the gift shop, the chapel into spaces for patients because we don't have anywhere else to put patients. I've talked to a number of people at large hospitals, county hospital systems, where they're running out of oxygen, they're running out of face masks, they're running out of infusion pumps. And none of this even is talking about the number of healthcare workers that we're losing as well, because they're falling ill and they're having to stay home. And that really compromises how we take care of patients. We've been really lauding the fact that our mortality rate from coronavirus is low. It's around 1 or 2%, but that's going to change. We're going to see that shift in the next 2 months, because as nurses get strapped, as they are, instead of taking care of 2 patients for an ICU nurse or 6 or 7 patients for a floor nurse, they're going to be taking care of 5 patients in the ICU. They're going to be taking care of 10 patients on the floors, 10 patients per nurse in the emergency department. And that compromises the good supportive care that those patients need. So we're going to see mortality spike as we see hospitalization spike. And I know that a lot of experts have been saying it. It's been rough the last month. The next 2 months are going to be worse, especially when we see what happens with the recent holidays and how that causes surges across the country. And the hospital system, it's already bent as much as it can. And I fear that the hospital system is going to break under the weight of all of these cases.
And doctor, I suppose it's worth stressing too, that was the expectation even before we saw the discovery of this new strain that's supposedly 71% more spreadable. And we talk about cases in Colorado and California, but those are the documented cases. In the Colorado case, that man had not traveled. So, I mean, you think about how this may have already spread around the U.S. and the CDC warning that new strain will stress hospital staff even further. I mean, what does that say? Because obviously you can't lock down 71% more than what you're already doing, what we're seeing in place in California. So how does that maybe add to the risks now?
This variant has probably been around for a while. It's probably been around for a couple of months in the US. We haven't done a very good job of sequencing and tracking these variants. Now we're trying to, and that's why we're finding a couple of cases, but it's probably been around for a little while. And we can do more. That's the honest truth. The way to stop this variant from spreading is the same way to stop COVID from spreading in general, which is good public health measures. It means that everybody has to wear a mask. We have to be physically distancing. We have to be hand washing. We have to avoid gatherings, and not just large indoor gatherings, not just large outdoor gatherings, but small indoor gatherings. The living room spread, this is the new super spreader. One person in a small group indoors that gets this can spread it to a lot of other people. And what we see with the numbers going up with this variant, whichever variant it is that we have to place personal freedom behind personal responsibility. Personal freedom is great to talk about, but it has to come with personal responsibility. We have to understand that one person gets this can spread it to a lot of other people. We are very interconnected, and it means that everybody has to do their part. So I actually think we can ratchet up those public health measures more. And in addition to that, when it's your turn to get the vaccine, we need to make sure that we do that too.
And doctor, you expressed concerns about doctors falling ill, doctors and nurses. Of course, healthcare workers were at the front of the line on the vaccine, but we've heard reports from across the country about vaccines going unused, not being stored properly in, for example, senior care centers. A lot of workers not wanting to get the vaccine as well. What's been your experience with that? And what specifically do you think is the biggest hurdle, at least in this first phase, in getting those who need the vaccine inoculated?
It was really heartwarming to see in my hospital when the vaccine was released. We had lines wrapping around the hospital, healthcare workers waiting to get these. And we should be seeing the same thing across the country. The problem is that we have lost a lot of our faith and our trust in our healthcare professionals and our leadership. And we need to resume that or regenerate that trust in the FDA, the CDC, in medical experts. From what we know, the best evidence tells us these vaccines are extremely safe. Yes, there are going to be some side effects, but the vast majority of them are very minor. There are very few really severe adverse events. And so it's important for healthcare workers to model that behavior of we trust the experts, we believe in this vaccine, and to go and get it. But I think the hurdles are the amount of misinformation that's out there. So what I really want to stress to people is to make sure that you're getting your information from reliable resources. And the next administration is going to have a big uphill battle in regenerating that trust in the FDA and in the CDC and in the medical health professionals. So we have to get out there and spread the same message over and over again. I got vaccinated. I'm actually up for my second vaccine next week. So the second in that two-part series with the Pfizer vaccine. And I had really no side effects at all. I went to work the next day, and that's what we need to be talking about. The vast majority of us are completely fine getting the vaccine. We're out in front, and it gives us the security that we can go to work, we can be a little bit more protected. It doesn't change the amount of PPE that we are using because we're still trying to protect each other and our patients, but then we can be there to take care of our patients.
It's an important point to stress, and I know it's been a stressful year for all of you in the medical community. Appreciate you taking the time to chat with us today and bringing us that. Dr. Anand Swaminathan, thanks again and Happy New Year.
Thank you, guys.
We're going to take another quick break here on Yahoo Finance Live, but when we return, discussing the 2021 outlook for a hard-hit sector through the pandemic, the airlines. Will break down one analyst's top picks right after this. Welcome back to Yahoo Finance Live. 2020 was obviously a brutal year for airlines and airline employees, with daily passenger traffic here in the U.S. still off by about 50% versus last year's levels. But many are hoping 2021 can bring a sharp rebound in travel due to pent-up demand for getaways. So if that's the case, which airline should investors be betting on? Here to answer all of that for us is Cowen Senior Research Analyst Helene Becker. Good to be chatting with you again, Helene. Let's start by putting it all into context here, though, shall we? I mean, when we talk about North American airlines, profits forecasted to be down nearly $46 billion in 2020. That's the end number here this year, according to the International Air Transport Association. Next year, they're saying that that's going to drop to a decrease of $11 billion. So if that's going to happen, what kind of rebound in travel would you expect to see? And is that perhaps a bit too optimistic?
Well, Thanks for having me again on the show, Zach. It's nice to see you. I think that we're going to see a 40 to 50% decline in traffic in 2021. In fact, if you think about the numbers that we're seeing come through TSA over the last week and a half, it's actually about 1.1 a day. That's probably pretty close to 95% of leisure traffic, and where it should be on a normal year or normal day. What we're missing is business traffic, which is still down 85 to 90%, and international, which is down 90 to 95%. The only people that seem to be traveling internationally are the people who need to travel. We're really, and especially now with the second strain of the virus, we're seeing borders close again. This is just going to, the longer it takes us to get out of this, the longer the recovery.
And the key question, of course, is who's best positioned to ride out at least a bit more of this downturn over the next few quarters or so. Delta Airlines, one that we've heard a number of our guests mention, but you've also got American Airlines outperform rating there. I'm curious what the thesis is behind that. And ultimately, as an investor, how do you sort of decipher these airlines when the overall sector is still facing a very much uphill battle?
Yes, very good. Those are very good questions, and I spend my life thinking about it. So here's how I think about American. It's our contrarian idea. Our best idea for 2021 is Southwest Airlines. It's got a strong balance sheet. It's got a great management team. They're not going to have to furlough people. They're growing in an environment where the rest of the industry is not. And so that would be our top pick. But it's becoming a crowded trade. And then when you think about American, here's our thought there. First of all, they were very quick to reach an agreement with their pilots on furloughs and early retirements so that they can put themselves in a position to win the recovery. The idea is to try to keep as many pilots on staff as possible so that when things do improve, they can, no pun intended, but take off again. One of the things to think about, especially with pilots, is it takes about a year to bring them back from a furlough. So the idea is to try to keep as many as possible on staff. And then second, you've got a lot of pilots between the ages of 62 and 65 that are intending to retire over the next couple of years. And the idea for American was to bring those forward. So they did a lot of that in an effort to keep more junior pilots. So as a result, while the absolute wage rates are likely to go up over the next few years, the average should come down because the percentage of people that are with the company less than 10 years will exceed the percentage of people with the company more. And then the third thing to think about is the balance sheet. Now, it's one of the more stressed balance sheets. We've heard every one of your guests who've been on talking about airlines talk about the balance sheet. But, the thing to think about is they don't have any debt due until June of 2022. They've already paid back their 364-day loan that would have been due in March. They've got the money from the government that will get them through 2021. And they're already seeing recovery in some of their markets. They're seeing load factors that are kind of in the 60-65% range. In some cases over the past week and a half, it's been 85%. So that's put them in a position where they're actually cash flow break even. Obviously not for the whole quarter, but we're getting, I think mid of 2021, they should be there.
So, it sounds like Southwest top pick, American another one to consider here. When we talk about the added benefit of another $15 billion in funding in the latest package that came through here, of course, that's on top of what you were talking about there in the CARES Act. But one of the headwinds that I think a few people have been raising is the idea of restricted travel, or maybe this idea of travel passports for people who have been vaccinated. Our doctor guest today was just talking about how many Americans might not want to actually get vaccinated. Is that something that you're seeing as a possibility among the airlines, maybe weighing the idea of checking before people could fly again, or what are some of those other headwinds that you might see play out?
Yeah, I think that's a good point. People are uncomfortable, sharing that kind of information. But on the other hand, I would say we got used to taking our shoes off. We got used to metal detectors. We got used to taking our belts off, our coats off, our toiletries out of the bag. This is just another thing we might have to get used to doing if we want to travel freely. And we should want to take the vaccine. The people who are taking it have proven that so far that it seems to be safe. I heard the doctor speak about how he had no side effects. I can't wait to get mine. But Zach, it's no different than any other flu vaccine. I mean, obviously it is different, but it's not different from an annual flu vaccine when only 40% of the people take that. So the idea that a lot of people would be reluctant to take this vaccine is not surprising, but that may be what needs to happen in an effort for people to get back to what I would call, normal life, although I suppose this is our new normal for a while. I'm sorry?
I was going to say that the new normal is probably a more accurate description. No question, even when we start flying again, things are going to be a little different than they were pre-pandemic. Helene, it's good to talk to you today. Helene Becker, Senior Research Analyst at Cowen. Thanks so much for your time.
Thank you. Thanks for having me.
Coming up, Tesla soaring into the new year, hitting a new high in the session. Jared Blickery is going to walk us through the latest market action on the other side of the break. Welcome back to Yahoo Finance Live. Shares of Tesla hitting a new high in this session, topping that $700 level for just the second time. Jared Blickery is tracking that for us. And Jared, second time, first time since that stock split in the fall. What's the big catalyst today?
The big catalyst, I think, is just kind of year-end euphoria. Money has to find a place to go, and people want to be in the right stock. So sometimes you see stocks playing catch-up, and sometimes you see the winners just taking in more money. I think that's what we're seeing today. And it was only yesterday that Tesla made a record high, eclipsing that prior high when it joined the S&P 500 a few weeks ago. Some people were worried that Tesla was going to be top-ticked by that inclusion. And when you said topping $700 per share for the second time, that's right, because it was only in February that it topped 700 for the first time. And that was before its 5-for-1 adjusted split. So that was about $140 somewhere in there. And you can see what's happened since then, leading the NASDAQ up 757% year to date. It's probably one of the biggest stories of the year. And in fact, if we put this heat map on a year-to-date basis, we can see Apple. Now, I have Apple included in electric vehicles because it's purportedly getting back into that play. It's up 80%. But some of the big winners here, you check out NIO, the Chinese EV play, that's up over 1,100%. And QuantumScape, that battery play, that's up 787%. And it goes on. So just a lot of strength in this particular area. Kiko.
Yeah, we've seen huge gains in the EV space as a whole in anticipation of further growth going into the new year. Jared, thanks so much for that. Well, all this week, we have been looking back on some of our key conversations with top executives throughout the year. Today, we're looking back at a discussion with Land O'Lakes CEO Beth Ford, talking about what the company and its farmers face in the coming year and the difficulties they've had to face as a result of the coronavirus. Take a listen.
Farming is an outdoor sport, so it can be too hot, too cold, too wet, too dry. You can be a brilliant farmer, you can still have issues. Well, how are they feeling right now? The pandemic did exacerbate supply chain backup. So I mentioned what happens with food service. Oftentimes, producers, farmers, dairy on the dairy side ship to food service restaurants, processors who make products for food service. Schools have been shut down. So you lost basically 15, 20% plus of the market for distribution. You saw backup in meat processing, right? Hogs, cattle. And so what happened was that there was an immediate drop in collapse in commodity prices. As well, there wasn't a lot of international trade because a lot of things were staying here in the United States, especially early in the pandemic. And exports are crucial to profitability for farmers. For instance, on dairy, 1 day out of 7 of production is exported in variety of products. So this was really causing pressure at the farm gate in terms of pricing. Now, how are they feeling right now? Well, we've made it past this particular, the peak point of the pressure. The administration and the Senate and the House did provide funding for farmers, interim payments to make up for this gap. Many will make it to the other side. We're going to see what happens with this next few challenging months, depending on what happens with the pandemic. I have seen grain pricing, so row crop farmers, so beans and corn, have started to strengthen. Bean price up over 10, 20, 10, 30. Corn price, I saw a 4 number in front of it. And so that's stronger performance for those crops. Those are core crops. And so that's a positive. That's a positive. I'm seeing a little bit more momentum, a little bit stronger performance. For dairy, the food box program that is providing food for underserved communities and for the food insecure has elevated milk price a bit at farm gate, so we're not seeing the same level of bankruptcies at the dairy farm level. So they're feeling a little bit, it's not stable. Let's not say that, and we're in this stable environment, but there are more positive signs than there have been for the last couple of years, especially. Trade has started to pick up in China. We're seeing a lot of shipments, especially for soybeans, for hogs, et cetera, into China.
Are you looking for any more aid to come from the government? We're still waiting for this next stimulus deal to materialize, and when it does, are you hopeful, or do you have reason to believe that there will be some aid in there for our country's farmers?
Well, the administration and I think the House and Senate reallocated some funding to a funding area that it provides funding or support to farmers. As well, support programs or insurance programs will be critical. So the farmer has to sign up for insurance, and same thing from the dairy for the dairy side. So are we looking for support? Well, we're going to see. I mentioned the food box program. Actually, funding had run out for that food box program, but it looks like they're re-upping for maybe another $1 billion is what we're hearing. Do I expect we're going to see something? Well, we all don't know what's going to happen in that round 4. My government affairs team, and certainly we are connected through our government affairs team into both the administration, the House, and the Senate to get a view and then advocate appropriately for some level of gap payments for farmers as we move through this pandemic.
Something that farmers have had to deal with even pre-pandemic has been access to connectivity and to the internet, and the pandemic has really just exacerbated that need. I know that you are a huge proponent for internet access in rural areas. You've backed legislation regarding this. Where do things stand right now, and what else can the public and private sector do and come together to help aid the farmers?
Thank you for phrasing it that way. This is about coming together. 18 million plus Americans lack access to broadband. The majority of them are in rural communities. 1 in 4 farmers or rural community citizens lack access to broadband. This has exacerbated, or this has highlighted this digital divide that we have. You know, oftentimes on a farm, the teachers are having to drive out with this paper homework so these kids can do homework because you don't have enough technology on the farm, or you got to run farm equipment. I mean, it's really unacceptable. And this isn't a rural issue. This is an American issue. Food security is a national security issue. We see this front and center, right? We all see this. We're working from home. We're connecting with doctors from home. And there's a shortage of 40,000 doctors in rural America. There's a lack of hospitals, and now we see COVID coming into these areas. So what are we doing? We are advocating. We've started a coalition called the American Connection Project. We've got over 120 other companies, Microsoft, Cargill, Polaris Tractor Supply, any number of company partners who also see this as a need. We must fix this, this lack of access to broadband. It needs to be like a 1930s rural electric initiative going across the country.
There you go, Land O'Lakes CEO Beth Ford there talking about the problems in the farming sector. We're going to take a quick break here on Yahoo Finance Live, but when we return, breaking down the worst blunders in the PR space here on the part of companies in 2020, as well as those companies that navigated things to perfection. Stay with us. Welcome back to Yahoo Finance Live. We're taking a look back here on 2020, including the way that many companies navigated some controversies. It's not always easy to do, but sometimes some companies do a little bit better of a job at doing that than others. And here to break all that down for us is Jim Haggerty, the CEO and president of Haggerty here. And Jim, when we look at it, you know, it's tricky to navigate some of these things, but one of the companies you listed on your worst handling PR disasters of 2020 would be Yahoo Finance's worst company of the year, and Nikola. Talk to me about what you saw play out this year and maybe some of the mistakes you saw that other companies should be avoiding.
Well, it was a mess what Nikola did from beginning to end. I mean, from the truck rolling downhill to the misleading statements that they made along the way. And what they did is whenever you see a company in crisis, you can tell the ones that don't have their act together when they issue a statement to clarify the prior statement. And that's exactly what happened in that case. They issued a statement short statement saying they're investigating and they will respond. And then they issued a 2,200-word statement that put everyone to sleep to try to justify what was going on. And again, you have to respond quickly, but you have to respond with thought and empathy in those situations. But I suspect the facts were so poor in that case that there wasn't a whole lot they could have done. But they certainly made it worse by the way they responded.
Well, and we saw the stock take a huge dip on the back of those reports that came out. Let's talk about the positives here. You've highlighted the NBA and its handling of Black Lives Matter, but also Epic Games, the company, of course, leading the way in going after Apple and Google for their app fee stores. I'm curious, as you look at what you deem to be a PR success, how do you ultimately measure that? Because the way people view it obviously varies pretty widely.
Yeah. Well, we actually have a proprietary software called Crisis Response Program. We collect statements all year that companies have issued in response to various crises. Then we sit down and go through them and analyze them and come up with the best and the worst. And what was fascinating about the Epic Games situation is if you looked at what they did in rolling out the announcement of the lawsuit that they undertook, was the amazing planning that went on. A lot of times, the lawsuit comes first and then they figure out what they're going to say. But Epic Games did everything from being everywhere in the media with their message, very tight messages, and including creating a video that mimicked the famous Apple 1984 video as part of their lawsuit announcement. So it really was a home run.
Yeah, I mean, I don't want to harp on the negativity here in 2020 as we look ahead to 2021, but on your list of good performers here alongside Epic Games, which again kind of timed the pressure on Apple pretty geniusly there. But when you look at Airbnb, that's another one of the standouts there. And you think about how tricky it is to navigate a company to an IPO, but doing so along with the people on the platform, really bringing them along for that ride, ensuring that things were going to be fine in the pandemic. What'd you see from them that made you add them to the list?
Well, that's exactly the point. They shared what they were going to do in a very human, responsible way. I think the CEO of Airbnb at one point said he had to make 10 years of decisions in 10 weeks. And it was that human. Often in a crisis, there will be a lawyer-like response, likely controlled by lawyers, where they won't say anything at all. They'll say, we're looking at the situation, we'll get back to you when we have more information. In this case, they were human. They made their customers and the other stakeholders part of the response by bringing them in each step of the way. And in that way, I think they really saved themselves in what could have been the most difficult situation any company has ever faced.
Yeah, I mean, important to note that they made some painful decisions along the way, Jim, laying off roughly a quarter of its staff. But of course, all of this ending with what is considered to be a pretty successful IPO this month. Jim Haggerty, with Haggerty CEO and President, good to talk to you today. Thanks so much for your time.
Yeah, speaking with you. Thank you.
Coming up, Jack Ma facing the heat. What Chinese regulators are now proposing as Ant Group looks to get back in the good graces of Chinese authorities. Plus, an App Store purge at Apple. What led to the biggest removal in a single day? We're going to discuss on the other side. Welcome back to Yahoo Finance Live. Stocks trading pretty flat right now as we count down to 2021. All three majors dipping just lightly in the red there. A number of headlines coming out of China leading to some big stock moves. And we're going to start with Alibaba here because that share is down more than 2% on the back of reports that Chinese regulators are looking to force Ant Group to divest equity investments in some of their financial companies. This one coming from Bloomberg. Let's bring in Inez Ferre, who has been following that for us. Inez, it's been kind of this drip of bad news for all of Jack Ma's assets really over the last few weeks. What's the very latest here on Ant Group?
Completely. And Ant Group is a fintech giant. It's an affiliate of Alibaba, and Chinese regulators are now considering whether to order the company Ant Group to divest some of its investments, as you said. And this would really scale back the company's influence when it comes to the fintech industry. Now, the company, you'll remember, was going to list in November. It was going to do a dual listing. That listing suddenly was suspended, and that happened after founder Jack Ma, in a speech, criticized bank regulators. This really, as you mentioned, really highlights the Chinese regulators, their greater antitrust scrutiny with Alibaba. And this is really the latest move, this one being on the affiliate, being on Ant Group. Now, as far as divesting its holdings, this would primarily be in technology and fintech companies on, of course, anti-competitive grounds. Now, Ant Group has stakes in Indian payment companies and an Indian payment company called ATM, also a Chinese state bank. And the giant has 81 equity investments overall worth $21.6 billion. So this would certainly be a big change. And of course, again, regulators really coming down on Alibaba, on Ant Group, and as you mentioned, on Jack Ma's holdings as well, Akiko.
Yeah, I mean, regulation seems to be the theme here in China right now. I mean, you look at Apple not to be removed from this discussion here, having to remove game apps in its China store and having publishers acquire a license. I mean, that seems to be the pressure point right now in China, no, Inez?
Yeah, it is. And you have Apple that has now removed 39,000 unlicensed games from its China store. Today was really the year-end deadline for those publishers to have a license. And those publishers that don't have a license had to be removed from the App Store. Also, certain apps without licenses were also removed. So these unlicensed games, these unlicensed apps being removed because of these Chinese regulations as well.
Yeah, and as it's been interesting, at least going back to the Ant Group story here, to see how some of the bigger tech names have traded alongside the headlines that have come out on some of Jack Ma's assets, because the initial thought was potentially the government would try to crack down on some of the big bat names too, like a Tencent. But it seems like increasingly the focus is on Alibaba, Jack Ma, and the Ant Group as it looks to try and revive that $35 billion IPO you talked about getting halted earlier this year.
Yeah, that was going to be a massive IPO. It was one that was going to be a dual listing. It was very highly anticipated. And it was a big shock when it was suspended suddenly. But then we saw reports afterwards of that speech of Jack Ma, basically talking about bank regulators acting sort of like a pawn shop. That did not sit well with Chinese regulators at all. And you can really see sort of like the power of regulators in China that they have over these companies. And certainly Jack Ma's speech did not help at all. In fact, many saw it as a hindrance and as one of the reasons why that IPO was suspended suddenly.
Yeah, those comments, of course, coming at a time when the Chinese government was already a little uneasy about the scale and scope of the Ant Group. So much more to be expected on that front. We're going to take a quick break here on Yahoo Finance Live. Much more to come. We'll be right back. Welcome to the noon Eastern hour of Yahoo Finance Live. I'm Akiko Fujita along with Zach Guzman on this New Year's Eve. We want to take a live look here overseas in Thailand, over in Bangkok, already ringing in the new year. We've got 12 hours to go, at least on the East Coast here in the US. But Zach, no question, a lot of people eager to put this year behind us. Let's take a look at where the markets are trading right now, though, as we count down to that new year. It's pretty flat right now. A lot of people probably already looking into their plans, probably staying at home. Wall Street wrapping up a wild year for stocks, and right now communication services and financials really the only sectors seeing meaningful gains. Signs of improvement in the labor market. Weekly jobless claims falling in the holiday week as millions of Americans await those new unemployment benefits from the latest stimulus package. And the UK officially exiting the European Union as the Brexit transition period comes to an end. We're going to discuss the implications for trade with the UK Trade Commissioner for North America, Anthony Phillipson, joining us later in the show. But we begin this hour yet again with the very latest on stimulus discussions. Hope fading quickly for a bump in those stimulus payments for millions of Americans. Jessica Smith is tracking the very latest on that front for us. And Jess, $2,000 looks like a no-go. The focus here, at least for Republicans, is much more targeted relief.
Exactly. And Majority Leader Mitch McConnell really essentially ruled out $2,000 checks yesterday by saying that he would not split up President Trump's three priorities. That would be the $2,000 stimulus checks, repeal of Section 230, and establishing an election fraud commission. All of that is not going to make it through Congress in the next few days before the new Congress starts. So really, the chances of $2,000 checks are very, very slim at this point. And yesterday, McConnell and Republican senators multiple times blocked efforts by Democrats to take up the issue of the $2,000 checks, to just vote on the bill. They repeatedly said no, and it really turned into quite the debate on the Senate floor. Let's watch.
What is your problem with members of the United States Senate, including a number of Republicans who have already indicated they would like to vote for this? What's your problem with bringing that up as a single standalone bill, not merged with corporate liability or anything else? What's your problem with that?
I would say to our colleague from Vermont, this money is not targeted to people who suffered financial losses. It is not targeted to people who suffered financial losses.
So while it looks like the $2,000 checks are probably dead for this Congress, this will likely come up again in the new year when the new Congress comes into Washington. President-elect Biden has said that he wants to do another stimulus check for Americans, though he hasn't said exactly how much he'd like to see yet. So this debate is not going anywhere. And the Senate is getting ready to convene here any moment now. They're set to continue debating overriding President Trump's veto of the annual defense policy bill. We will see if there are any more debates about the $2,000 checks, and we'll be sure to keep you updated if that comes up throughout the day.
And of course, Jess, all of this happening as we look ahead to next week with those Senate races in Georgia. That's really going to be key to shaping the policy, especially on stimulus moving forward. Thanks so much for that. Let's move on here to take a look at some of the economic data we got out this morning. Weekly initial claims for jobless benefits declining 19,000 to 787,000 last week. That marked a second consecutive week of declines. Let's bring in Emily McCormick, who is breaking down those numbers for us. And Emily, I guess the argument is that a decline is good news, but we are talking about a holiday week and potentially more pain ahead in the weeks to come.
That's right, Akiko. The last major economic data report of 2020 was an upside surprise. Of course, we did see those headline new jobless claims coming in below expectations, or lower than expected, I should say, which was a market improvement given that over the course of December, we'd seen those new weekly claims come in above the 800,000 level. So now finally getting that breaking below that elevated level. So more specifically, those initial jobless claims coming in at 787,000 800,000, below expectations for 835,000, as well as coming in below that revised 806,000 that we saw during the prior week. But we should note that at 787,000, that sum is still well above the pre-pandemic weekly average of 200,000 new jobless claims. We should also note that the 4-week moving average for new claims was upwardly revised by more than 17,000 to nearly 837,000 because of last week's upward revision, as well as the elevated claims that we saw throughout the course of the past 4 weeks. Now, I also want to highlight that we saw an unexpected improvement as well on the continuing claims side, those coming in at 5.2 million, better than the almost 5.4 million that had been expected, as well as the 5.3 million from the previous week. But to your point, Akiko, it really is going to be a question of whether that momentum can actually continue into the new year, especially given some of the difficulty with adjusting for seasonality factors. But to that point, it is encouraging to see these improvements here on those initial and continuing claims, even in absence of the rollout of new provisions authorized under Congress's $900 billion stimulus package. That, of course, should start to provide another line of support here for the labor market as we head into the new year, especially when we think about those loans provided through the Paycheck Protection Program. So that might actually help many of these small businesses actually keep their workforces employed, even given the ongoing pandemic. Now, the final thing I'll note is that we did see the number of claimants under the Pandemic Unemployment Assistance and Pandemic Emergency Unemployment Compensation Programs actually decline last week to 13 million. That's still comprising the bulk of the 19 million overall individuals that we see claiming benefits through all programs. But again, with Congress's new stimulus package, those individuals will be able to continue remaining on these programs at least through March. So with the stimulus, we will see some additional support here for the labor market into 2021. Akiko and Zach.
Yeah, you talk about the Paycheck Protection Program. A lot of small businesses waiting on that, especially with these winter months expected to be the toughest for them. Thanks so much for that, Emily. Let's bring in our first guest for the hour. We've got Eric Ditton. He is president and managing director of the Wealth Alliance. Eric, it's good to have you on this New Year's Eve. As Emily highlighted there, the news, at least within the last week here, is good on the employment fronts, but we're also coming on the back of some disappointing economic news where we saw household spending decline, household income falling as well. How are you processing all of that going into the new year?
Well, first off, thanks for having me, Akiko. To understand where the markets are and going forward to 2021, you first need to understand what happened in 2020, right? And we all know what happened. We had a pandemic. We had a massive stimulus. The Fed and the Federal Reserve both basically came out and told the markets, we are going to do whatever it takes, right? The result was a bifurcation of the markets. Who's going to win in a pandemic? Who's going to lose? Who won? Big tech, right? Big tech was able to continue to grow their earnings in a pandemic. The Pelotons of the world, the Zooms of the world, they could grow their earnings. Value stocks, companies tied to the economy, the banks, energy, they could not, okay? It stands to reason that we are now seeing a proliferation of a vaccine. We are seeing a recovery. It's going to be choppy. It's not going to be quick, but it's happening. And that means that the laggards, those value stocks, those dividend stocks, we should see more profound moves. That's been happening already over the last month, but I think there's a lot more to go.
Yeah, and Eric, I mean, when we talk about some of those cyclical names, those hard-hit names in the pandemic this year, I mean, each time we got updates of bad news, whether it be, rising cases, new outbreaks, we did see those ones retreat quite a bit here. So considering how shaky the vaccine rollout's been so far here, would you not be a little worried that those names could get hit in Q1, Q2 while we're waiting a full herd immunity?
Listen, it's not going to be a smooth ride. It's going to be choppy. But Zach, what you have to realize here, I was on with Bridgewater last week. We went back to the year 1600. These are the lowest global interest rates in the history of mankind. How are the GEs and the IBMs of the world going to provide pension benefits to all these retirees for decades to come with a sub 1% 10-year treasury? They can't assume a 7% return. they're going to need to own more equities. If you ask me, I'd much rather own a Verizon or a Pfizer paying over 4% dividend with growth potential of that income than a 10-year treasury at a 0.95.
Eric, you talked about the growth that we've seen in tech. In many ways, that's kind of become the safe haven play here at a time when we've seen so much volatility in the year. There's the obvious names like a Zoom that no question benefited from the pandemic. But as you look ahead to the new year, does that thesis still hold in terms of tech and its outperformance because of the growth story? Or you think valuations are setting up for a bit of a pullback right now?
Well, first of all, I think the stock market in general is due for a pullback. It's gotten very frothy. It's gotten choppy. Margin debt levels are at highs. You're still going to want to own some big tech, but you do not want to be in an S&P 500 type of ownership. All right, you don't want 25% in 5 names. That just doesn't make sense, and they are pricey. But I laugh when everyone says the stock market is expensive. The stock market's expensive. No, it's a market of stocks. There are stocks within that index that are very expensive, but there's a whole bunch of value names. I mean, you look at the banks, they are cheap. Energy, cheap. So the stock market has a lot of value in different names.
Yeah, and to your point, I mean, when we look back on what happened this year, the wave of stimulus that we got, and now the latest bill as well, it seems to reason that if Democrats do win both of these Senate races in Georgia, that would set up for a lot more accommodative policy there as well. Of course, maybe some more moderate Democrats have been kind of cheering the fact that if Republicans maintain control in the Senate, he won't need to go along with more progressive policies that he might not be in favor of. So how do you see that shaking out in what we should expect out of Washington to maybe be different than what we saw this year?
Right. So the first thing you need to realize is we're okay with Joe Biden. The market has been okay. When Biden pulled ahead, the markets continued to rally. Biden is not a Bernie Sanders or an Elizabeth Warren. He's a moderate Democrat. Now, the markets love a split in Congress. So we already know the Democrats lost seats in the House. And there's, I think, a very good chance that the Republicans are going to eke out a majority in the Senate. So I think that a lot of those big tax increases that Joe Biden would like to see, he probably won't see. And markets like that too.
And Erica, let's talk about some of the investment themes you're looking at. Pot stocks as well as green energy. Green energy, one that we've seen a lot of our guests be very bullish on, especially on the expectation of the focus on climate change coming from the Biden administration. But what specific names are you looking at that you think have significant upside on the back of what is expected to be new regulation around the environment?
Well, so first of all, I just want to say within green energy, this was going to happen whether Joe Biden won or lost. You have to look at what's going on in the world. There is a realization that climate change is an issue, and every country is talking about it. And the United States would have addressed it too. It's going to happen faster because Joe Biden is a big proponent of green energy. We're not, within our practice, we use a lot of ETFs. We will bring in money managers. We do not pick individual stocks. I like the ICLN as the iShare to represent green energy. I think that it's low expense, and I like the names in there. Green energy's had a big move. So again, we could very well see a pullback. You want to add into that pullback. This is not a 1 year, a 3 year, a 5 year theme. This is a 20-year theme.
That's a long-term hold. Obviously, a lot of these changes take time, no doubt. Tesla didn't become what it was overnight either. Eric Ditton, President and Managing Director of the Wealth Alliance, appreciate you coming on here to chat today. Be well. We're going to take another quick break here on Yahoo Finance Live, but when we return, breaking down the themes and fitness trends of 2020, why a lot of those might be here for good. Stay with us. Welcome back to Yahoo Finance Live. One of the big trends here in 2020 was a shift in home fitness, with Peloton shares up more than 420% on the year. I want to break down a lot of those trends and whether or not they'll be changing in 2021 with our next guest. Abigail Cuffey is Women's Health Executive Editor. She joins us now. And Abigail, I mean, a lot of people out there were quick to scoop up whatever Pelotons were out there on the market. Some people had to wait, but that seems to be one of the big things that's not going to be going away once you have one of those. People keep talking about them. It's a big trend here.
It's a huge trend. We saw it explode in 2020, and it's only going to continue in 2021. People love their Pelotons and have really become used to and recognize all the benefits of working out at home with a Peloton or with other exercise equipment. There's a magic of being able to just go to another room or to another corner of a room and not have to go to a gym or to a class and still get that elevated experience in your own home. So this is something that is definitely here to stay.
And Peloton, of course, led the way on virtual fitness, but we've seen so many different players come into the fold during the pandemic, even the local gyms offering up sort of classes on Insta Live. How much of that do you think will actually stick once we do start to go back to our workplace, go back out to the gyms? How much of this do you think it has been a permanent shift?
I think a lot of it has been. I think that at Women's Health, we've seen so many people that never considered themselves home workout people just really jump right into the shift and not look back. Women's Health launched Instagram Live workouts in March, right after the stay-at-home orders went into place. And we have continued programming with these workouts all throughout the pandemic. And we have a whole community of people that say, when gyms open again, I don't think I'm going to go back because I love working out at home now and I can do it and I get so much out of it. So I think that is very much here to stay. That being said, I think we all have been in, if we've gone to a gym or been in a fitness class and really sort of experienced the feeling when everyone's together and sweating and all those good vibes. So I think there is definitely a place for that. But I think that how we've been working out and how we've been sweating for the past 10 months, there are pieces and elements of it that are going to stay around forever because now some people have just fundamentally shifted how they prefer to work out and taken away some of the barriers and some of the obstacles to fitness.
Yeah, it might be a while before sweating and good vibes go in the same sentence here in the pandemic. We'll see how that plays out. Well, it's kind of triggered a lot of the same thing. It's triggered a lot of the same thing. You got people who might not have been big fitness people, buying up Fitbits, buying up Apple Watches to maybe see how they're tracking on some of these things. But that's also been a trend even before the pandemic in the athleisure space. Maybe feeling fit while you're wearing the clothes, and maybe that'll change when we go back to the office. But how has that played out here in 2020? That kind of trend, Lululemon obviously up about 60% this year too.
This has been huge. I think we all know as we've lived in leggings, sweats, comfortable clothes, as so many of us are working from home, working remotely. But really this idea of activewear and athleisure sort of infusing our everyday looks, right? Like we're not just talking sweatpants, we're talking now we have other types of clothing that now have elements of the sweatshirt, the sweatpant, just that sort of focus on this comfort now. And I think it's going to be very hard to go back to how we used to dress in so many ways, as you are seeing up there. I mean, the athleisure market, which has so much competition right now, is expected to see sales in the US total $105.1 billion in 2020. That is huge. Another stat that I love is that items including sweatshirts and sweatpants were expected to account for 31% of total US apparel spending during the holiday season. So we are truly a sweatpant nation now. But as you said, big players like Lululemon, Athleta, Nike have all reported stronger sales than a lot of other retailers during this year. So that is here to stay. I think once you have comfort and have these elements in your apparel and in your clothing, you are going to always be looking for that. And we're seeing the market reflect that.
Yeah, and Abigail, I guess if we're all being really honest, it's also comfortable because so much of us has gained during the pandemic, right? Sitting at home and eating all the time, not necessarily getting out. Another trend that I thought was kind of interesting on your list here are elevated breakfasts, as you describe it, which I completely overlooked because I don't step outside my house in the morning. But how is that likely to change? And who do you think is kind of best positioned to take advantage of this trend?
I think we're going to see this continue in some ways. So we saw without the commutes and with everyone at home, the idea of morning meals and what you're making for breakfast, the whole definition of it sort of shifted because it wasn't just, grab and go, get out the door, eat something on your commute. It was, I'm home, I, have a little bit more time perhaps, and you may be feeding your family. And so people were able to sort of make meals or think about things differently, like pancakes, right? Like, do you make pancakes during the week and the weekdays when you're crazy? Usually no. On the weekends, yes. But there are all these elements that sort of came into the week and changed how we think about morning meals. I thought it was interesting that Whole Foods rated Epic Breakfast every day as one of their trends to watch for 2021. And we're so seeing that at Women's Health as well. It's this idea of I can have this exciting, flavorful, different meal than sort of the usual quick grab and go and make it and be on your way. So I think that is definitely going to continue in 2021, and hopefully for people that are going back in some way, shape, or form, this idea that breakfast can be different or more or a little bit more fun and exciting, even when we are starting to make ahead and take it on the go, is going to stay with us. So I hope that's one that's here to stay. I know it is for me in my life and my home.
Well, here is hoping to a healthier and more active 2021. Abigail Cuffey, Executive Editor at Women's Health. It's great to talk to you today.
Thank you so much.
Coming up, streaming versus the box office. We know who won the battle in 2020, but will movie theaters stage a comeback come next year? We'll debate that after the break. With movie theaters largely closed throughout the pandemic, streaming services have seen a huge bump in subscribers this year. That trend likely to continue with major studios, including Warner Brothers. I see Zach there announcing its release of all of its films direct to streaming next year. Let's bring in our guest, Paul Durgarabedian. He is a senior media analyst at Comscore. And Paul, we've heard the warnings from the likes of AMC saying they don't know if they can make it through January, given the downturn and the financial pain they have been put in. But you say the rumors of the demise of the movie theaters has been greatly exaggerated.
Absolutely. It's really interesting too, because we had a record box office year in 2019, $42.5 billion earned around the world. This year, it's going to be more like $11.5 billion globally. So it's really taken a downturn. Obviously, though, everything's shut down basically March 20, that Friday, March 20, that was when theaters essentially closed. At that point, we were running ahead of 2019. We were doing really well. We had Bad Boys for Life that did much better than expected. And Invisible Man, one of the best movies of the year. It doesn't seem like forever ago when that came out. That movie was doing really well, and then it got sidelined, and a lot of movies went to streaming immediately, and a lot of movies were moved down the slate into later 2020 or even 2021, which is almost here.
Yeah, that's kind of the big, I guess, cause for concern is how much longer some of those big blockbusters will continue to get pushed back, or how many will get released on streaming platforms, because we know that these theaters are so desperate to draw people back in.
Oh, I know, Zach. It's really been a tough call, because for theaters, they need two things to happen. They need a really strong pandemic response in whatever country, city, town they're in. And then they also need new movies, big movies to draw people in. And if you don't have that, that's really tough on the bottom line. I think the big picture here is that how many theaters will be able to weather this storm? I know they'll be back. I'm very confident about that. I'm very bullish on the future of the movie theater. But this has been months of the box office just being really decimated. And the North American box office is running about 80% behind 2019. That's really tough. And when a movie like Wonder Woman 1984 does about $16.7 million, that's cause for celebration, because that was the biggest opening during the pandemic in movie theaters, while still that movie was available on the same day that it opened in theaters on HBO Max. So people want to go, and we've seen that with drive-ins too. Drive-ins were really huge, relatively speaking, in the summer, because people wanted that communal, outside of the home movie theater experience, or big screen experience, I should say. And that's how they got it. So really, really a tough time for the business, but a lot of big movies on the horizon. But we have to turn that corner, get to a point where we have movie theaters open to a degree that they can start generating big box office.
Well, Paul, some critics would argue that the movie theaters were slow to act even before the pandemic, when the shift was inevitably moving towards streaming, making requirements, for example, that certain films needed to have a certain amount of a run in theaters before they actually went to streaming. How do you think that conversation shifts? Assuming that these major movie theaters do survive, how does the business model shift?
You make a great point, because what you're talking about is the window between when a film opens in theaters and when it's available on home video or on streaming. And what that's done for the industry, for the theater industry, is given it a prestige and an exclusivity, because you have to wait to see a movie at home. So people go out to the theater, see a big blockbuster, and they're like, wow, in a couple of months or maybe 3 months, I'll be able to get that movie at home. Now, those dynamics, and literally it's a dynamic window now, are changing. And depending on the movie, the type of movie, its potential for blockbuster success, I think we're going to see a carryover from this, that there will be a bigger conversation surrounding what movies go to the big screen. And then once they do, how long should they be in theaters before they then are available on streaming? That's an accelerated conversation. And now those strategies are already being accelerated. We saw that with Wonder Woman 1984. We saw it way at the beginning of the pandemic with Trolls World Tour, where that movie suddenly had to shift directly to streaming. And then, of course, Tenet opened and Croods opened recently. And actually, those movies have done well considering the lack of seats that are available and the lack of screens. And so that makes me feel good that people are still seeking out that experience. I think streaming and the theater will live side by side as they did in 2019. It'll look a little different, and it's going to take some time before people feel fully comfortable going back to any brick and mortar communal space.
Yeah, but Paul, it seems to me like it's kind of the cat's out of the bag when we're having this kind of friendly relationship. It's been there between the theaters and some of the larger studios, but now when you look at a Disney Plus and the idea of saving so much money and keeping more revenue, just putting it on a Disney Plus streaming platform, it seems like once you do that, it's tough to go back to the old way of doing things.
It is. The genie is somewhat let out of the bottle in that case, and it is hard to put that back. But you have to remember, too, if you have a movie like Avengers Endgame, which just last year, it seems so long ago, opened with $350 million and made almost $3 billion worldwide. How do you do that just on streaming? It's very difficult. And I know there are revenue splits between theaters and the studios, but when you're talking about movies that earn $1 billion or $2 billion plus, you do that in the movie theater, and then that builds a huge conversation around that movie, and that becomes even more valuable on streaming. But there's no denying that this has changed everything. But I think people who are jumping to this means the end of the movie theater, I think that's completely misguided. This is a business that's been sidelined, and now it's going to take some time to come back. And naturally, streaming took over. People are stuck at home. They're consuming a lot of content. But again, I point to drive-ins during the summer, getting a lot of people seeking them out. And then more recent movies like Wonder Woman 1984 doing better than expected in the movie theater.
Yeah, well, if you had told me last year that Doolittle would have been up there as a top box office performer, I would have called you crazy, but that's just how 2020's gone. Paul,
it really has. Everything's changed, for sure.
Yeah, it's a nuts year that we're looking back on. ComScore Senior Media Analyst, appreciate you taking the time to chat. Be well. Happy New Year.
Thank you. Same to you, Zach and Akiko. Thank you so much.
Of course, 2020 here has been a year. We're reflecting here on the last day of the year, and our company of the year obviously benefited from the idea of streaming and connecting at home. That would be Zoom. Want to spotlight that package we rolled out here, explaining why the company earned the Yahoo Finance honor. Take a listen.
No other company has had the kind of year Zoom has had. Amid a global pandemic that has shuttered huge swaths of the economy, driven millions out of work, and forced the term social distancing into the national lexicon, the video chat service has become a lifeline for everyone from friends and families to schools and businesses. While the company debuted in 2012 and launched its IPO in 2019, it was 2020 that quickly made the firm the kind of household name few other companies have managed to become. Like calling a web search Googling, video chatting has become Zooming. People now Zoom with their friends rather than Skype or FaceTime, and rather than asking friends to get a drink, people ask, "Want to Zoom?" All of this from an app that wasn't even designed for regular consumers.
I have to say, I joke, I think I have ulcers from that time period, to be honest, responding to the demand. It's very humbling. It's an honor and privilege to serve the world, and I am, so proud of what Zoom has been able to do.
We are very humbled and proud of the opportunity that we've been given during this time to support connection in the community.
But the transition hasn't been an easy one. The company faced criticism early in the pandemic due to security issues resulting in so-called Zoom bombings. Still, Zoom has managed to become the kind of app used by everyone from teens and adults trying to keep their social lives afloat while socially distancing, all the way to members of government. And Zoom School has become a phrase that parents across the world are using as they continue dealing with school closures. As early as March 6th, Zoom began lifting the 40-minute limit on free basic accounts for K-12 schools in Italy and Japan, and by request in the US. A week later, the company proactively lifted the limit on accounts for 60,000 US schools. Zoom classes quickly became the norm as school systems transitioned from in-person learning to remote learning with city and state lockdown orders put in place. In its most recent quarter, the company saw year-over-year revenue growth of 367%, with the number of customers who spent more than $100,000 in the past 12 months growing 136% year over year. And investors have been watching. Zoom's stock price has skyrocketed in the last year, jumping 465% from $71.90 a share in January to $406.31 a share as of December 1st.
I mean, I would have loved to say that we planned it perfectly. Obviously, we didn't. Nobody has planned this pandemic. And I think the biggest benefit for Zoom that you're seeing in the user base is that we do provide that human connection when we desperately need it most.
The number of users that began piling into the platform through the pandemic can't be understated. While Zoom doesn't share individual user numbers, it did announce that daily meeting participants skyrocketed from 10 million in December 2019 to 300 million in April 2020. The incredible growth and seeming overnight transformation of the video chat service to one that's being used by individual consumers, small businesses, and community groups alike is why we've chosen Zoom as Yahoo Finance's 2020 Company of the Year.
An incredible year for Zoom indeed. Coming up, a historic transition across the pond, the UK officially exiting the EU at midnight tonight. We'll discuss the implications for trade and travel with the UK Trade Commissioner for North America. That's coming up after the break. Welcome back to Yahoo Finance Live. The 11-month Brexit transition period officially comes to an end at midnight in the UK tonight. Come tomorrow, the UK will officially be out of the European Union single market and customs union, ushering in a new era. Let's bring in Anthony Phillipson. He is UK's Trade Commissioner for North America. It's great to have you on today. 2016 is when this all began. It feels like it has been a very long and often rocky road to get here. For those who haven't been following every step of the way, help us understand what changes fundamentally from a trade standpoint come midnight tonight.
Well, thank you very much indeed for having me on. As you say, it's a historic moment. Technically, just to be slightly pedantic, it happens at 11 o'clock UK time, midnight Brussels time. So that will be the official moment. And indeed, I think even Big Ben will sound to mark the moment. As you say, it's been a long process since the referendum in June 2016. It's been an intense process. I mean, separating the UK from the European Union, from the single market, from the customs union was never going to be a simple enterprise. Of course, the most significant moment really was 31st of January this year when we formally left the EU, although we remained, as you say, within the transition period that ends in a few hours. And we will move into, as the Prime Minister has said, the next chapter in our own national story, but also our relationship with our prosperity and security partners in the European Union. This is still going to be a very close relationship, governed by a free trade agreement, governed by other agreements affecting our engagement, of course, governed by hugely important joint committee within the Northern Ireland Protocol, within the withdrawal agreement, to make sure there's no risk to the Good Friday Agreement, etc. This is going to be a deeply engaged relationship as we both now start, as I say, the next chapters in our national stories.
Yeah, and as Akiko highlighted there, I mean, 2016, you think about how many things change in 4 years, and it was obviously a pretty close margin in terms of the 52-48 vote. We've been hearing stories from a lot of business owners out there who might not be happy with the way things are going, maybe seeing unforeseen business implications to their own businesses because of this. What's your estimation, or what are you hearing from a lot of people who may have voted for it and maybe thinking twice about that now as we see this deal going forward?
Well, I think there's a couple of points I'd make. First of all, in a way, Brexit is done. Although the transition period ends in a few hours, it was done on the 31st of January this year when we left the EU. So I think we've already moved past some of those more significant moments. And then I guess the other point I'd make is the incredible amount of work that has been done in partnership with business to prepare for what is a very significant change. As I say, we will be outside the single market and the customs union that has been the underpinning of our economic relationship for the last few decades. But we will move forward into this new trade agreement, tariff-free and quota-free, which the EU hasn't done with anyone else, certainly not at this scale. Separate processes on equivalence in financial services, adequacy, governing our data relationship, security relationships. As I say, we move forward not on the basis of no contact and engagement between us, but as part of a deeply engaged relationship. We will continue to put information out there to help businesses prepare. Many of them have already prepared intensively for this. And we'll see what happens as we go through the next few months as we put in place the rest of the agreements, the rest of the new relationship, and continue to look for opportunities to work together in a global context, including, just to highlight a couple, key issues around climate next year, COVID recovery, economic resilience. The UK and the EU are going to be very firm partners and friends as we go forward.
And now that you've got the agreement in place with the EU, certainly there's going to be a lot of attention that focuses to that discussion that you've been having with the U.S. on any kind of trade deal. We heard from the trade representative, Robert Lighthizer, talking about a mini trade deal with the U.K. he'd like to get done, at least in the early parts of the year. Of course, he's exiting with the Trump administration. Where do the discussions stand right now on that front? And what are some of the key sticking points?
So I think there's two things that actually, if you're referring to the piece he did, a TV interview just before Christmas, I don't think he actually himself used the term mini deal. I think that got used by the sub-editor and they wrote up the headline. And what he was actually referring to was the talks that are ongoing between the UK and the US, and indeed between the UK and the EU and US to resolve the Boeing Airbus disputes, which is a huge priority for us. We think we need to get those disputes resolved. We need to move forward in a way that we can support these strategically important companies, but without hurting other industries who are being affected by the tariff retaliation. On the FTA itself, just before the US election, back on the 3rd of November, the UK and US negotiating teams wrapped up the 5th formal round of negotiation, 5 rounds over the previous few months since we launched them in May. We've made a huge amount of progress. We haven't quite got there. Now we're just waiting to see how we can pick this up with the incoming presidential team under Joe Biden. We're looking forward to working with him and his team once they are confirmed, including, of course, Kathy Tyers, the US trade representative, who we know very well from her time in Congress. And we will aim to position that FTA as an important part of the UK and US's approach to COVID recovery, coming back, building back better, building back stronger from this pandemic and economic crisis that, of course, is not over yet. So that's where we see the FTA now, and we will look to pick that up as quickly as we can with the new administration after the inauguration in 20 or so days.
What are some areas you anticipate or potential areas for discussion, at least as it relates to COVID relief, as both sides really look to try to bounce back, at least economically?
So I think we will look to find ways to free up trade and investment flows between us wherever we can. We will also want to make sure and continue to really focus in on how this agreement can support small and medium-sized enterprises in particular. I think they're the lifeblood of our economies and our communities, and of course have been severely hurt by the economic crisis and the pandemic. We will obviously, I think, want to make sure there's a strong focus on services collaboration, lowering market access barriers where we can in key sectors of our economy. I think we'll also want to continue with a really strong focus on digital trade, making sure that as the UK and US move forward together, we can set some of the global standards in e-commerce and digital trade together, working through other organizations such as the G7 and the OECD. I think there's real opportunity here for both economies, which is why we're still very excited to have the chance to push on with this and to pick up the conversation with the new administration when we can.
It was a long road, but to new beginnings here, a fitting story here as we celebrate the new year. Anthony Phillipson, Her Majesty's Trade Commissioner for North America, appreciate you taking the time, and Happy New Year.
Thank you. Happy New Year to you both.
We're going to take another quick break here on Yahoo Finance Live. We'll be right back with a big look back on 2020, the big market moves year to date to highlight. Stay with us. Welcome back to Yahoo Finance Live. Of course, historic might be overused to describe the year that we've just experienced. When it comes to the stock market, though, it was indeed historic when you think about how quickly we saw a 30% decline earlier on the year, followed by the shortest-lived bear market in history. For more on all those moves, no shortage of things to point out here. I want to get to Yahoo Finance's chart master, Jared Blickery. And Jared, I mean, you got kind of a gluttony to pick from here in terms of the crazy moves to discuss in 2020.
You got it, but let's just go with the kahuna, S&P 500 to begin with. And you mentioned that 30% drop. Well, let's take a look at the Wi-Fi Interactive here. That was indeed nasty. And the biggest thing about this year is no one really believed the rally until it was way off of those lows. And in fact, anytime we had any kind of downdraft, we had a couple of 10% moves. They were so quick and furious, it seemed like the market would perhaps descend into another bear market. And at this stage, we see the market very overstretched. I mean, you take a look at some technicals here with regard to its 200-day moving average, et cetera, very overstretched. So a lot of times this time of year, you can actually pinpoint what might happen in the next year. And in fact, some research by Ryan Dietrich at LPL Financial illustrates this. And this is the post that he has today. Basically, not only does the Santa Claus rally, and we're in day 5 of it, predict what's going to happen in the new year a lot of the time, but also when we have 20% move in, greater than 10% move in the final 2 months of the year. And this is what he's writing about here. A big end of year rally could have bull smile in 2021. And we can put this back up on the Wi-Fi Interactive. Turns out a 10% or more gain the final 2 months of the year has equaled a higher S&P 500 the following year every single time since World War II. And in fact, we're putting in the best 2-month performance that we've had since World War II. So here's what happens normally in a year. Stocks go up, maybe high single-digit returns. And then we also have this right here. Now, this is what happens in one of these years where we have these gains like this. Guys?
Jared, of course, so much of the discussion throughout the year has been kind of these two sides here, the stay-at-home trades, as we've described it, that have seen a huge boost as a result of the pandemic, and then some of the reopening trades that have kind of teetered back and forth, depending on the headlines around the vaccine as well as the economy. Where do things stand right now on that front going into 2021?
Well, it's really been a fascinating year in that regard because the lockdown trade kind of emerged in March and April. And let's see if we can get the Wi-Fi Interactive up now. Had a little technical problem before. Here's the NASDAQ, and this really tells a story here. If we look at year to date, you see the big caps, the mega caps. Those were in part some of the biggest gainers because we had low interest rates. I mean, interest rates sunk very quickly along with stocks back in March, and then kind of recovered a little bit, but really not nearly as much as stock. We still have the 10-year hovering below 1%. And so we saw this flight into a lot of the big caps and also some of the names like Tesla, not really a lockdown trade or a reopening trade, but that's kind of an idiosyncratic story. But you take a look at number 2 here, Moderna, that's up 440% year to date, although over the last month, it's sunk a little bit. So a lot of these leaders have given back gains, and this happened in the fourth quarter. If we take a look at the sector action for the year, you can see tech, XLK, still up more than 40%, followed by discretionary and communication services, each up more than 25%. Those are the FANG stocks. But you take a look at what's happened in this quarter, energy is a standout, and then you have financials and industrials. So as we got this great vaccine news, as we got some resolution on the November presidential election, then we saw this reorientation of the markets into some of these other sectors. We talk a lot about the value and the cyclical play. So, heading into 2021, it's going to be an event-filled week next week because we do have that Georgia runoff, and there's still volatility in the markets surrounding that. So we'll have to see what comes of that. But if nothing changes, if the Republicans keep control of the Senate, probably still see some more of that rotation into the value and cyclicals in January.
Yeah, I mean, we'll figure out pretty quickly what kind of year we're in for after we got that news. But Jared Blickery, appreciate that look back on 2020. And Akiko, I mean, we don't necessarily want to end the show fully on a look back here. We're also looking forward to some changes that are expected to come down the pike in 2021. And I know you've been looking through a few tied to board diversity requirements as well as other disclosures that are kind of necessary here in the new year.
Yeah, but let's kick things off with what we're seeing on a nationwide level here, which is the minimum wage increasing. About half of the U.S. states raising the minimum wage. And I think this is kind of an interesting discussion because remember, if you look back to a few years ago, the discussion has been that raising the minimum wage hurts smaller businesses. At least that's what the critics have argued. But you do get the sense that the conversation has really shifted this year, largely because of the focus on these essential hourly workers who have continued to work throughout the pandemic, taking those risks that they do despite the pay that they get. And so the next phase here, as we look ahead to 2021, is certainly going to be what President-elect Joe Biden has said is a priority, which is to raise the federal minimum wage to $15 an hour. We'll see if that works, but it also feels like we've seen a number of companies that have been stepping up to try and raise the wages as well, as there's continued focus on the hourly workers who have continued to operate during the pandemic.
Yeah, the thing that gets lost in that conversation too for me is kind of the point that a lot of these tipped wage earners, and you think about servers as well, can get paid below the minimum wage levels that we're seeing, even though we are seeing states increase them in 2021, everything from $8.75 in Nevada, Montana to $14 or $15 or $13 or $14 in California, depending on how many workers are employed at those businesses. It's kind of a moot point if you're a server, and you're going to see minor changes there. But if you could get, and Joe Biden's talked about changing that tipped wage minimum, that would be a big change for servers across the country if that's something that can actually get done.
Yeah, and speaking of companies that have sort of committed to raising wages too, we've had B of A as well as Amazon saying they're going to be paying workers more than $15 an hour. Starbucks committing to raising wages for their baristas by 10% over the next 3 years. So a lot of changes coming on that front. You alluded to some of the new laws here in California that I'm watching closely. A number that could really affect a lot of these tech companies that we cover here. California requiring companies based here to have at least one board member, board director that is a racial or sexual minority by the end of the year. Remember, California was the first one to come forward and say there need to be at least one woman on the board. This is kind of an extension of that too. So we will, of course, continue to follow that among a number of new laws. That does it for us here in 2020. Zach, it's been great co-hosting with you. Of course, we will be back here on Monday. Wishing you all a very happy new year. See you back here next week.
Happy New Year.
It is 1 p.m. on Thursday, December 31st, of course, of New Year's Eve. This is Yahoo Finance Live. I'm Julie Hyman, in for Kristen Myers today. Let's take a look at where stocks stand on this last trading day of the year. We have seen the major averages near record highs, but not necessarily reattaining them today, although the Dow did touch an intraday record earlier before slipping a bit, but really not much change, and these kinds of days do tend to be low volume. On the year, of course, we have had what has been a pretty consistently surprising rally for the major averages despite the pandemic. Because we have seen the outlook improve, we've seen the major averages improve as well. The S&P, for example, is up about 15% this year, whereas the Dow is up about 6% or so. The NASDAQ has been the big outperformer. It has risen more than 40% this year. Today's action, or lack of it, is coming after the latest economic data and the last economic data of the year. Jobless claims falling for the second straight week. We're going to have details and reaction. The aid package signed into law this week has provisions for student debt relief. We're going to break those down. And the federal government set a goal to have 20 million people in the U.S. receive the first dose, at least, of their coronavirus vaccine. So far, though, just over 3 million doses have been administered. This as more cases of the rapidly spreading COVID strain are being discovered in the U.S. and hospitalizations are at a record. And let's begin there as we kick off the hour here and begin our discussions, because I want to focus in on these issues regarding the vaccine and coronavirus, and specifically want to talk Texas for a moment, because we're joined by Dr. Cedric Dark. He's an assistant professor at Baylor College of Medicine and a board member with Doctors for America. He's also an emergency room physician. And I mentioned Texas because, of course, you are there, and we've seen the cases pretty persistently elevated there, just as we have everywhere. We have also had, as we've had elsewhere, some reports there of the vaccine not being deployed as quickly as hoped. What are you seeing there at your hospital and across Houston and across Texas?
For the
Dr. Dark, unfortunately, we're having trouble hearing you. I don't know if it's a muting issue or a connection issue.
I'm not sure.
Oh, now I can hear you.
You can
You
hear.
know
I
what?
don't
Let's
know.
take a break. Let's try and figure out and make sure that we have your audio all sorted out, because I don't want to I don't want to take chances. So, Dr. Dark, just hang on for 1 second. We're going to take a quick break and we'll be right back. With the focus on the coronavirus vaccine here to end the year, even as we still have an elevated number of cases and record hospitalizations, I want to bring in Dr. Cedric Dark. He's assistant professor at Baylor College of Medicine and board member with Doctors for America. Dr. Dark, thanks for your patience. And I think we have our audio issues worked out. So I was asking you about vaccine deployment in Texas, because we have seen a lot of hiccups around the U.S. What's been happening there?
Yeah, as I was trying to say before, myself, my colleagues, and many other emergency physicians and healthcare workers around the state have been eager to get our vaccines. I was able to receive my shot about 2 weeks ago. I have my second dose of the Pfizer vaccine coming up in 1 week. And so looking forward to that. But again, this really is the largest logistical challenge that I think our country has ever faced, or even the world has faced in modern history. If you think about this, it's sort of on the scale of like the moon landing, putting someone on the moon. How are we going to vaccinate 328 million Americans? How are we going to vaccinate almost 8 billion people on this planet? That's one of the huge logistical hurdles. And it's something that, as you mentioned, the rollout has not gone as smoothly as it has hoped. Not as many people have been administered the vaccine as we would like to have happened. And it's one of those things that we have to rise to this challenge if we're going to stop this pandemic.
Are you confident we're going to do so? I mean, we had sort of a practice, if you will, with the testing rollout in this country this year. That also had a rocky start that is continuing in some places. So does that not bode well, or do you think we can get our hands around this?
Well, I think the challenge is immense. Number one, just with the sheer numbers, the ability to keep up demand and supply is going to be quite difficult. Where I work, roughly we have enough supply for roughly half of our staff from that initial vaccine allocation. And so it's going to be a long time before everyone that wants a vaccine is able to get it. Here in Texas, we're moving on to phase 1B, which means we're vaccinating people with comorbidities, people that are age 65 or older, and that are higher risk for complications from coronavirus.
And doctor, I want to turn to what you're seeing in your hospital because, as I mentioned, hospitalizations nationwide are at a record. There in Texas, I was looking at some of the latest numbers here, and it looks like yesterday there were more than 19,000 new cases reported statewide. You told me during the break you're set to begin an emergency room shift in just a few hours. What have things been like there?
It's been picking up in terms of intensity. It's certain places, not necessarily where I work, but where other colleagues of mine work there, having to open up new COVID wards. And this pandemic is still raging. Right now, this is one of the greatest tragedies I think our generation has ever seen. We're talking about nationally almost 4,000 people dying every single day. And even though some people want to diminish the impact of this infection, 1 out of every 58 people that become infected with the disease are going to die. And so if you look at that, think about it in terms of like cancer mortality. It's similar in terms of its mortality to something like prostate cancer or thyroid cancer. And what's really interesting is that if you consider the number of cases that we have every single day for new cases of coronavirus, they surpass the cases of prostate and thyroid cancer for the entire year of 2020. And this is every single day we have this going on.
Yes, indeed. It's an important and sobering reminder when you put it in those terms. And we could be getting a more rapidly spreading strain that has reached our shores. There are some reports of it in California and in Colorado, I believe, as well. How much of a concern is that for you? And I mean, despite the vaccine coming, it sounds like things could get worse before they get better.
Well, I guess it comes as good news, bad news. I'm not sure which one you'd rather have me discuss, but you mentioned some of the bad news is that it's already here. The new variant strain that was seen in the UK has been found in California and Colorado. And just like the virus itself, when it first started back in the springtime, we probably have community spread before we're able to recognize it. And so that's the bad news. But the good news is it's not necessarily deadlier. And experts like Dr. Fauci have said that we expect our vaccines and therapeutics that already exist to still work, regardless of this variant of the spike protein and this mutation. So hopefully it will work out for us long term and not be a terrible change that requires us to have to change our entire approach to dealing with this pandemic.
There's been a lot of talk about sort of pandemic fatigue, right? That people are anxious to get back out again. I'm also curious about pandemic fatigue among physicians, right? Particularly emergency room doctors. You guys are used to sort of long hours, exhaustion. Is this another level? And how are you and your colleagues faring?
Well, on the one hand, burnout has been something that physicians have been experiencing for years now, and coronavirus is simply adding to that. I think a lot of the human touch that we're used to between doctors and patients has been eliminated, as we've had to wear all this PPE. You can't see people's faces. Depending on the types of masks you're wearing, it's hard to hear people. If you're trying to talk to a patient that's hard of hearing, you're essentially shouting and yelling through a mask, trying to communicate with them, and it really hinders what we're able to do as physicians and takes a lot of the humanity out of the side of medicine. And I do fear that, for many physicians who went into the profession with the sense of I'm going to care for people and have that personal interaction with other human beings, that may be tipping us over the edge and causing folks to leave the profession altogether. The good thing is, and from some of the data that I've seen, is we've actually seen more people applying to medical schools this year than in prior years. And so maybe the focus on healthcare as being a valuable profession and something that is still respected in our society. Are you intelligent young people have heard this and they've decided to heed the call?
I like your focus on the positive throughout our conversation, and that's what I'm going to take away going into 2021. Happy New Year to you, and good luck with your shift today and going forward. Thank you for the work that you do. Dr. Cedric Dark is an assistant professor at Baylor College of Medicine and a board member with Doctors for America and an emergency room physician. Thank you, sir.
Thanks, Julie.
Let's talk about what is going on or what is not going on in Washington, D.C. It looks like the latest attempt to get a $2,000 check quickly passed and gotten to the American people. It ain't going to happen. Jessica Smith has been keeping tabs on the process for us. Jess, what's going on right now?
Yeah, no real movement on those $2,000 stimulus checks today. We're seeing kind of the same debate play out on the Senate floor today that we have watched happen over the past few days. Majority Leader Mitch McConnell says he is not splitting up President Trump's three priorities. Again, I know we've gone over these a few times, but not breaking up the $2,000 stimulus checks, Section 230 repeal, or election fraud commission. He says that they need to do those three together. And he really blasted the House passed bill that would increase the stimulus checks to $2,000. Well, then we heard Minority Leader Chuck Schumer say, okay, let's vote on all of these individually. We'll vote on Section 230. We'll vote on whatever you'd like, but let's break them up to see if we can get this done. But Majority Leader Mitch McConnell is not budging. Let's watch.
We do not need to let the Speaker of the House do socialism for rich people in order to help those who need help. Our duty, both to struggling Americans and to taxpayers, is to focus on targeted relief that will have the maximum impact and help the people who need it the most.
When corporations get a blanket tax break, that's fine by the Republican majority. When the average American gets a little help from their government, it's poorly targeted.
You heard Majority Leader McConnell call those $2,000 checks the current plan, calling that socialism for the rich. Then we saw Senator Bernie Sanders come out and say that he was delighted the Majority Leader was talking about socialism for the rich, but then he went on to blast the 2017 GOP tax cuts. So again, does not look like the $2,000 checks are happening in this Congress, but I'm sure this debate will be back in the new year. Julie.
Most definitely. And I never thought I would see the day where Bernie Sanders stands in front of a big blown up tweet from Donald Trump saying it's a good thing for those $2,000 checks. But that indeed also happened as part of all of this. So what does happen now going into the new year? There was talk of Congress working through the holiday weekend. Is that still happening? And then what happens next week?
Right. It looks like the Senate is going to have to stay and vote to override President Trump's veto of the defense policy bill this weekend. So that will likely happen on Saturday at this point. And then on Sunday, January 3rd, the new Congress will be sworn in. Democratic majority is going to shrink, and Speaker Pelosi could face a very close vote to maintain the speaker position. And then on January 5th, of course, we have those Georgia runoffs, the all-important race that really is going to determine who controls the Senate. And then finally, on January 6th, another big date, Congress is set to count the Electoral College votes. So formally confirming again that President-elect Biden will be the next president. We do plan on having Senator Josh Hawley. He's planning on objecting to some of those results. So that's not going to change the outcome of the election. Clearly, he's saying that there are irregularities and election fraud, but none of that has been proven no court cases have been able to show that. So really what this is going to do is kind of drag out that process, make January 6th a little bit longer of a day. Julie.
Yes, and a little bit of political theater for everyone to enjoy or not. Right. Jess, thank you so much. Appreciate it. Well, in addition to watching all of the goings on in Washington, just want to mention we got some economic data as well. The last report of the year, jobless claims declining by 19,000, coming in at 787,000 last week. That is better than estimated, lower than the estimate by economists. To talk about that and talk about the outlook for the new year, I want to bring in Leighton Spar. He is president of SS&C Alps Advisors. Leighton, thank you for being here. So given all of this that has happened, and as you look back over 2020, as an investor, first of all, given what we've seen, the trajectory of the economy, we're showing those jobless claims right now, what would you say is your biggest sort of investing lesson that you have taken away from this year?
Yeah, so 2020 it's chock full of lessons. I think the ones that are most important are the fairly simple ones, right? Be patient. I was working with a group of 16-year-olds in March of 2020, and we were talking about the market decline. And when you're that age, everything's long-term, right? And we were able to talk about thinking for the long term and being patient. And a lot of those students started investing through the crisis. And I think that long-term perspective is one of those things that can always be reinforced. And this was a year where thinking long-term, extending your time horizon when you go through a crisis is really important. And I think that's one of the lessons that was reinforced this year. I think another lesson is that diversification matters. And we've seen a good year in the bond market. We've seen a good year in commodities. We've seen a good year in equities from point to point, but we had to go through a lot of volatility. So, it's fairly fundamental lessons. I think the important part there is that sometimes what it takes to make good investment decisions is very different than what we're going through in our day-to-day lives, right? We were thinking very short-term individually in March and April, and really through 2020, it was all about improvisation in the short term. In the investment business, it's about thinking long-term, and I think that was reinforced this year.
Yeah, even at times when it's really challenging to sort of separate what is happening in the world and that long-term view. And you have a list of sort of 5 things to watch going into 2021. So I just want to run through them with you and kind of break them down if we could. So that your first thing to watch is commodities as an asset class. And what do you mean by that? I mean, certainly they have not moved altogether in 2020. You can take gold and oil as just an example.
Right. So, 15 years ago, it became really popular. There was some academic research that encouraged a lot of investors to move, 5 to 7% of their allocations into commodities as an asset class, as an asset allocation. And, as we exited the big boom in emerging markets and we went through the collapse in oil prices, the bloom really came off of that rose of thinking of commodities as an asset class allocation. And I think what we've seen over the course of the last couple of years with what's happened in oil, what's happened with the lack of capital investment in commodities, what's happened with the supply chain through the COVID crisis, I think we're now in a period where over the next 3 to 5 years, the returns you're going to see across a broad commodity suite are pretty good. And we can go back to some of that early research that shows that the correlation between commodities, equities, and bonds is low. And from here, I think they have pretty good real returns. And so bringing those back into a portfolio, I think, is going to gain some attention again in 2021.
Interesting. All right. And moving on to your second point here, or maybe if I can kind of bounce around a little bit, because I want to make sure that we mention all of them. You say active ETFs find their group, but the clean energy sustainability investing one is interesting because this is a trend that already started, right? And it's been very uneven, particularly on the clean energy side. Do you think that President-elect Biden is really going to give a lift to this industry?
Yeah, I think there's little doubt that having Biden in the presidency is going to bring a lot of attention to this in the United States. I think something else that has really changed is that China has started to talk about, really reducing their carbon emissions. And they're the largest carbon emitter on the planet. And they've been resistant, because it is an economic cost up front for them to invest in that. But this year, Xi's made a lot of statements about China getting serious about this. So, when you put all of the clean energy investment in the context of the Chinese economy and the U.S. economy, the two largest economies in the world, and you look at it over a decade, it really looks like this is a sustainable trend, right? We've had a great year in the theme and the contextual concentration around energy and around ESG, but it does seem like this is a generational investment opportunity.
Let's circle back to the active ETFs point right now, because I've had a lot of people say this to me this year, that we're going to see in 2021 more differentiation between stocks. It's a stock picker's market is the cliche that's frequently used. Although to your point, over the long term, you buy the index and forget it. You've done pretty well. So why do you think active ETFs might be coming into their own in 2021?
Yeah, so I mean, active investing has had a heck of a headwind over the last decade, and one of the biggest headwinds is the cost of implementation of active investing through mutual funds, which has been the primary wrapper of equity active investing. What we've seen is that active ETFs and the new technologies there lower the cost of implementation. So anything that an active manager can do to get closer to that lower cost option within the passive market, I think is going to see faster adoption. Now, there has been a huge amount of inertia, the profitability, the distribution structure of mutual funds that has really slowed the shift to the active ETF wrapper and the semi-transparent technologies in particular. But I think it's becoming very clear that active managers need to get to that side of the bridge, really to lower costs. And it also improves overall tax efficiency. So when you put those things together, we've seen, a couple announcements this year where we're seeing conversions from mutual funds to ETF structures. We're seeing more adoption of the semi-transparent technologies. In my opinion, it's just a better mousetrap. And we have to get past the inertia of what tradition has been and what the distribution process has been. But we're going to adopt the better mousetrap. And it's a little bit of a benefit for active managers. I think what we've learned over the last decade is that there were too many active managers. A lot of them didn't add value. So we're seeing consolidation and shrinkage there. But it's an important part of the market. I think active management adds a lot of value in general. But those that lived on the margin, they're just going away. And active ETF shifts are part of that evolution.
Yeah, this is kind of a shakeout like we saw in the hedge funds, but on a bigger scale because there are more of them. So I want to skip to number 5 to end up, because I want to talk about private equity. When you say private equity goes to Main Street, explain what you mean by that. We have had obviously an enormous amount of interest in things like SPACs and IPOs this year. This would seem maybe to be a related emerging trend. So what do you mean?
Yeah, so I think the first point is, with interest rates as low as they are, the great run we've had in equity markets, investors are looking for returns in further and farther places. And one of the areas of strong returns historically that has been closed off to retail investors is private equity and private credit. And part of it is the qualification procedures are difficult. It's been a very manual process. There's a lot of paperwork. The transparency into the managers has not been very good. All of that is in the process of changing. There are a number of technology and service providers that are learning how to streamline the qualification and the paperwork process. There's more research being done that looks more like mutual fund research, so the transparency is really improving. And then this year, I think one of the capstone events was the opening up of a possibility of putting private equity into 401k plans. And regulators have opened the door to this. Private equity firms and public equity investors are looking for ways to pair together the illiquid private portion with a little bit of a liquidity vehicle that allows that inflow and outflow dynamic of a 401k. But the demand is there. If we get to registered investment advisors and we can talk to them about bringing in smaller scale private equity investments, call it $25,000 at a time instead of $1 million at a time, largely because of that automation, we think there's a huge shift of capital that starts to move towards private equity. And it's fueled increasingly by you and me as retail investors, not just the big foundations and endowments. So we think 2021 is the year you see the technology breakthroughs. You start to see regulation follow behind that. It's a long theme, but we think 2021 is an inflection year for it.
Interesting. Definitely an interesting trend to watch. Thank you so much, Leighton. Good to spend some time with you, and Happy New Year to you. Leighton Spar of SS&C Alps Advisors. Thank you.
Take care.
When we come back, we will be, thanks. When we come back, we'll be talking about Yahoo Finance's Company of the Year. Stay with us. Every year, Yahoo Finance crowns a Company of the Year, and in 2020, it wasn't really even close. It was pretty clear that Zoom Communications needed to be it. And we talked to some folks inside the company about the year that they had.
Zoom has always been, from the beginning, a service that was enabled to provide people with human connection. So our whole premise of our product was to provide human connection. Now, in December 2019, I would have said that that was largely focused around workplace collaboration. As you said, with the pandemic around the March timeframe, we saw a huge influx of users. So we went beyond sort of the workplace collaboration focus, and we saw an increasing uptick of consumer use cases and consumer adoption, large meeting formats, et cetera. It was significant. I mean, I would have loved to say that we planned it perfectly. Obviously, we didn't. Nobody has planned this pandemic. And I think the biggest benefit for Zoom that you're seeing in the user base is that we do provide that human connection when we desperately need it most. For us at Zoom, it was a no-brainer. I remember when we first made the decision to turn on free service for schools, for example. Education is a very critical initiative for Zoom. It's a dear to your heart value for our employees. It's actually one of the things that we focus on as part of our Zoom Foundation, which is our philanthropic arm. And it was voted on by our employees as the #1 issue. And it just so happened that this pandemic had dislocated so many kids who were going to school. And so even those types of decisions, turning on, K through 12 schools for free across the globe and eventually the United States, was a decision in response to a need for human connection, a need for some normalcy during a very difficult time. So for us, focusing on the user and focusing on the needs of the user has always been paramount. And I think that has shown up, that core value, that core driver of the business has shown up in spades in whatever we've done during the pandemic, whether it's sort of a response to the needs for kids to continue their education, response to the need for additional efforts around security and privacy, et cetera. It is a fundamental factor of how we do business.
I guess when you went and saw that influx, from a technical standpoint, were there new server farms you had to bring online? Did you have to, extend it out to third parties? Was it just Zoom's server capabilities, or were you pushed beyond the bounds of that and then had to rely on Microsoft or Amazon, the public cloud,
Right.
kind of, so to speak? How did that work?
Right. That's a great question too. So at its core, I think you have to understand how Zoom is built. So Zoom is built in a very simplistic way from the ground up with two things in mind. Number one, to deliver the most outstanding video possible, a video experience to the user. So that's why I can see your eyes and the deep blue of your eyes right now, and you can see me. It's the outstanding video. And the second thing, we have built this architecture such that it scales in a way that's very easy to manage, and it can meet that influx of demand. So let me go a little bit deeper. So we have a distributed cloud native architecture. It's comprised of about 19 different data centers all across the globe. And we use that in conjunction with the public cloud infrastructure, AWS and OCI. And that gives us significant control and flexibility when it comes to, delivering audio and video and routing our traffic throughout the world. And so when we had this unprecedented, massive influx of demand, we have the ability to, in a few hours, deploy tens of thousands of servers all across the world, depending on where we see the demand. And so it is that infrastructure, that outstanding video quality, coupled with a scalability that allows us to react very quickly and in a very flexible way, that has made us, react to the demand that we see from our users.
So it's something where, you guys originally had the kind of backhaul available, and
Yes.
then, to a degree, and then you said, okay, we're seeing this huge amount of folks coming in. We're gonna, flip on here, flip on there, OCI, AWS. We're gonna need to kind of, get all of our ability to get more and more people online. I guess, was there ever a point where
I would say that
you
our
guys
core.
were
Oh, I'm sorry. I want to just confirm what you had said. Our 19 co-located data centers are the underpinning, and then we're able to flex. We might even, we started off the year, I think, with less co-located data centers. We were able to add a few. I believe Singapore was one. We added a second one in Japan, et cetera. It's that kind of flexibility in conjunction with the public cloud infrastructure that makes us very flexible. I would say, I'm still amazed at our engineers and our technology team, because the way they've thought about this product, it is very scalable. And, at a base case, we are not utilizing the full capacity that we need. We always have some flex. And I think that proved itself out in the pandemic, where we were able to test that flex and really see what it can deliver.
Was it something where, you had seen the numbers starting to go up and thought, wow, this is getting, intense, where we have these capabilities, but we're really, starting to see them put to use and stressed as kind of never before? Was that something that you guys saw and were thinking, wow, it's a good thing we had to be prepared for something like this?
I would say we would love to be prepared for every eventuality, but I don't think anybody, as I said, anybody saw the pandemic coming. It is a testament to the scalable nature of our technology that, we were able to respond, as I mentioned, and flex up within a few hours, tens of thousands of servers at a time. For me personally, we exited December 2019. If you had asked me, I would have said we were squarely a workplace collaboration service. We had about 10 million daily meeting participants, in the December 2019 frame. By the time we turned around to April, it was more like 300 million daily meeting participants. I have to say, I joke, I think I have ulcers from that time period, to be honest, just, responding to the demand. It's very humbling. It's an honor and privilege to serve the world, and I am, so proud of what Zoom has been able to do. For me personally, the point at which I knew this thing was real and had hit was when I started to get calls from my kids' school's parents saying, "Oh, Aparna, we finally figured out what you do now. Where everybody's on Zoom, and I'm going to have my, my grandmother's birthday on Zoom. I joined my cousin's wedding on Zoom." I mean, sadly, there were also funerals on Zoom. And so that's when I realized when we hit the K through 12 free offer in the US, when we provided K through 12 services for free, I think the recognition of Zoom's capability beyond workplace collaboration really sunk in for the world, basically, and also for all of us.
Again, that was a bit on our Company of the Year, Zoom, which of course dominated in 2020 during the pandemic. Coming up next, we talk a lot about the stimulus checks, but there's another provision that it's important to talk about in the aid package, and it has to do with student debt. We will be dissecting that next. Well, thanks to the aid and stimulus package that passed Congress and is now law, people who have student debt will now be able to do tax-free contributions through their employers to try to pay down some of that student debt, which we know is a crisis in the United States. Joining us now to talk more about it is Laurel Taylor. She's CEO and founder of FutureFuel.io, which is a student debt repayment platform. So this new provision, Laurel, and thanks for joining us, is called the Employer Participation in Repayment Act. Talk to me about what exactly it does. And as I was saying to you during the break, it's surprising to me that something like this did not exist already.
Yes, well, Julie, I'm so thrilled to join you today. And I love that sentiment that you were shocked that it didn't already exist, because it's incredibly intuitive. The Employer Participation in Repayment Act is a transformative provision that is enabling employers to leverage their tuition assistance and tuition reimbursement program and budget and simply expand that budget not only for future educational pursuits, but to also pay down the student debt that employees have already incurred, I would argue, to get the job. And so it enables employers to offer $5,250 annually, tax-free to both the employer as well as the employee. And shockingly, this will liberate about, somewhere between 143 billion and 206 billion dollars to pay down student debt. And I can share a little bit more and get more granular on where those numbers come from. But this is a transformative provision that will have a massive impact in the workplace and for employees who are struggling and confronting and paying down student debt.
So just to make sure I understand this correctly, presumably there would be two ways in which this would be deployed, where an employer would offer this perhaps as a benefit to employees and say, maybe to attract them, to retain them, we're going to pay down some of your student debt, and they would get the ability to do that in a tax-free way. Or they could allow the employees to do it through their job in a tax-free way. Is that, am I understanding it correctly?
Okay, so perfect. So Julie, this provision enables employers to effectively add extra payments and to pay down, and we as Future Fuel, we of course facilitate this entire benefit offering, but it's an additional $5,250 in tax-free contributions to pay down the student debt of employees. Now, employees will still continue to pay their student loans, and that will be in a post-tax world, but certainly this additional $5,250 that the employer has already set aside. Actually, 71% of employers offer tuition assistance and tuition reimbursement programs. And so this enables all of those employers, and that tuition assistance and tuition reimbursement offering covers about 115 million employees, but that budget goes 92% unutilized every year. So now employers can take that 92% of budget that goes unallocated and they can leverage it to pay down the student debt of their employees. And it's finally tax advantage, just like any other benefit that's being offered in the workplace.
Gotcha. Okay. And in addition to that, going into 2021, the Secure Act is on the table. Secure Act 2.0, I should say, which offers further incentives to get this debt paid down to employers, because it talks about offering matching a contribution to retirement savings to employees who pay down their debt. So, the only thing I wonder about with this particular provision is for the employees who aren't paying down their debt at the same rate, is that going to be enough of a carrot, if you will? I wonder if the people who are not paying it down at the same rate, is it because how many people don't pay down their debt because they can't? And how many people don't because they are deploying the cash elsewhere?
Good. Okay, so we have two issues here. The repayment of student debt. The average horizon is 17 to 20 years. That is the pay down journey, which is staggering. And then we have 401k participation. So if we think about the student debt, paying down student debt, so we have about 20% of student loan holders are on income-driven repayment programs, which decreases the total amount that employee has to pay commensurate with income. Now, if we think about and 53%, by the way, 53% of borrowers are not prepared to enter into repayment in FY21. So we would really encourage those users to get on and switch their plans to income-driven repayment plans if they're not prepared to enter repayment. If you've lost your job, you can bring it down to $0 for 12 months as an example. Now, if we look at the Secure Act 2.0, and this is a transformative year in the workplace from an employee benefit and benefits that address student debt in the workplace. The Secure Act 2.0 for the first time will enable employers to offer a matching contribution to employees who are paying down their student debt. So I've had $150,000 of student debt. I did not put anything into my 401k in the first 10 years of my career because I was paying down my student debt. My mother took out a Parent Plus loan as a social worker with a 9% interest rate. The interest rates on Parent Plus loans are outrageous. She didn't put anything into her retirement in the last year she could save for retirement. 84%, according to MIT Age Lab, 84% of those who have student loans do not contribute to their 401k or retirement savings, or they contribute at a suppressed level. So the Secure Act 2.0, what it enables Americans as they're paying down student debt for the first time ever For the majority of the population paying down student debt, this will be the first time they have anything going into their retirement savings. So this is truly a transformative opportunity for those who are paying down student debt to build wealth in partnership with their employer. And of course, the provision that was already passed enables employers to direct dollars directly to help pay down the student debt of their employees. That will save the average employee $30,000. The impact is $30,000 on their student loans and will shave off 6 to 7 years off that horizon. So these have a huge impact at a micro level. And 2/3 of debt is held by women and persons of color. So as we think about employers, progressive employers who are financially inclusive, who want to address the full spectrum of financial health and wellness within the workplace, women and persons of color own 2/3 of debt. And we know that also, women have left the workforce kind of en masse since COVID hit at about 22%. So this has a double impact within the workplace.
Right. Thank you so much for explaining all of this, Laurel. It's been really helpful and really interesting, and also really hopeful, I think, on the topic of student debt, over which you do not hear a lot of hope. So Laurel Taylor, CEO and founder of futurefuel.io, thank you so much for your time, and Happy New Year.
Happy New Year. Thank you, Julie.
Thank you. Take care, Laurel. Well, coming up next, we are going to talk about one company that avoided layoffs this year by talking to employees and asking their opinion. We'll be right back. Well, when faced with the prospect of potentially cutting costs, cutting employees earlier this year, Dan Price, the CEO of Gravity Payments, went to his employees and asked them what they thought he should do. And Dan is joining us now. So Dan, how did this all go down earlier this year, and kind of what did you learn through the process?
Yeah, well, Julie, when we implemented the $70,000 minimum wage in 2015, Rush Limbaugh and Fox News and a lot of prominent voices came out and said that we would fail as a result and we'd have to do layoffs. So we took that into account, and our team came together, and we always said, well, we're going to plan for what we heard was the worst recession of our lifetime, 2008, where small businesses lost 20% of their revenue, and we as a result lost 20% of our revenue. But when the pandemic hit, we were planning for that 20% to be prepared for the worst crisis that we were told we would ever face in our lifetime. And what we found was small businesses lost 55% of their revenue in March and April of this year. So we found ourselves completely unprepared. We were losing $1.5 million a month, and we were faced with a very difficult decision, potentially go out of business, do layoffs, which of course would destroy everything we stand for, or increase prices to small businesses, as a lot of our competitors were doing. And our employees said, no, we're not going to do that. And that put us in a situation where we weren't really sure where to turn.
And so you turned to your employees themselves, right? And you said, what are we going to do from here? Obviously, you were left with a really difficult decision.
Yeah, I mean, the idea that they threw out there just sounded kind of utopian, because people said, well, let's have anonymous, so that there's no pressure, individual actions by employees where they can either go out and get new clients, help our existing clients get reopened, most importantly, because that's the whole point of our business, is to help small businesses with their payment processing. Or alternatively, people can decide during the pandemic to pick what their pay is going to be, and it'll be completely anonymous. There'll be a spreadsheet where you'll be able to see the individual actions, but in an anonymized way where it doesn't tie to anybody's identity. So I heard that and of course thought, that's not going to work, because everybody's going to think somebody else is going to step up to the table. And when I saw the spreadsheet and the way everyone had filled it in, I bawled my eyes out. And it was one of the most humbling moments of my entire life, because what I found was our employees had, in many cases, volunteered to work completely without pay. We had 30 people asked to take a 50% pay cut. And they were saying they wanted to protect their fellow employees. They wanted to protect our community small businesses. I don't think this is because I'm some kind of great leader, as some people say. That's not true. It's really about our employees that wanted to take care of each other and their small businesses. And that allowed us to extend our runway from just a few months to more like a year, and have enough time to get all of those small businesses reopened with the right technology for social distancing. And that allowed us to recover our revenue to the point where in September, we felt comfortable enough not only lifting everybody's pay back to where it was previously, but also paying everybody back for the big sacrifice they had made at such a risky time to be making such a big sacrifice.
Amazing. It's really an amazing story. And we have to leave it there right now, but I would love to check back in with you and talk to you about what you are hearing from your small business clients now and your employees. Thank you so much. Really appreciate it. Dan Price joining us there of Gravity Payments. He's the CEO. All the best to you, Dan, in the new year.
Thanks, Julie. Happy New Year.
Thank you. You too. All right. Coming up next, we'll be talking about why the prices on your alcohol might be going up. We'll be right back. Well, your French Bordeaux's and German Gewürztraminers, I guess, are about to get more expensive because of increasing tariffs. Our Alexis Keenan has some details on this. I thought this had already happened, to be honest, Alexis, that we saw look at how festive you are because of increasing tariffs. So talk to me about what's going on here.
So you're right, Julie. There were tariffs already in place on a number of European spirits, if you will. But yesterday, the U.S. Trade Representative announced plans to hike tariffs again. This is on alcohol that's imported to the U.S. from France and Germany. This increase will go into effect on January 12th, and it will affect certain non-sparkling wines, cognacs, other great brandies, as well as airplane parts. Now, of course, this is all over the 16 years and continuing to run dispute between Boeing and Airbus. But why tax booze, a lot of people ask, including those who distribute it and buy it. The U.S. regulators say that they basically need to recalculate an arbitration decision reached by the WTO in that Boeing Airbus dispute. The US government is saying that the EU really unfairly calculated its tariffs on US products that the WTO said that it could impose. Now, the WTO awarded both the US and the EU tariff rights. However, the US is concerned that the EU used COVID era trade volumes to calculate its numbers, while the US says it used prior year's data in order to remain more fair. Now, I talked with a major wine importer to the US earlier this morning, and he said that the announcement, while it mentions an additional 25% tariff going on to these French and German spirits, that it's not really clear yet if 25% is the final determination. He said either way, prices are going to have to go up on these products, and it's going to be especially challenging given that a lot of these purveyors, including restaurants, event venues, already struggling due to the lack of sales because of COVID-19. So this round, though, goes after a much wider group of products because it applies to all format sizes. It also applies to alcohol that is under 14%. So hard to get around some of the loopholes that distributors and importers were using with the prior tariffs. Julie?
All right, the lesson, stock up on your French and German booze before January 12th. Oh, looks like Alexis is doing so. Alexis, Happy New Year, and Happy New Year to all of you watching at home. Shauna Smith is in. She's going to take you through the next hour.
Stocks are under a bit of pressure here on the final trading day of the year. Welcome back to Yahoo Finance Live. I'm Shauna Smith. Investors are getting ready to wrap up what has been a very tumultuous year. And let's take a look at where we stand right now with 2 hours to go in the trading day and also in the trading year here for 2020. We have the Dow off just around 15 points, S&P off basically around the flat line. The NASDAQ, though, off just around 38 points. So we do have some time here to move things around, switch things around here for the final trading day of 2020. S&P, it is in the red today, but when we talk about coming off the lows that we saw earlier this year, the S&P is actually up 15% so far in 2020. Taking a look at the sector action, energy, technology, and consumer staples are the biggest underperformers today. Bucking that downward trend, though, financials and communication services outperforming today. Well, let's take a look at some of the bigger movers. And for that, of course, we want to start with Jared Blickery. And Jared, as we wrap up the year, we have to talk about Tesla because shares hitting a record intraday high today, and it's been a massive outperformer really for this entire year. And if you were a short seller, you were certainly on the wrong side of this trade.
Oh, yeah, the short sellers got burned and burned bad. Jim Chanos has talked about how it's been painful for him. He's had to reduce the size of his trade. But let's just get straight to the Wi-Fi Interactive, where I got a few things to show here about Tesla. And number one is the incredible market cap that we're seeing, $679 billion. All right. Number two is it's above 700, and this is the second time this year that it's risen above 700 for the first time. Now, the first time was actually around late January, early February when it was only $140. That was pre-split, so that was the first time above 700. Now, 716 and change here. Now, I also want to show you. You mentioned the short sellers. S3 Partners have estimated that they lost $38 billion in mark-to-market losses in this year as Tesla surged. And the short interest, which was 20%, extremely high, has fallen to 6% of the float. And the head of S3 is saying it's the largest loss he's ever seen, not only for the year, but in any year. And just taking a look at what's happened here, this is the short seller pain. So Tesla comes in at about 38 billion. And then you have Apple, Amazon, Square, Pinduoduo. Those are all coming in between $5 and about $8 billion a piece. And then if you take a look at the richest people in the world here, Jeff Bezos, number one, his net worth has increased by $76 billion this year. Number two is Elon Musk. His net worth has increased $140 billion this year. I just want to highlight one more name because it's instructive to see what Warren Buffett has made this year. He's lost $2 billion. And that includes the investment that he has in Apple, which is Berkshire Hathaway's biggest portfolio position. So something to think about here as we head into the new year.
It certainly is, Jared. And as we do head into the new year, one of the big stories that we've been covering over the last couple of weeks is this SolarWinds hack. And we got new details out today from the company, well, I guess from Microsoft, because Microsoft is now saying that the hackers accessed internal systems within Microsoft. And we can see shares there of Microsoft off just around 0.8%.
Yeah, and I didn't see any price movement around the timing of this announcement itself, which was 1 p.m. today. So really not affecting the share price. And Microsoft, for its part, said, and this was a disclosure made with the Securities and Exchange Commission, they said, we detected unusual activity within a small number of internal accounts. And upon review, we discovered one account had been used to view source code in a number of source code repositories. However, the person wasn't able to actually change the code. And they're saying that it didn't affect any of their critical systems or customer information here. But this is another story we're going to be tracking. It's not going away. Affected companies have been Cisco, Intel, NVIDIA, and Deloitte is investigating this, and there could be more.
Jared, speaking of stories that aren't going away, 2020, it's been a huge year for IPOs. Two big names making their public debuts over the last several weeks. It was Airbnb and DoorDash. Now, the quiet period ends on Monday. So analysts at the IPO underwriters, what's likely to be the key focus here for analysts going forward when it comes to these two names?
Well, valuation is going to be a huge one. And Airbnb, holding on to most of its post-pop gains here, you can see had that really low IPO price. Estimated they could have left $3-4 billion on the table. But the share price speaks for itself. It is a monster here, still up over 100% from the IPO price. And then you take a look at DoorDash, that's also been elevated. Now it's up 2% today. it's given back more of the gains from that first day pop, up about 40%. And I will say this, something like 95% of stocks undercut their first day trading lows within the first year. And so a lot of times it makes sense to hold on to these. But back to the original question, what are these analysts looking for? It's that valuation. Are they too overvalued? And what's the path to profitability here? The DoorDash space is very, very crowded right now, and the unit economics not really looking good until we come up with autonomous driving.
Hey, Jared, real quick, we don't have much time, but we got to talk Bitcoin real fast because it's finishing the year, up around 300%, not too far from 30,000. On the other hand, XRP is under a tremendous amount of pressure, especially over the last month, losing 2/3 of its value. What's the state of crypto as we head into the new year?
I think it's clear here. Real quick, Bitcoin has institutional support. It's probably going up. You can see it's up just even 300% year to date. DoorDash is in a world of trouble here. They've lost, I think, 2/3 of its value over the last month, and there could be more lawsuits coming. So, Coinbase may IPO in the new year, but that could be affected by the Ripple fallout as well, Shauna.
All right, Jared Blakely, thanks so much. Let's take a look at the broader market action here with just around 2 hours to go in the trading day. All three of the major averages, as you can see on the corner of your screen, and now on the big board here, under pressure. The Dow off 15 points. NASDAQ, the biggest loser today, off just around 0.3%. But for the year, though, has been a massive outperformer with the NASDAQ composite with gains of more than 40%. Here to break all this down, we want to bring in Chris Vermillion. He's the founder and chief market strategist at the technicaltraders.com. And Chris, I know you take a technical view when it comes to the market. The volume has been extremely light this week. But what do you make of the action that we've seen over the past several trading days, and what's on your radar here as we enter into the new year?
Yeah, well, 2020 has been a pretty wild year. Obviously, we've seen the NASDAQ really lead the way in terms of the indexes, and that's because it's tech heavy, it's biotech heavy, and those are two sectors that have done very well on the year. We have been seeing a little bit of weakness really since the September top, where investors and traders aren't that interested in getting into the technology. We've seen the NASDAQ kind of lag and the tech sector in general. But I think going forward, we're still in a very tech forward-looking economy, and I think it's going to do really well come 2021 because really the lockdowns, businesses are more strapped to the internet now than they ever have been, and it's really becoming a new way for a lot of businesses. So I like the technology looking forward, and obviously the biotech is here is going to be doing pretty well here too.
Chris, within those tech names, are you betting on the leaders that we've seen so far over the last 10 months, or is it some of the undervalued names that you're finding reason to buy at this point?
All right, so I use a strategy called the BAN trading strategy, which stands for best asset now, and it's a relative strength strategy. The key is to always be playing the leading sectors. You want to be in the market leaders because they're more likely to outperform the market in almost all situations. So you've got to be long the leaders. When you look at the market, technology was good last year or this year, but PBW is a clean energy ETF up over 200% on the year. If you look at the opposite end of the spectrum, one of the worst sectors, which is the dirty energy, oil holders, it's down minus 42%. So huge spectrum between the worst and the best sectors going forward. So I definitely play the leaders. I'm always looking to be in the top three sectors. And I think in 2021, we're going to see some really good moves continue in those sectors alone, the clean energy. There's a few other sectors that are looking primed and ready to go. So when we look into 2021, we're looking at GDX or SILJ, which are the silver miners. They've been building a very strong pattern. Silver miners look very strong. And of course, we've been having some cybersecurity issues. And so there's an ETF called HACK, HACK. That sector ETF or that sector is going to do, I think, very well in 2021 going forward. And so the key is to try to own these leading sectors and to identify them so that you can ride these waves, because 2021 is going to be a very volatile year. We are far from over. Volatility is good as long as you're in the right sectors and you know how to manage positions in case things turn south. But it's going to be a pretty exciting year for traders.
Chris, it certainly sounds like it's a stock picker's market, at least from your view. But I'm curious, we are seeing a bit of pressure today, but we're clearly not far from those all-time highs. We had the Dow closing at a record yesterday. Are you cautious or a little bit nervous at all that there's too much exuberance in the market at this point?
I am actually. I just talked about it the other day with subscribers about how we're actually in a very similar situation. When you look at the technicals and all the underlying equities, we're very similar to what we saw in February this year, early June or July it was there, June, and also in September or August. Each time it led to a market pullback. So I do think we're about to see a bit of a pullback. Everyone's kind of been piling in. I think we're running out of steam to the upside. So I'm anticipating a little bit of weakness come January, and we really need to see how January closes, because it's really like kind of like an opening year range. Where January closes, positive or negative, typically sets the tone for the rest of the year. So January is going to be a very big month for both traders and investors to get a feel of how the year is going to turn out.
Chris, how much of that has to do with the vaccine rollout? Because we've been covering the fact that we are well below what the initial expectations were just in terms of the number of people vaccinated by the end of the year. This could potentially be a huge headwind for the market going forward. So I'm curious how you're pricing that into your expectations.
Yeah, so I don't price in fundamentals or news like that, but I would, because we follow price as a technical trader, that's really the key for what I do. But when you look forward with the vaccine and the virus, I think it's going to be a huge headwind. I think people don't realize how hard it's going to be to vaccinate everyone. It's going to be a lengthy process. Strain 2 is coming around. We're in prime time for it to spread. I think this lockdown, which lockdowns keep getting stronger, more restricted, businesses and people, I think it's going to drag out, and we're going to see it affect the first and second quarter of the year, which people are already looking beyond that. But I think this is going to drag out a lot longer than people think. So I think it's going to put some pressure come January, February. It might be a little bit of a repeat in terms of some selling if things continue to ramp up here with lockdowns and virus spreading.
And Chris, speaking of lockdowns, I think the big question here is the impact that that's going to have on the labor market, because we certainly have seen the recovery there slow pretty significantly over the last several weeks and the last couple of months. Do you foresee that, I guess, continuing that trend here, at least over the winter, as we see the number of cases surge?
I do. I mean, when you look at the jobless claims, like the 4-week average, it's climbing. It's continuing to go up. We've got more strict lockdowns now than we've kind of had before, at least in a lot of different countries, including Canada. People just can't work as much as they want to. I mean, they want to, but they're not. So we're going to see this continue to rise. And this is what I mean. It's going to drag out a lot longer. People are going to be suffering without income. Small business owners are just getting absolutely annihilated. Restaurants and mom and pop shops. I mean, this is the worst thing that could ever happen. And it's going to be here, I think, for another 3 or 4 months, longer than people anticipate. And it's going to hit the market eventually.
All right, Chris Vermillion, founder and chief market strategist of thetechnicaltraders.com. Great to have you, and I wish you a very happy new year.
Yes, same to you. Take care.
Coming up here on Yahoo Finance Live, COVID's impact on the movie industry. We're going to talk to the CEO of Screen Vision about this year's biggest winners and losers. That's up in just around 2 minutes. COVID disrupting the movie business this year with ticket sales declining, get this, 80%. So for more, we want to bring in John Partilla. He's the CEO of Screen Vision. It's a cinema advertising company. And John, great to have you on the program. Your company or your business clearly impacted by the COVID pandemic over the last 10 months here in the US. How have you navigated this extremely difficult time, not only for your business, but your industry at large?
Yeah, thanks for having me, by the way, and Happy New Year as we bring this year to a close. It's been a brutal year with the pandemic for the movie industry and all things derivative of that business. As you said, it's down 80% from the box office of about $11.4 billion in 2019, a year ago, to about $2.2 billion. And, how we're navigating, I think, is everyone's trying to pivot and to survive and to, pivot into what will be, we hope, a more positive and strengthened slate in 21.
John, talking about pivoting to a stronger slate and getting people back in the movie theaters, that screen that we have up right now, it shows that we haven't gotten back above $100 million in the box office in any month since March. I'm curious, just when do you expect that we'll get back above that level?
I think we'll see a pretty choppy still Q1 in the business. I think there will be movies, and I think we'll have about 50 to 60% of the movie screens in the US open for business. But I think we really see a return to the business somewhere in the April-May period. We're very hopeful, by the way, that in April, the Bond movie, No Time to Die, will remain on the slate. That's in early April. And then we've got Black Widow coming in May, part of the Marvel Cinematic Universe franchise. So our prediction is somewhere around April, May, we'll really see the business starting to strengthen.
When we talk about where we stand right now, I mean, this has dragged on a lot longer, I think, than people initially anticipated. Less than 40% of theaters across the US are opened at this point, all of them here operating with limited capacity. How at risk are some of these movie theaters at closing here before we do get to the other side of this pandemic?
It's been rough, right? I mean, I think that everyone has been doing their best to hunker down, preserve cash, do what's right for the health and safety of the US and the customer base that goes to movie theaters. But it's been tough to have a business where there's no product and there's no one showing up and rent is still due. There has been recent news with the bill that was signed, as we know recently, under a program called Save Our Stages, which was a $15 billion allocation within that bill, almost $1 trillion, of which we feel about $5 billion of that may be allocated into the cinema business. And so we feel that will be helpful to the mid-sized operators and the independent operators that could benefit from that signing of that bill.
John, another thing that's interesting here when it comes to COVID, it's really accelerated some consumer behavior, some trends that already existed within industries. When it comes to the movie business, I mean, it's been streaming. Streaming has really taken off here over the last several months. We heard from Warner Media how they are debuting their movies in the month of January, simultaneously in theaters and also making it available on HBO Max. Is this the start of a bigger trend in your view?
I think the jury's still out. I think it's been a good deal of experimentation this past year, as you would expect, with obviously theaters shut down for the most part. It's a good opportunity, I think, for studios with their streaming services to experiment with different types of practices. And I think what we're seeing is that you mentioned, obviously, HBO Max, part of Warner's. I think they've been sort of at one end of the continuum with some of their recent announcements on trying to simultaneously in 21 release movies as well as those properties into streaming. On the other end of the continuum, though, we've got Disney, which had their earnings call a few weeks ago and very emphatically stated, listen, we value the theatrical window as well as streaming. For us, it's not or, it's and. And that's where Disney came down on the other side of the continuum. So they're really valuing and protecting the theatrical window while they also continue to experiment with streaming. So I think we'll see a bit more of this experimentation, certainly through Q1 with most of the studios. And then I think as we come out of Q1, I think we'll start to see again that sort of integrity of the theatrical window before things are released into streaming for the most part, certainly the larger titles.
John, with the rise, though, of streaming, does that alter your business strategy at all or how you look at potential opportunities within the industry?
Yes, for us, thank you for asking that question. We continue to feel that the cinema advertising business is the center of the plate for Screen Vision Media. It's a terrific business. We get to advertise, with that audience across that giant canvas of a screen as people sit before the movies begin. And that's a very unique asset and platform for us. But we have also been pivoting and beginning to sign up new alliance partnerships with different kinds of out-of-home assets and properties and platforms that we can also display advertising on as well. So for us, we still have our cornerstone center of the plate, which is cinema advertising, but we have been moving into adjacencies such as bar networks. We've moved into doctors' offices. We've moved into e-charging stations with screens. So there's been some various other experimentation, and you'll hear some more about our foray into sports stadium advertising as well in upcoming months. So we have been pivoting as well.
John Partilla, CEO of Screen Vision. Happy New Year. We wish you all the best. Thanks for joining today.
For a better year ahead. Thank you.
Yes. I think we all are hoping for that for 2021. We're going to take a quick break here, but on the other side, we're going to talk to eBay CEO Jamie Iannone. He's going to talk about the outperformance of the company this year, what it's like taking the helm of the company in the midst of the pandemic. We're back with that in just 2 minutes. eBay shares getting a boost in the midst of the pandemic. The stock up nearly 40% since January. Well, earlier this year, Yahoo Finance caught up with eBay CEO Jamie Iannone, who took the helm in April. Let's listen to what he had to say.
First off, I had spent 8 years at the company earlier in my career, so that definitely helped, knowing the business and the company and the people. But certainly a different environment starting during COVID. But a big piece of this was really just starting with a listening tour, talking to all of our employees about what's important to them and their thoughts, really getting out and visiting our customers, so our sellers and our buyers, which turns out actually to be pretty easy to do during COVID because it's easy to schedule these calls and spend some time with them. Not the same as being inside their business, but really great to connect with our community. And then third was really to get around the world and see our different offices. And was able to do that pretty easily, just changing my Zoom background to Amsterdam or Korea or something along those lines. So look, that's what really helped me crystallize on this strategy that we're going after, which I'm calling a tech-led reimagination of eBay, really to create the best marketplace for buyers and sellers. Defending our core business, we have a huge opportunity at Julia in non-new and season, and really getting back to that core and going after that growth is what we're focused on. Being the seller platform of choice. One of the first things I did was get out there and talk to our sellers because it was one of my favorite things when I worked at the company before, because they've got great ideas on the tools and capabilities they need to be successful. And then third is building lifelong trusted relationships with our buyers. So spending time with them and figuring out how do we take friction out, how do we make it easier, And a lot of the things that we're building and working on are really designed to help build those longer term relationships with buyers.
Okay, there are a lot of things that I want to unpack with you here, Jamie, and a tech-led reimagination, which is so interesting to me because a lot of conversations these days, and I'm sure you're having these as well, it's all about the word digital transformation. It has been at least for several years. And, before it was kind of like the analog company going to and going from and to the digital world. But it's interesting because eBay, 25 years old, digitally native player, and you're talking about a tech-led reimagination. What does that look like?
Yeah. It's really using next-gen technologies like AI and machine learning to really change the experience on eBay. So I'll give you a small example, which is, we just launched a feature for local pickup. So sometimes people transact in person on eBay. And how do we make it really easy? Well, we built QR codes that when you and I were together and you handed me whatever was a musical instrument, we swapped QR codes and the money just magically flows in the background. That's a small example. A big example is the work we're doing in managed payments. So forever, for the longest time, for 25 years as a company, you've had to create a separate account and manage your payments separately than managing your eBay account. And we've been working on a way to bring those together so it's really seamless for the seller because they can now manage everything in one place. Their fees, for the most part, will be lower. And the feedback that we've gotten from sellers that are on our managed payments platform has been, wow, this is fantastic. Same thing from the buyer side. When you think about a new buyer coming in, they only have to create one account. They can keep that on file. And there's all kinds of great things we can do once we manage the payments for buyers and sellers. So from small little things to larger things, it's really about how are we using technology to make it a much more compelling, seamless experience on the site.
All right. Let's also talk about the core marketplace. That seems to be the focus. I know this company, even before you got there, made some divestitures. Walk us through the strategy as it relates to the core marketplace. Why is this the area you all want to really hone in on when we are seeing this kind of explosion of e-commerce through this pandemic and a lot of other opportunities out there that I guess you could go after, or maybe you just rather focus here at the core marketplace?
In our core marketplace, we believe we have a huge untapped potential in the non-new in season area. That may be for apparel off-season or off-price goods. It could be pre-owned, vintage, collectible, or just kind of new product that's out of season. And when we look at that, there's a $500 billion total addressable market. And for most of the verticals or categories that we're in, we're maybe low double digits, high single digits penetration. And that business is growing double digits. So it's a huge market that's growing fast. That's a big opportunity for us. And what you're seeing us do is go vertical by vertical and say, how do we really win in that market? The other really unique thing we have, Julia, is consumer sellers, people that just come to sell things that they have around the house. And it's great. When we look at it, the average household has $4,000 of items that they could sell, and less than 20% of that's online. And what's great is when someone comes to sell, they usually become a better buyer. They become twice as valuable as a buyer because it's fun to buy and sell on the platform. And it brings that great unique inventory that consumer sellers have just lying around the house that you can't buy from a business usually. So by really being focused on our core in our marketplace business, we see lots of untapped potential. And we've started rolling out specific areas, like we just rolled out watches and a bunch of changes. And this week we announced sneakers, and I can talk about those, but specific changes by vertical to really enhance the marketplace experience.
Okay, you just basically took my next question from me, which was, you just said $4,000 in items. That's like what's average that's lying around people's households. I'm going to have to tell my husband. That's remarkable. So kind of given what we've gone through, this recession that we're in, a lot of people who've lost their jobs, furloughed, you have to imagine they're probably looking for things to sell. I mean, anecdotally, I can tell you, I've heard from friends who are doing this. What are you kind of seeing from the customers these days? Are you seeing more people who are looking to sell items? Walk us through what you're seeing from your viewpoint as it relates to the broader economy.
Yeah, so for our sellers, we're absolutely seeing that. So people just coming on to sell because they're at home more and they have more time and they may need more cash. And so coming onto the platform to sell different items that they have is important. Small businesses are also a really important part of eBay. And so we put a lot of programs in place earlier this year. The one in the US was called Up and Running, where we invested over $100 million globally to really help bring those small businesses online. They may have had an offline business and not been online and wanted to do so, and really investing in them and helping them come on. We had tens of thousands of new sellers sign up, and they're seeing success on the platform just during this time period. What's selling and what are people buying? It started with things that people specifically needed for the pandemic. And then it really transitioned into things that they needed staying at home. So home gym equipment or office equipment, desks, that type of thing. But then it really became across the board, really buying in every category. I was at the dentist a few weeks ago and he said, look, the free time is giving me time to fix up this 1988 truck. So I've been buying vintage car parts on eBay. And I started with this mud flap that I was missing that I was frustrated by. And now I bought like 5 or 10 different things to fix up the truck. So we've really seen it start narrow and then become really broad in terms of what's being sold and what people are buying on the platform.
What's your kind of read, whether it's, the small businesses, which we know have been just decimated by the pandemic and the recession, and the consumer? What would you say your read is and what they might need?
What we see is that there's obviously been a shift towards e-commerce because of the pandemic. And what's been great to see is that as mobility changes and mobility opens back up, it does taper off a bit, but we stay well above pre-COVID levels that we've seen before. And I think what we're really seeing is things across the board. So people finding a hobby or enthusiast because they have the time or they're at home. And so, whether that's musical instruments or trading cards or other hobbies that people are getting into. And of course, when people are cash strapped and times are challenging, eBay is a great platform because of the values that we have. What we've seen in past economic times and past recessions has been eBay really flourishing because people turn to the platform to get the amazing deals that we have. We've got inventory from all over the world. It's spread all over the world, so we don't really have supply chain constraints. And like we talked about with consumer selling, we bring unique inventory to the table. So I think in these economic times, eBay is a great place for that and for the enthusiast customer just looking to, how do I take advantage of all this time that I have at home?
And you mentioned earlier going through it by a category approach. You mentioned watches, you mentioned sneakers. Obviously, sneakers have just been hot lately. Talk to us a bit more, though, why that was such an important market for you to go after. And I think the trust factor there, I think that's something that you're really focused on. And where do you kind of see that going next? What are the other opportunities?
Yeah, so if you look at watches, which we rolled out about a month ago, what we did is we said, we're going to authenticate every watch that's over $2,000. We're going to add escrow payments for every watch over $10,000. And then we're going to have different buying channels to help watch enthusiasts. And it was really focusing on how do we take a category and really create an amazing, awesome end-to-end customer experience. And while that took us months to do, weeks later, we're following up and doing the same thing in our sneakers business. So in our sneakers business, now we've started authenticating sneakers over $100. We're starting with top brands, and starting the beginning of next year, we'll do every sneaker over $100 will be authenticated. And that really helps build trust in the platform because there's a third party authenticating it. And sneakers is a huge business for us. We sell millions of sneakers every single year. It's a great platform for us because it brings on a younger demographic. And so we're investing a lot behind these new verticals like watches and sneakers. And you're going to continue to see us do this vertical by vertical, where we enhance the experience, build trust, build new capabilities to really make sure that we're driving this tech-led reimagination of the best marketplace for buyers and sellers.
You mentioned sneakers obviously being popular with the younger generation, 25-year-old company now. What are kind of the ways that you're reaching the young generations, and what are the opportunities as it relates to it?
Yeah, well, look, we have a lot of the younger generation. We have 182 million buyers on the platform, and just last quarter, we added 8 million new buyers. That's more than the last 6 quarters combined. But there's a lot of things we do specifically there to use our technology to appeal to them. One is we make a huge investment in our apps. Most of our buying is actually done via our apps, and that appeals to a younger generation. It's a really slick interface. We just launched dark mode for iOS and Android, which was the most requested feature in our apps, and the younger generation absolutely loves it. And we're looking at category by category, ones like sneakers and trading cards and other ones where we introduce younger consumers to the platform. But with the scale of what we have of 182 million buyers, we have more younger generation on the platform than most competitors.
Jamie Iannone, CEO of eBay, thank you so much for joining us.
Thanks for having me on.
Coming up, the latest from DC as lawmakers debate $2,000 in stimulus checks. We're back with that in 2 minutes. Welcome back to Yahoo Finance Live. Stocks turning things around this hour, as we can put it on your screen. Dow and S&P back in the green. So we'll see whether or not we can hold on to those gains. Just under 90 minutes left in the trading day. The NASDAQ, the tech-heavy sector here, still in the red, off just around 0.1%. Let's take a closer look at oil with crude closing just a few minutes ago. And for that, we want to bring back Jared Blickery. And Jared, it looks like the hope for more stimulus here helping crude a bit today.
Well, it settled a whopping 12 cents higher, about 20 basis points. So kind of a quiet day. Maybe that's adding to it. But I want to take a look at what's happened this year in crude oil, because this was probably the biggest surprise for me this year, in a year filled with surprises. And that would be this candle right here, just going negative. Still difficult to believe that actually happened. Now, since then, well off the lows, it's actually done quite well over the last 2 months. We've looked at this chart a number of times, but since November, really nice price action here. Hasn't been able to punch through $50 per barrel, but still up 20% over this 3-month period. And from low to high here, up even more. Now, it is worthwhile checking out the energy sector as well, because this has seen a lot of volatility this year. And so here's what's happening today. We can see most of the majors are off by about 1% or more. You take a look at what's happened this year, and none of these stocks, not one, has been able to climb back into the green. So this is by far the worst sector of the year. XLE down something like 25-30% here. Now, if we take a look at what's happened over the last quarter, it's quite a bit different. You can see we have some nice gains in Exxon up 20%, Royal Dutch Shell up 40%. That's a standout. And some of the smaller names also up nicely. You take a look at Apache, that's still down 44% year to date, but it is up 50% over this quarter. Now, also Occidental Petroleum. Remember Occidental? That was the company that Warren Buffett invested in. And by the way, he's still getting an 8% dividend. So he's still making money potentially on that stock, even though he's shed quite a bit of that holding. Nevertheless, still down 57% year to date. A lot of people are wondering, is this going to be one of those value plays that does well in the new year? Probably has some room to run just for having been so downtrodden, but it could take a while for this sector to recover, and could be dead money for another year. We'll have to see what 2021 brings.
Yeah, Jared, I want to ask you about that, because with crude down 20% this year, when we take a look at some of those expectations that's out there on the street, are we expecting to see a quick recovery next year? It sounds like it might take a little bit more time from what you're saying.
I think the demand picture has to pick up. Business travelers still kind of staying at home for the most part. We're seeing a resurgence a little bit in holiday personal travel, but you really need all industries to fire on their cylinders for this to happen. And it's not just jet fuel that I'm talking about. That's kind of a smaller subsector, but it's the industrial picture of the entire world. And as we're rolling out these vaccines, it's going to be important that we don't lose too much momentum. If we do have a couple of headwinds here, could dampen the demand expectations going forward. Now, that's demand. On the supply side, OPEC Plus has done a pretty good job of holding crude oil prices and expectations in check. And in the new year, they're going to be making adjustments on a month-to-month basis. So that's another thing that we're going to have to keep in mind.
All right, Jared, thank you. Crude ending 2020, 48.52 a barrel. Let's turn to the latest down in Washington with the debate for $2,000 in stimulus checks. Senator Majority Leader Mitch McConnell blocking the effort for the third day in a row. Jessica Smith is, of course, following all the latest on this. And Jess, what can you tell us at this point?
Well, it still does not look like those $2,000 stimulus checks are going to happen. Majority Leader Mitch McConnell is sticking to his point of holding together all three of those issues that President Trump has been pushing: the $2,000 checks, repeal of Section 230, and the Election Fraud Commission. Today on the Senate floor, we heard from Senate Minority Leader Chuck Schumer saying, okay, we'll vote on Section 230 repeal. We'll vote on all these issues, but let's break them up and do them individually, because really that is the only way those checks could pass. But McConnell and Republicans held firm. They said they were not going to do that. McConnell says that relief needs to be targeted. He said the House passed bill is a terrible way, he called it, to get relief to people who need it. Let's watch.
We do not need to let the Speaker of the House do socialism for rich people in order to help those who need help. Our duty, both to struggling Americans and to taxpayers, is to focus on targeted relief that will have the maximum impact and help the people who need it the most.
When corporations get a blanket tax break, that's fine by the Republican majority. When the average American gets a little help from their government, it's poorly targeted.
Senator Bernie Sanders also took the floor today, again, trying to push the Senate to hold this vote. When Majority Leader McConnell said this was socialism for the rich, Sanders responded saying he was delighted to hear McConnell talking about socialism for the rich. And then he went on to blast the 2017 tax cuts. So again, it looks like the $2,000 checks are dead for this Congress. But this debate is going to be back again in the new year when the next Congress is sworn in. We already know President-elect Biden will push for more stimulus checks. So again, don't expect this debate to go anywhere for very long.
Just speaking of next year, we got some news out last night. Republican Senator Hawley saying that he will object, to Electoral College results. He's the first senator to do this. We know we've heard a couple of House members say that they are going to do this. To what extent does this prolong the process?
I mean, it is going to make January 6th a longer day for lawmakers. It's not going to change the results here, but it does force Senate Republicans and House Republicans to vote on whether or not to accept the results of the election. So it could put some Senate Republicans up for re-election, kind of in a tough political spot, I guess, though we have seen many Republicans start to kind of distance themselves from this idea. We know that McConnell was privately urging Republican senators not to object. But again, it looks like Senator Hawley will do so. So while this won't change the outcome, it will drag out the process a little bit on January 6th.
All right, Jessica Smith, thanks so much, as always, for the latest from D.C. Happy New Year. We're going to take a quick break here on Yahoo Finance Live. But when we come back, a closer look at the markets. Dow and S&P still in positive territory with just around an hour and 15 minutes to go in the trading day. We're back with more in 2 minutes. Dow and S&P moving higher right now with the Dow up around 100 points. We're not too far from the highs of the session. You can see the Dow up 95, S&P up 10 points. This, of course, comes as we close out or get ready to close out the last trading day of 2020. Joining us now for this episode of Yahoo Finance Presents, presented by T. Rowe Price, we want to bring in Clark Kendall. He's the president and CEO of Kendall Capital. And Clark, great to have you on the program. Happy New Year. It's been quite a year for the markets, to say the least. As we do close out this year and look ahead to 2021. I guess the big question is whether or not this upward momentum that we've seen in the market this year is here to stay.
Well, I think before we can look to 2021, we got to look in the rearview mirror as far as what happened in 2020. In many respects, it was an unusual year, but also in many respects, it's history repeating itself. Remember, we had the pandemic, we had the economy shut down quite hard, but what made 2020 so unusual was the dramatic increase in labor productivity. It grew 10.5% during the second quarter, 4.5% during the third quarter. And on a historical basis, GDP, labor productivity really only grows 1 to 2%. So it became a bifurcated market. Those who worked, did well and were paid well. Those who didn't work, were left behind, quite frankly.
Well, then, Clark, how are you positioned then for next year, taking all that into account and knowing that history does tend to repeat itself? I know you were on Yahoo Finance back in July. You recommended buying small caps at that time. Taking a look at the Russell 2000's performance since then, up just over 30%. Is there still reason to buy those small caps, and where else are you seeing opportunity?
Well, we do continue to see value in the marketplace. Remember, investments all boil down to return and cash flow and the predictability. I call them, sometimes it's easy to know where not to invest. And I point out, one thing it's not to invest in is the fixed income market. Our Jerome Powell has basically said he wants 2% inflation rate, yet we have the 10-year treasury at 0.8, 0.9%. I call them the COVID success stocks. The Zoom, the Pelotons, the Teslas are priced to perfection in this low interest rate environment. If they have any type of hiccup, those stocks fall apart. And remember, I go back, to the history repeats itself. 1950s, 1 out of 13 women worked as telephone operators. And through technology, labor productivity, they had a decade of women going, losing their jobs. Back in the, we also had the 70, the Nifty 50 stocks. We had Eastman Kodak and Coca-Cola, Hewlett Packard that traded like the Zoom stocks today. They took over 20 years to recover. And I go back also just to kind of drive home my point. 1999, we had the Y2K stocks, the AOL, Ameritrade, and Sun Microsystem. A lot of those have not recovered. So I'm being long-winded in answering your question. So stay away from the success stocks, stay away from the fixed income. Where do we see value? The dogs of the Dow, quite frankly. Nobody talks about, they've underperformed this year. You can buy things like Walgreens, Verizon, Dow Chemical, Amgen, 3M. All of them have over a 3% dividend yield. You can sit back and collect a relatively fat dividend check while you wait for these companies to come back. The second tier, kind of continuing the Russell 2000, it's had a strong move, as you pointed out, the fourth quarter. But I still think there's some great companies there. Brunswick Corporation, yeah, they sell fishing boats. Can you believe that? They have strong profit margins. Everyone's getting a fishing boat today at only 7 times cash flow. United Rental, O'Reilly. There are some just great companies, 6, 7, 8 times cash flow. There's the opportunity in today's market.
And Clark, we only have about a minute left here, but I want to ask you about energy. We were just talking about it a couple minutes ago with our own Jared Blickery, but the XLE is off just around 35% this year. We have seen it bounce back a little bit in the fourth quarter. Are you seeing any opportunity within the energy sector, and specifically the expectations there for crude?
Yeah, as I said, I've got 4 cars at home, all of them gas guzzlers. The kids, my wife drives them. And we still fill them up with gas. I still prefer to have a warm home in the wintertime. So, people will continue to use gas, even though I think the Teslas and the EV will be a part of our economy, just like 20 years ago, we thought computers and Qualcomm would all be a part of our economy. So yes, I think there's great opportunity. The energy sector is only 1-2% of the S&P. I would be very careful, but Chevron, Exxon, I still believe have a very good dividend yield. There is opportunity, but you got to manage that within reason.
All right, Clark Kendall, President and CEO of Kendall Capital. Great to have you on the program. Very happy New Year to you. The NFL wrapping up its regular season. We're going to discuss how the league navigated the pandemic and also what to expect from the playoffs. We're back with that in 2 minutes. NFL wrapping up its regular season and getting ready for the playoffs. So here with more on this, we want to bring in Charles Robinson. He's a senior NFL reporter for Yahoo Sports. And Charles, great to have you on the show. Going back several months ago to the start of the season, I think there were lots of questions out there about whether or not the NFL was going to be able to complete the 2020 season. So here we are heading into the playoffs. What's your assessment of how the league has navigated the pandemic?
Well, I mean, I would think that the league would have to consider it a resounding success. I think when the season started, the league said, can we pull off 17 weeks without a break? That was going to be the big question. They knew that there was going to be COVID infection within teams. They knew that COVID protocols were going to be so restrictive that they would probably have to change and tweak them as they were violated or they saw teams struggle to adjust to them. And the fact that we've reached week 17, albeit with an ongoing outbreak inside the Cleveland Browns, the fact that the league learned how to augment the schedules, slide games around to keep teams on the field and make it this far really means a lot. And I think even the league was surprised to be able to announce this week that they're going to cross the 1 million fan attendant mark this weekend, which is, this was a league that was looking at potentially no fans when the season kicked off. So even to get 1 million people in this year and feel like they did it safely, I think the league feels like it's a resounding win.
And Charles, we only have about a minute here, but what should we expect from the playoffs? Because we're not going to see a bubble. There was some push from some people, but will they make this work?
Yeah, I mean, I think they feel like they can make it work. There were going to be enhanced protocols. You're going to have hometown bubbles. Teams are going to have essentially ramped up protocols for the playoffs. So you'll see some teams as the playoffs progress, they'll start to close ranks. I think there's potential as we get toward the Super Bowl. You may even see some teams decide to adjust and move some of the roster into the hotels just to sort of close down and mitigate any circumstances as the playoffs progress. But the league feels like, look, they've got it in hand now. Everybody understands how to make this work moving forward, and everyone's on board.
Charles Robinson, senior NFL reporter for Yahoo Sports. Thanks so much for taking the time to join us. A very happy New Year to you, and also to everyone else watching at home. Happy New Year. That does it for me today on Yahoo Finance. But keep it right here. Adam Shapiro and Sabeel Marsalis will take you through the final closing bell of 2020.
Another grim milestone in the fight against COVID. Coronavirus hospitalizations have surpassed 125,000 for the very first time. And this comes as the federal government struggles to meet its goal to vaccinate 20 million Americans before the end of this year. We'll speak to an ER doctor about the situation on the ground in California and whether or not those business restrictions are actually working in terms of slowing the spread of the coronavirus. And here's a silver lining to all of those at-home restrictions we underwent in 2020. The housing market has experienced a boom as people have snatched up bigger and better homes and taken full advantage of those record low interest rates amid the pandemic. We'll speak to a real estate expert about the breakneck speed of home sales and what the real estate market has in store for you in 2021. And the countdown to New Year's Day. We're almost done with what has been an unforgettably challenging year. If you've already started the champagne, I totally understand. But Moet Hennessy is going to be joining us live to give us some tips on how to fully enjoy New Year's Eve celebrations tonight. You won't want to miss it. I'm Sybille Marcellus.
And I'm Adam Shapiro. Thank you for joining us here as we get our technical issues all ready to go for the end of the year with about an hour left in the closing bell. Want to let you know that we could very much end this year, the S&P 500, up 15% in 2020. The Dow could be up about 7%, the NASDAQ up about 43%. But we still have roughly 58 minutes in the 58 minutes in the trading session. So, Sybille, we're keeping an eye on all of it. Back to you.
Exactly, Adam. Just 15 minutes left. There's still time for a rally, so we'll see where things stand by the time we get to the closing bell. But I want to talk about those $2,000 stimulus checks. Many Americans were hoping to be able to get that. Now, what we're hearing is Senate Majority Leader Mitch McConnell saying that he sees no quick path to a vote on those checks. And you've got Senate Minority Leader Chuck Schumer, who's still pushing for them. So for the very latest on what's happening in Washington, D.C. right now, I want to bring in Yahoo Finance's Jessica Smith. Jessica, are we any closer to seeing those $2,000 stimulus checks?
No closer to seeing those checks. The debate has been playing out yet again on the Senate floor today. And Democrats tried to vote on that bill that the House already passed to increase stimulus checks to $2,000. But Republicans yet again blocked that effort. We heard from Majority Leader Mitch McConnell on the floor today saying, again, he wasn't going to break up the issues that President Trump has been pushing. And then we heard from Senate Minority Leader Chuck Schumer, who said, okay, we'll vote on all of those, but let's do them individually. Doing it individually at least gives the chance for those checks to pass. Democrats insist that the only way to get this done before the new Congress is to take up the bill that the House already passed. McConnell spent quite a bit of time today on the floor bashing the bill, bashing that House passed bills, calling it socialism for the rich at one point. So doesn't look like these $2,000 checks are going to happen this Congress, but this debate will come back in the new year, most likely. We know President-elect Biden has said that he'd like to see another round of stimulus checks, though he hasn't said what number. He hasn't said how much he would like those checks to be. So once the new Congress is sworn in, there's a good chance that we're hearing this debate all over again.
Absolutely. And we will definitely be there to cover every single detail of it with you definitely leading the charge. Jessica Smith in DC, thanks so much. And now I want to talk about what's happening with the market. So we're seeing a little bit of a rally. The Dow is not quite up 100 points. Maybe we'll get there. I want to bring in Yahoo Finance's Jared Blickery to talk about the wild year in trading we've had in 2020. Of course, we underwent that coronavirus shutdown in mid-March. We saw the S&P 500 have its fastest sell-off on record, but we've also seen the pandemic drive market gains. Jared Blickery, what has stood out to you in 2020?
Well, just a year of so many unexpected events. I was just talking about negative oil prices 30 minutes ago. That was a real shocker, but let's stick to the S&P 500 here and stocks. And first, we're going to take a look at the last 5 days because this is day 5 of the Santa Claus rally. And you can see here, now we haven't quite recovered the high that we had on Tuesday, but you can see we're up about 1.4%. Now, the official Santa Claus rally is the last 5 trading days of the year plus the first 2 of the next year. So this will include January 5th and 6th, I believe, next Monday and Tuesday. But usually the gains for the Santa Claus rally is about 1.3% in the S&P 500, so already over that threshold right now. And then in the NASDAQ, it's usually 2.5%, but you can see only up about 0.7% over the last 5 days. Now let's get back to the S&P 500 and take a look at year to date. This was an incredible year. This 35% drop caught everyone off guard, fastest bear market in history, and then fastest recovery in history. I don't think anybody in March or April was expecting us to get to record highs. Maybe some Robinhood traders, who knows, a little bit bullish there. But I also want to talk about what could be in store for next year. Now, here's LPL Financial, and they're saying that with the last 2 months, the last 2 months performance here of 14% in November and December, this is the best end to a year since World War II. And this has only happened about 5 times in the past where we've had more than 10% gains in the final 2 months of the year. And here's what happens. Now, we usually get an average return of 18% in the next year. So that would be 2021, and average gains of 3% in January. And you can see, if you can squint real hard, all 5 times we actually got gains. So looking pretty good for the new year right now based on history, but we do have that big election on Tuesday, which could stir the pot a little if we do get a democratically controlled Senate. Seville?
Well, we'll see where all the chips fall. We've got about an hour left in the trading day. Jared Blickery, thanks so much. And coming up, a COVID-19 update. We're going to be speaking to an ER doctor who's on the ground in California about how the coronavirus spread is going there and whether business restrictions have actually helped. You won't want to miss it. That'll be next.
And welcome back to Yahoo Finance Live on this last trading day of 2020. We're watching the markets for you. We've got the Dow, the S&P 500, and the NASDAQ right now in positive territory. But one of the things we were watching this morning, we'll continue to watch, of course, into the next year, is the employment situation. We're going to get the federal numbers on jobless people unemployed next Friday. But we did get a read on initial claims for unemployment. And while it was somewhat better, Emily McCormick, than expected, still hundreds of thousands of Americans needing help just this week.
That's right, Adam. The last major economic data report of 2020 did give us an upside surprise. We saw those initial unemployment claims breaking below the 800,000 level for the first time since November. And specifically for the week ended December 26, those new weekly jobless claims came in at 787,000. That was lower than the 835,000 that had been expected. Although, as you mentioned, that sum is still well above the pre-pandemic weekly average of 200,000 new claims per week. We should also note that the 4-week moving average for new claims was upwardly revised in this morning's report by more than 17,000 to nearly 837,000 because of the upward revision to last week's data, as well as the elevated claims that we've seen throughout much of December. Now, turning to continuing claims, those also came in better than expected. And those, of course, measure the total number of individuals claiming benefits through state programs. And those fell to 5.2 million for the week ended December 19th, better than the almost 5.4 million expected and the 5.3 million from the previous week. Now, encouragingly, this week's report did show an improvement even before we had the rollout of Congress's $900 billion stimulus package. Of course, there are a number of provisions in there that are going to help unemployed Americans, as well as help keep other Americans on the payrolls. And specifically, I'm talking about the Paycheck Protection Program, the loans to small businesses that will allow them to keep much of their workforces employed even amid the ongoing pandemic. Now, one thing I do want to note about this morning's report, even though we did see this improvement, we're not likely to see this get reflected in the December jobs report that is going to be reported next Friday. The survey week for the monthly jobs report actually takes place during the 12th of the month, and the weekly jobless claims report during that week had shown an increase to nearly 900,000 new weekly jobless claims. So that's suggesting that we may get an even more pronounced deceleration in the net number of payrolls that we saw for December. Some individual economists outside of the consensus actually believe we're going to get the first negative print on payrolls since April. So again, this will be something to watch as we get that December report. It will be a little bit backwards looking, but as we get the stimulus provisions rolled out in the new year, that is going to provide a lifeline to the labor market. Adam and Sabeel.
And we will be watching that. Emily McCormick, thank you. Speaking of a lifeline, we are counting on hundreds of thousands of medical personnel nationwide to help us get through the remainder of the pandemic. Let's bring in our guest right now into the stream, Dr. Jessica Osterman, emergency medicine physician from Los Angeles, California. We appreciate your being here. And while this is the end of how did Queen Elizabeth say it? An annus horribilis. 2020 is just, it can go home and stay in bed and be forgotten. Got to give you some statistics here. We had a record 3,900 people die from COVID-19 in just one day. We have 125,000 people in the hospital in the United States. We've surpassed that. What is this like for you? Because we know Southern California has been hit so hard.
Yeah, we are seeing higher numbers than we've seen throughout this entire pandemic. Obviously, in the spring, we saw a lot of new cases coming in, but even looking before Thanksgiving, our numbers at the hospital have quadrupled. We're kind of in disaster mode where we're trying to find new places to treat patients. We're running out of ICU beds across the county. And there's some hospitals in LA that are actually treating patients in their gift shops and their lobbies and things like that. So we are really, really getting slammed with cases right now.
And what about the new strain of the coronavirus that is reportedly in Southern California? How are you dealing with that, and how is that impacting hospitalizations?
I'll tell you, I'm not surprised that the strain is here. I was actually saying with the way we've seen the spread and the numbers just kind of exponentially increase, I had a feeling that it was already here. And we're not treating that strain any differently from a clinical medicine standpoint, but we are, as I say, it is just bringing more patients to the hospital than we've seen in the previous several months. And so we are really trying to figure out where to treat all these new patients coming in.
Sorry for being muted. There was another TV network where they were talking about what's going on in California. And they said that the lockdowns in California actually made what you're going through now worse. I'm trying to understand what they might have been saying. I think they're mistaken. What would you say to that?
I will say that I don't think the lockdowns have made any impact. I think whether this is the new strain that's spreading faster or people are still just kind of resuming their daily lives. Obviously, our patients and our population here aren't inside restaurants and things like that. But I'm sitting in traffic on the way to work every day. It seems like people are still out and about. And then you compound that with the fact that people were traveling like crazy over the holidays, Thanksgiving first, and now the Christmas holiday. And I think the worst is really yet to come because the spike we're seeing right now is really the result of the Thanksgiving holiday and Thanksgiving travel. And I think we're going to see a huge jump in numbers come January and even into February from the Christmas and New Year's Eve holidays.
And you said the worst is yet to come. Hearing that is always worrisome for Americans, especially coming from a doctor. There's a vaccine that's being rolled out. What are your thoughts on the federal rollout of the vaccine so far?
I will say, at least in California and in LA, we've been very fortunate that all the kind of first responders and frontliners at the hospital have received that vaccine. But from reading the news and things like that, I think the goal to vaccinate a larger number of people has not quite been met yet. And even with the rollouts, I think that we're not looking until, I would say, this summer or even this fall until that herd immunity really takes effect. And we really see significant drops in the numbers of patients that we're seeing.
So when we hear the stories about potential rationing of emergency care, there was a headline about that. Is that really happening? What does that look like?
Right now, it's not happening quite yet in LA County. We've been kind of briefed on it with the expectation that this may be something in our future. But as I say, we are running out of spaces in almost every hospital in LA County. Almost every hospital has been on diversion, meaning they're not accepting ambulance runs, and the ambulances have to get into kind of a round robin to find a hospital that can take their patients. And, I have heard some smaller hospitals are running out of oxygen and things like that already at this point. And so I do, as I say, think that if we do see a surge post Christmas and New Year's Eve, we're going to find ourselves in a situation where we just don't have the resources and the spaces to treat people. And I don't think any of us are looking forward to making those type of decisions because, we all got into medicine to help people. And the fact that we may have to make decisions like that is really heartbreaking.
And are you getting any new information in terms of metrics, in terms of what Governor Gavin Newsom wants in terms of vaccinations of Californians in January?
Yeah, I haven't heard any specific metrics. I know that across the board, most of the hospital staff have been vaccinated in most of the hospitals around LA and in the Bay Area. I have several friends up there. And I think they are starting to do some of the seniors and the nursing home residents right now. So my hope is if we can start really rolling out the vaccination program and get those vaccines to those people that are the most vulnerable, we have a solid chance at kind of slowing the spread of this at least and getting this a little more under control than it is right now.
All right. We appreciate your joining us, and we do wish you and the medical staff, everybody in Southern California, the best as we head to the new year. Dr. Jessica Ostrom, an emergency medicine physician from Los Angeles, thanks for being here. When we come back, for artist and entrepreneur Master P, it's all about ownership and opportunity. We're going to hear from him on why a prospective deal to buy sneaker brand Reebok would be such a massive deal. You're not going to want to miss this one.
Music mogul, entrepreneur, and philanthropist Percy Miller, also known as Master P, wants to make a game-changing move in the sneaker business. He's interested in reportedly purchasing Reebok from Adidas for $2.4 billion. If he's successful, it would be the first time that such a major sneaker brand was actually Black owned. To talk about this some more, we're going to be joined by Yahoo Finance's Reggie Wade, who actually sat down with Master P. Reggie, how big a deal would this be if Master P was able to purchase Reebok?
So Bill, it would be huge. As you said, it would be the first Black-owned major sneaker company. And Reebok was actually one of the top sneaker companies in the 1980s. As a matter of fact, for 1 year in the 1980s, they were number one. So they've fallen on hard times. And Adidas in 2006 bought the company for $3.8 billion, thinking that they could rejuvenate it and resurrect this brand. But unfortunately, it didn't work. So Master P wants to step in there and he wants to make Reebok cool again. But it's not just about the footwear for him. He's also looking at the impact that it would have on communities around this country, especially the Black community.
I just feel like Reebok has a lot of equity still in that brand. And if that company is Black owned, I feel like these guys have tried. But if the majority of the ownership is African American, that we could do more with this brand. And also we can give opportunities for other designers. I feel like the brand need to be made cool again. And I think that we have the plan to make this happen.
Percy, let me run some stats by you real quick because I was shocked to find this too. So Reebok is owned by Adidas. They have been for some time.
Yes.
Now, Adidas has had knocks on its lack of diversity internally and even externally. You know, on their executive board is only 5 white males. On their supervisory board, there are 16 people. They have 11 white males and 5 white women. Now that you have gotten internally inside of Adidas, you've talked to them, you've looked at Reebok, you have kicked the tires. How big is that diversity problem in Reebok right now?
I mean, not only in Reebok, but in so many brands. I mean, African Americans spend more money on tennis shoes. And I feel like it's time to add diversity as ownerships in this business, but it's also time to be able to take the control and show other African Americans that it's time to open the doors. We're stronger together. When you look at the African American CEOs, just like you said, of companies, we only make up 0.1%. I want to change that narrative. I feel like we are able to give back to our community and our culture because we know where to put the money back into the community. The more we make, the more we give. I feel like this is going to give so many opportunities for other African American businessmen and women an opportunity to say, if Master P could do this, we can do it. And I feel like after we open the doors with this, thousands will come and we'll be able to solve the poverty issues. We'll be able to go back to rebuilding our own communities through economic empowerment. I mean, you look at the riots and everything that went on, I think it's definitely time for the diversity, for us to be able to get a seat at the table. I started making smaller deals. It's like buying houses. You have to think bigger. I want my culture to start thinking bigger. Say, we went from making $1 million deals to $1 billion deals. I took a page out of Reginald Lewis' book when he did this in the 70s. He was one of the first African-American billionaires. And I feel like we need more at the table. I'm inviting, not only we have Baron Davis, but even to invite Shaq a seat at the table. We can really make this happen together. All the celebrities and entrepreneurs out there in the world saying we have to own majority of this company to make this cool again and make, Reebok need to go Black. Like you say, the diversity is really needed when you talk about the tennis shoe business.
Mr. Miller, Reggie Wade here. You're not just talking the talk, you're walking the walk with this. Yes. What do you think Reebok needs to do to compete with the likes of Nike? Nike right now has a stranglehold on the athletic shoe market. So what would you do?
Well, like I said, we have to make the product, the technology as good as Nike. When you look at the shoes that Nike put out in basketball and even the lifestyle, being able to bring other brands and tie it in, give other people opportunities, Reebok has been shelved by Adidas. And like I said, this brand is struggling, but it definitely can be revamped. If you look at, people look at Allen Iverson the way we look at Michael Jordan for Nike, we look at Allen Iverson that way in Reebok. We need to bring him to the forefront. We need to bring in better designers. We also need to make this for the millennials, and I think that would be a game changer.
Last year, you came on Yahoo Finance and showed us your Magnati brand, just excellent craftsmanship on those shoes. If you do acquire Reebok, will you bring Magnati to Reebok? What would happen to that brand?
Yeah, that brand would be massive the way Kanye brought his Yeezys to Adidas, and I think that's what we're missing. These brands are not just about sports, even though we're going to get some of the top sports players in the world, but being able to bring high fashion to brands like that, to accent, to be able to say, if we took a Magnati and brought the right designers, the right team with this, that now we have a fashion brand at the same time, so you're touching every area of the business. And also, I just feel like we could make it cool again. We could make Reebok cool again. And I think it's a blessing for us to be able to get into a position like this. When you look at Aunt Your Mama, Uncle Ben's, when you talk about the diversity, we're talking about product. Me and my partner, James Lindsay, we was able to get rice into stores, noodles, cereal. I mean, the game is changing. So I think that a lot of these companies are opening up, and we're able to sit down at the table with a lot of these owners and say, bring some diversity in. Let's get some African-American owned product on the shelves. You know, this is major for our culture if we're going to turn this around. And I'm just saying that this is not about a black thing. It's about empowering people, because it's not going to just be an African-American business. But I'm just saying the majority ownership should be African-American. I think that we could turn this company around.
Percy, Adidas has set a deadline by, I believe it's March 10th, to figure out what they want to do with Reebok. But just hearing you talk, are you nearing a deal now? Do you anticipate them carrying this out until March 10th?
Well, even if they don't want to do the deal with us, I'm saying that this would open the doors for so many other opportunities where our culture, the millennials, know that we can do deals like this. They just need to be educated. I feel like this deal would be educating our culture, and it'll be opening the doors for so many deals, because this is not the only deal we have on the table. This is just one of many. And I'm saying next thing, we want to be able to open up banks. We want to be able to purchase commercial buildings. It's so much stuff that we want to be able to do to put other people's products on. I think this is just the beginning. So I hope that Adidas come to the table and say, we want to do business with you guys. If not, then guess what? We're going to make something bigger happen after this. And so this is a blessing. I feel like this is an educational process for our culture, letting them know that we can do this.
Master P's not only talking the talk, he's walking. He and Baron Davis are serious about this bid. And I spoke with MPD Group's Matt Powell. He's the senior sportswear analyst, and he thinks that Master P and his group have a shot at really taking this company. One thing he says is that they have to focus on their iconic shoes like the Allen Iversons that Master P mentioned, as well as the Shaqnosis, and then they can position the brand to do some big things.
Make Reebok cool again. I love it. Great interview, Reggie. And
Thank you,
coming up,
Sabia.
we'll take a look, of course. And coming up, we'll take a look at the breakneck speed of home sales in 2020 and what the real estate market has in store for you specifically next year. That's up next.
Want to take a quick look at where markets are with roughly 25, 26 minutes left in the trading session, the last one of 2020. The S&P 500 is on tap to close up today about 15 points. The Dow could close up as much as 140 points, and the NASDAQ could close up, or rather down, about 12 points. Keep in mind that the indices, the S&P is probably going to end the year up 15%, with the Dow up roughly, about 7%. And we could actually see the NASDAQ, at least the NASDAQ close up, about 40%. So it's been a good year for a lot of players. But want to check something that we are paying attention to, and that has to do with real estate, because it's been a good year for a lot of people, especially if they were selling in certain locales. Jeff Tucker is Zillow economist. He's joining us now, and it's good to have you here. I don't want to say 2020 is a record year, but we haven't seen appreciation like this since almost 14 years, 2006. Can we sustain it?
That's right. Yeah, the recent monthly price appreciation we've seen in the Zillow Home Value Index is the fastest since actually the peak pace of appreciation back in 2006. The annual appreciation looking back over 2020 was a little bit more modest, about 7.5%. But we expect this to be sustained well into 2021. There's a lot of pent-up demand from people who kept trying to buy homes and were stymied this year. Partially because they had sometimes had trouble finding a home for sale. There's about 1/3 fewer homes on the market at any point in time in the last few months. And they're still being driven by some of these fundamental factors of record low mortgage rates, well under 3% still. And just actually the fundamental forces of aging. There's a lot of people entering their 30s right now. There's about 3 million more people, about 23 million versus 20 million 10 years ago, who are in the key age range of 30 to 34. That's the age at which Americans tend to buy their first homes. And so they are really trying to come into the market. And I think a lot of them sort of accelerated that decision in part due to the pandemic.
And Jeff, how much of that is people worried that if we have to undergo another lockdown or if there's some problem with the vaccine, that it's best to try to find a new home, a bigger space, because obviously that makes staying at home a lot more manageable. But how long do you think that's going to last? What about in the spring? What do you expect the housing market to be like then?
Yeah, that's a great point. I don't think that this was necessarily people overreacting or, buying a house that's way too big. I think this was sort of accelerating the choice that a lot of young people were going to make in the next few years. And now that they've, bought that bigger house, they're not going to turn around and sell it and try to downsize back into a smaller condo. And, just once again, these demographics are hard to argue with. There are just millions more people in that key age range of 30 to 34. I do think in the rental market, there is some more space that has kind of been opened up. We only saw rent increase 1% this year, which is the slowest in ages. And that's partially due to folks moving out and buying their first homes. It's also due to renters really struggling this year economically. But put that all together, and it does mean that Gen Z, as they move out from their parents' homes or move out from college, they could have an easier time getting their first place to rent in the big cities over the next year.
Well, the rents in New York City have fallen about 20, in some cases a little bit more than 20%. I know an apartment upstairs here sold for 20% lower than list. So as Doris Day would have said in the 1950s, que sera, sera, what will be, will be. Looks like there's opportunity, and people writing off cities is dead, but looks like with the prices dropping, there's opportunity in the places people were fleeing.
Yeah, and I think this call of the death of cities was certainly overblown this year. I don't think they are gone for good, but a lot of the things that made city living great, short commute, the nightlife, the restaurants, the live entertainment, that's all been shut down. But it won't be shut down forever. So I think as employers bring employees back to their offices, this is probably a great opportunity for renters to get a good deal. And really for home shoppers as well. And you mentioned New York City. That is one example, especially the Manhattan market, one place where we did see a buildup of unsold inventory. And some of those sellers may be willing to accept a bargain when they decide to sell their home. So if you're shopping for a condo or a townhouse, this may be a good opportunity to get a good deal. If you're shopping for a detached single family home, get in line, because there are millions of people trying to do the same thing. And prices are just going gangbusters in the single family home market.
Jeff Tucker is an economist with Zillow. We appreciate your joining us here and wish you and the team at Zillow a happy, healthy 2021. As we go to break, I want to tell you a couple things. First, there's a lot of money on the sidelines. So where are investors going to put that money? Allianz head ETF strategist on where you can find some opportunity next year is coming at you right after the commercial break. But let's leave with a bit of a smile on your face. It's not exactly the song Who Let the Dogs Out, but you remember a few years back when Boston Dynamics gave us the robot dogs? Well, now they've got this video. If we can bring the music up a bit, they dance. They actually disco dance, the robots. And while it's not Skynet just yet, watch out.
Welcome back to Yahoo Finance Live. A little bit of breaking news. So we're obviously paying very close attention to the Senate Georgia races. And now we're getting a report that Senator David Perdue is quarantining after coming in close contact with someone who tested positive. The runoff is on Tuesday. We're going to keep a close eye on that throughout the show and bring you the latest details. Now I want to take a quick check and look at the markets to see what the picture is, as we've got about 20 minutes left in the last trading day of the year. We're seeing a bit of a mixed picture, not much movement, but the Dow is up over 100 points. It's up 139 points. The NASDAQ is down about 8 points, and the S&P 500 is up 15 points. Now, clearly the pandemic has driven a lot of market gains, but there are so many options out there. So what exactly is the best way to position yourselves to take advantage of all the opportunities out there? To talk some more about this, we're now going to be joined by Johan Gran. He is head of the ETF strategy at Alliance Investment Management. Johan, it's great to have you on.
Yeah, pleasure to be here. Thank you. Happy New Year's.
So what are some opportunities, let's start here, that investors might have missed out on if they were cautious because of all the volatility in the markets because of the pandemic?
Yeah, sure. I mean, that's a pretty classic behavioral issue, right? When you have a big drop off and, especially if you start cashing in and you take money off the sidelines and you feel like you're in a safe spot, right? And that might be true for as long as the market's coming down, but then that risk balance turn into an opportunity cost, and that's where a lot of investors get burnt, frankly. So the question really is, what do you do to make sure you stay invested? And the question is, what do you actually own when you are invested? And those are some of the big questions that we battle with.
So how do you answer that question for your clients? Because we're looking at record close for the year on the indices, and a lot of people want to protect their assets with pandemic uncertainty, as you point out. But many of us rely on people like you to say, okay, here are your options. What would those be?
Yeah, no, I think it's a great question. Thank you. It used to be a lot easier to answer those questions. Traditionally, you've had investors, when they become more conservative, and what we focus mostly on in terms of investor base, right? You have retirees, you have pre-retirees, and people getting into retirement. That's typically where you tend to see some of the more conservative investing natures come into play. And a lot of times what you see is that you move money from equities to fixed income, and that's been the going rate, so to speak, no pun intended, for many, many years. That was the case 20 years ago. It was an easy decision. That is not so much the case anymore. As you know, you have interest rates at record lows. They plummeted from 200 basis points down to south of 100. We're now at about 90. And you don't get a whole lot of juice out of that rate market anymore. So that decision has faded away over the past several years. You've also seen the way that investors have been combating that has been to further diversify their portfolios. So now you're looking at adding some of your investments into real estate and gold and high yield and other types of investors. You had the Yale model come into play several years ago, and now you extend into hedge funds and private equity and so on and so forth. But no matter how you slice it, if you want to get to participate in the equity market and get some returns, you can't really find it in the fixed income space. So you get closer and closer to equity-like investments. And now you're adding risk back to your portfolio when you're not looking for it. And frankly, what we've seen, we just released a study just a few weeks ago. It's really showing that 60%, give or take 60% of investors admit that they're underinvested. So to answer your question, right, what do you do? Well, we at Allianz, right, we've been managing risk for many, many years, for decades here out of Minneapolis. It's what we do. And what we've done as of late is break that down and provide some of that investment capabilities into a structured fashion in an ETF. And that is very simply put the way for you to participate in the equity market without stretching out on the yield curve and try to look for asset diversification elsewhere. You can participate on the upside, and you still have a buffer against the downside to the tune of 10 or 20%. So it's a really elegant way to actually get that exposure in a simple fashion.
And you've mentioned that you expect above average returns in like the second half of 2021. So how should investors position themselves to really be able to take full advantage of that?
Sure. And when we say that, that's the base case, right? And you got to keep in mind, there's a lot of big movements behind all this, right? You have this perplexed market where it's really a bit of a head shake at times. But I think you've covered that, to a great extent. You have monetary policies, you have fiscal policies, that are really pushing the economy forward. You also have a whole bunch of other stimuli, like the vaccine is rolling out, and pluses and minuses around all of this, right? But at the end of the day, if you suspect that you will have something happening in the second half of the year, one way to participate, again, is to have like a structured approach to it. It's easy enough to say you can invest in things like smart beta ETFs, or you can invest in minimum volatility ETFs. You always have to have a balance, on the risk side. Those types of instruments will work in some places and work out for some investors. The way we look at this, the more safety you can build into how you're investing, the more comfortable you can be with how you're investing your money, the better off you'll be. You can set the expectations and you can know what to expect before you put your money to work. And that's where we think the beauty is. That has traditionally, from Allianz, come in the form of annuities, and still does, fixed indexed annuities and variable annuities, index variable annuities. And now we have repackaged some of that expertise into this ETF wrapper that can really give this to a much broader slew of investors.
I agree with you. There's beauty in setting the right expectations. Johan Grand, head of the ETF strategy at Allianz Investment Management. Thanks so much.
You bet. Thank you.
And coming up, Bitcoin has been on a red hot winning streak. Yahoo Finance's Dan Roberts joins us to break down how 2020 and how wild it's been for digital currencies. Right after this.
So it was Zaza Gabor in that TV show who used to say she just adored a penthouse view, but if she had had Bitcoin, she could have bought the whole damn apartment building. Dan Roberts follows Bitcoin for us, and you've, in your most recent article, pointed out that the 2017 price surge was, newbies buying cryptocurrencies. What's going on this time around? Because it's almost 29,000 a coin.
That's right, Adam. I think this time it's been kind of a convergence of all the positive factors. I mean, the 2020 surge has mostly been driven by institutional buying, Wall Street firms finally kind of changing their tune and at least declaring that, we now believe it's worth having digital assets as some small portion of our portfolio. Maybe it's only 1%, but big firms buying in. And in fact, a report just in the last week from CoinShares showed that the inflows into digital asset funds from Wall Street firms in 2020 were up 660%. I think that tells most of the story. But even if that weren't enough, and that alone would have really driven the price higher, you also had some consumer-facing payments names, PayPal, Square, Visa, Fidelity, all in different ways buying into cryptocurrency more than ever before. Again, kind of warming to it, changing their tune. And of course, you do again have retail investors, regular people, newbies buying in, just like in 2017. But I would say the market has matured in the last 3 years. And I think you have a lot going right. Look, that's not to say there won't be a serious price correction. There easily could be in the next day, week, or month. No one knows what's going to happen. But certainly there's a lot that has created the right scenario in late 2020 for Bitcoin. And it's kind of strengthened the argument that it's a good hedge against inflation, especially during a pandemic in which, central banks and governments have been giving out stimulus checks. So a lot has gone right.
And Dan, what are the chances that cryptocurrencies become a mainstream form of payment in 2021?
I don't see it happening, Sabeel. Now, of course, the other kind of narrative that has a little bit been put to bed is the idea that that's a problem. I mean, for years, you had the most popular skeptics argument was it's not a real currency. No one uses it to buy anything. There's very few places where you can pay in Bitcoin. And now I think people are starting to decide, well, that doesn't matter because as the price rises, why would you want to spend it anyway? If you bought some Bitcoin, you don't want to spend it just for the newness and the fun of, oh, look, I paid in Bitcoin. You want to hold on to it as an investment. Now, that being said, with PayPal adding the ability to buy and then pay in Bitcoin in 2021, maybe you will see more people using it as a form of payment, but I doubt it. But that's okay, because right now the use case is just as an investment. Now, of course, one retort to that is, well, wait a minute. If you look back all the way to 2008 to the Satoshi white paper, it was called a peer-to-peer electronic cash system. So what happened to the cash part of it? What happened to using it as a currency? And I think that's a fair point. But right now, Wall Street is just viewing it as an investment akin to digital gold.
An investment worth almost $29,000. Dan Roberts, thank you very much. Last call 2020. When we come back, we've got the closing bell. Don't hold your breath, but 2020 is going to close out with markets in record territory. We're watching everything for you as we head into the closing bell, and we want to invite into the stream Sean Cruz, TD Ameritrade Senior Manager of Trader Strategy, and also Josh Wine, Portfolio Manager at Hennessy Funds. Both of you, thank you very much. Josh, I'm going to start with you. I'm curious, will the bulls continue running in 2021? Can they?
I think they will, absolutely, Adam. Good to be with you. I've been accused of being an optimist, and so I'm very reluctant to get too excited, but I am. I think the bull continues, and I think it's a rate story and a growth story and all the things that typically underpin a rally. And yes, it's going to be a great year.
What are some of the things you would have us pay attention to in 2021 as investors?
Sure. Yeah, I think that, first and foremost, when I look at the market from, 10,000 feet, I think a lot about, certainly the risk-free rate. And so we're well below, we're at about 1%, about 90 basis points on the 10-year. And then just looking forward, the earnings yield on the S&P. So it's about 4.5%. So that spread of about 3.5 to 4%, that's about where we were before we ever started talking about vaccines and viruses. So that is very compelling, about a 4% premium on the 10-year. So I think about that. I think about just what might drive the market beyond the obvious is, things like margin expansion. I think some of these cuts, for better or worse, might be permanent. And so in some cases, that's great. I think we've learned how to do more with the same or more with less. So I think there's a margin story, an interest rate story, a growth story. And to sum that up, I think the market discounts cash flows. And so within that equation, all those metrics are moving in the right direction. Yep. So I think that, fundamentally it's a great setup.
With markets, like we've seen them at all-time highs, it always makes me wonder about the fundamentals. Is it too good to be true?
Well, I know where you're coming from. I don't think it's too good to be true. There's still a lot of work that we all have to do with getting people inoculated and things like that. But yeah, it seems strange, the NASDAQ's up over 40%, the S&P over 16 or 17. And the idea that, and I've seen this a lot, which is, I guess, a little comforting and also terrifying. There's a lot of company in the bull camp. And so that's usually a bad thing. But yeah, it seems like it can keep going. And we've been through the stress test. The Fed has their stress test. Well, this was a big live stress test that went on now for about 10 months, and we came through it pretty decently. So it's just hard to understand what, in the midst of reopening, what gets us off this track.
All right, so we're going to go to Jared Blickery because, as was just pointed out, it keeps going and going. It's like the Energizer Bunny, it keeps going. Jared, weigh in on this.
Well, just minutes ago, we got a record intraday high in the S&P 500. Both it and the Dow are set to close at record highs. So what an end to the year. Here's the Dow. It's up over 7% year to date. NASDAQ up over 40%. You see 43.5% right there. S&P 500 up 16%. And also taking a look at what bonds have done, Bespoke Investment Group put out an interesting note today. Now you can see that we started out the year just south of 2%, and right now we're south of 1%. But check this out, because the total return for the S&P 500 and bonds have coincided. They've converged. So each is up about 17%. And again, that's a total return of both of those. So you can see that red line, that's bonds, and then the blue line, that's the S&P 500. Does it mean anything? I don't know, but it's interesting to point out. And let's check out the NASDAQ 100 heat map, this final day of trading. Kind of a mixed picture for the mega caps. We can see Apple and Amazon each off, but not quite 1%. Alphabet, the biggest outperformer among the five, that's up 1%. And then Tesla. The story of the year, perhaps, is Tesla. That's up another 65% over the last 3 months, 1.7% today, trading above 700, as I've been saying for the second time this year, because way back in January, split adjusted, now that's when it's basically 5 times the current price, 140 here equaled 700 then. And so this is the second time that it has surpassed 700. So something to think about. And then looking at the sector action for the day, we can see utilities and real estate, kind of an interest rate play, maybe playing some catch up. Those are the two leaders there. Utilities up 1.5%. And then we have energy, the worst performer of the year, down 76 basis points here. Here's the closing bell on Wall Street.
2020, that is a wrap. Put a nail in it. We are done for the 2020 trading year. And let's take a look at least for today, the S&P 500 and the Dow, they're going to settle up higher. The S&P 500 today is going to settle up a little bit over 20 points. The Dow is going to settle up almost 200 points to the upside. NASDAQ will be up roughly 18 points. Even the Russell 2000 getting in on that last hurrah of the year, up about half a point, barely a tenth of a percent. Sectors that gained today, we had communication services up 1%. We had financials up 1.4%. The other one that was up pretty dramatically, utilities at 1.6%. Two draggers, as Jared just pointed out, energy down almost 1%, that sector. And consumer discretionary down about 0.25%. Let's go back to our guests to figure all of this out. And Mr. Cruz has joined us. Sean, it's good to have you here as we finish out the year. Let's get you into the conversation. So 2020 is now in the rear view mirror. Good. I'm not going to say it, but there's a special goodbye that I think a lot of us want to say to this year. Let's look at 2021. What makes you most optimistic about investors and where they could go with their money next year?
Yeah, I think one thing is, although we had a pretty solid rally in cyclicals to close out the end of the year, I still think there's plenty more to go. And I think what is really remains to be seen is what kind of a recovery we get. And I think where that recovery needs to come from, it really is going to be focused on the jobs market, and not only the breadth of the jobs that are getting out there, but I think also the quality of the jobs. And that'll be wage growth will be a key component of that as well. So that's really what I think is going to be the determining factor of just how fast of a recovery we can get and how robust that can be in the market. I think if we can get robust job growth, robust wage growth, I think that will be what drives cyclicals even higher here as we go into 2021 and beyond. That's where I'm really going to be focused on.
And Sean, I really like that you mentioned the jobs market, because that brings us to Main Street, right? So even if Wall Street, the markets are doing well, does that bode well for Main Street? We know there's this new stimulus that's coming into the economy. How much of a boost is that going to actually be?
Yeah, and I think there's always the wealth effects that come along with what the market's doing, but I don't think for the recovery, I'm looking at the catalyst for the robustness of recovery coming from strength in equity markets. I think it is going to have to happen in the hard economy. We're going to have to see some of those jobs start to come back, and I think what will allow that is really more this broad-based reopening of the economy, not just here but globally. I think that is what can drive sort of a snapback in a lot of these jobs that have been, furloughed or gone away. I think it's going to be a little bit of a challenge getting everyone back into the labor force and get them back into their jobs sooner rather than later, and making sure they're coming into good jobs, not something just lower wage, just to sort of get them off the unemployment reports. That to me is really what I'm going to be looking at. And so I think this has to come from Main Street. It has to come from the actual hard economy. It can't sort of be driven by the markets going higher, and that'll just drag everyone along with it. I actually think it's going to need to be the reverse. I think it's going to need to be the real economy really out there leading the way, and that will be what allows the market to continue upside.
Josh, everybody likes a little tip, and the Hennessy Cornerstone Midcap 30 Fund might have a few stocks in there that you'd like to talk about. Lithium Motors is the one that caught my attention because I love cars, but we had a guest on not too long ago who said, forget car dealerships, they're done. Yet they have 190 stores in 20 U.S. states. They're not out yet.
No, not at all. And I can see the bear case perhaps, but I think that, Lithia has delivered for many years now. I would point out that, certainly for those that are looking at used cars, Lithia derives the majority of their revenue from the used car segment, which, by the way, has higher margins. And then, of course, new cars and service and parts and all of that. And I think that, I think to build on what Sean was saying, I think that Main Street, the market doesn't necessarily rescue Main Street, but I think what helps rescue Main Street is kind of the reopening and the delayed wealth effect. So usually the market hits new highs and people, if they want, can cash out and spend that money. And we've all been inhibited from traveling and eating out and spending money in certain ways. And for a company like Lithia and others that are in our Midcap 30 fund, I think they're huge beneficiaries of that delayed wealth effect. The reopening, the pent up energy that exists in a lot of people who want to eat out and travel and buy a car. So I think that Lithia fits squarely in that theme.
And Josh, what are some of the unprecedented moves that you saw this year in the markets as we cap 2020?
Yeah, it's a great question. I mean, Bitcoin, most years Bitcoin would just sit on its own and that would be the story, but I guess it's overshadowed certainly by, the big five or the big 6 or 7 and the liquidity that they offered and the growth. I would say, what's nice to see is I would point to SPACs. I think they were right for the moment, companies going public via SPAC, not having to travel around the country and meeting with investors individually and just kind of, somewhat easily transforming into a public company. That was great to see. I think we are starved for new companies to invest in. I think the number of public companies have been dwindling for many years. Hopefully that's on an upsurge. And even though I think it's somewhat vilified very often, I think the return of the individual investor, whether it's Robinhood traders, which I think some are just bored and will maybe, once they're going back to their office, will stop trading. But I think it's good to see individuals returning to the market. It's good to see people talking about individual stocks, some of the themes that are exciting around electric vehicles and some of the sustainability themes and AI and everything, you name it. So I think SPACs to me is what this year was about. It was kind of everyone figuring out how to move forward, and it really it was nice to see.
Sean, I mean, we can't ignore SPACs, but when we look at 2021, what I keep hearing from the people who join us is $1.4 trillion in savings. And when you talk about pent-up demand, that money's got to find some place to earn a return, and it will not earn a return sitting in an account at Chase or Citi. So do you expect that money to come flooding in the first half of the year?
Yeah, and I actually think that that's a great point of where is that money going to go? And I always say that the base level, a lot of what we're doing here is trying to say, look, there's the stack of money, capital out there in the world. You need to find where it's going to go. Those are the places that stand to see, price inflation or better returns. Right now, I think that is a key of where does that money go? Does it actually go and do some sort of an investable asset, or does it actually go out there and just get spent through consumption when we're able to go out there, travel around, go back out to eat? I think that is another interesting point to keep an eye on. And the reason why I'm really interested to see how much of that goes back out into general consumption or demand for goods, that actually can be a little bit of what I think a catalyst for what will be the interest rate story this year, which I do expect to be a big story. Is that going to be such a big driver of demand where there's not enough supply to meet that, which can drive inflation? We've seen inflation break evens and expectations picking up going into the end of this year. That can really be a catalyst to push interest rates higher. It can push inflation higher, generally speaking. That'll be the first shoe to drop, and you'll see rates move higher as a result. But that can really then maybe put the Fed in a tough spot. So I think where that 1.4 trillion goes, if it goes to investable assets, I imagine that would probably be something with a little bit more of a longer term outlook, or something that is going to be a little bit more on the equity side. You're right, not going into a savings account, not going into a 10-year treasury, yielding just under 1%. But if it goes back out there into general consumption, that can be the inflation catalyst that can push rates higher. And then it could put the Fed in a tough spot. And that could end up being a very big story. And I think that could play out in the first half of 2021.
Sean Cruz is TD Ameritrade Senior Manager of Trader Strategy. Josh Wine is Portfolio Manager at Hennessy Funds. We wish you both a happy, healthy, safe new year and look forward to seeing you again. Well, next year is just a few hours away, so we'll see you next year. But we're going to see you just in a few minutes because they're taking NVIDIA and Intel in the chip game. We're going to hear from Graphcore CEO Nigel Toon right after this.
Welcome back to Yahoo Finance Live. There it is. We ended 2020 in terms of trading. We had the closing bell already. I want to bring in Yahoo Finance's Jared Blickery to kind of give us the highlights, the stats, and let us know about all the records that were broken this year.
Well, I think it's kind of fitting that we just ended the year on a high note with records in both the Dow and the S&P 500. Let's get to the Wi-Fi Interactive. I want to take a look at the sectors first, and we'll get into some individual names and components in a second. But here's the sector outlook for the entire year. This is tech up 41.8%, followed by consumer discretionary. That has Amazon as its biggest component, then communication services. That's mainly Facebook, Alphabet, even Netflix in there. So the three FANG sectors have been the outperformers, and that's kind of the story of the year. And then you look in the down in the bottom right, that's energy down 37%. Really rough year for energy, although it has come back in the last couple months. So if we look at what's happened quarter to date, different picture. Energy is the biggest gainer along with financials and industrials. That's the value and cyclical rotation that we've been talking about. Now here's the NASDAQ, and we're going to go to a year-to-date look. You can see lots of green there. Apple, probably the biggest story of the year next to Tesla. That's up 80%. Tesla, what a monster, up 743%. Just incredible. Even NVIDIA and PayPal each up over 100%. So lots of outperformers here. But it wasn't just the safety trade or the so-called FANG trade. We had a lot of participation at the end of the year in travel names. Now, this is year to date, so you can see they're still sitting on tons of losses. United's down 50%. Carnival Cruise Lines is down 57%. But in this quarter, they managed to build up some gains. That's largely on the reopening trade, and we're looking forward to that in the new year. Booking is one of the highlights. That's a NASDAQ 100 stock. That's up 30%. Marriott up 42%. And I should add that Booking.com is actually in the green for the year, so not all is lost there. Overall, what an incredible journey it's been, guys.
Definitely an incredible journey. And here's to more record highs in 2021. Jared Blickery, Happy New Year.
You too.
And UK chipmaker Graphcore has raised $222 million for AI chips, raising the company's value to $2.77 billion. Now more capable of taking on rivals NVIDIA and Intel. Now, Yahoo Finance spoke to Graphcore CEO Nigel Toon earlier about how his company is standing out from its competitors and what we can expect in 2021.
We have developed a completely new type of processor built from the ground up, especially for AI. We have many more processor cores inside the chip. We have a very different interconnect between those processor cores, and it really delivers a very different set of performance capabilities for customers, really accelerates for a wide range of AI applications, just built exactly for that application.
So Nigel, this is a nice chunk of money that you did in fact raise this week. How you use that money change if an NVIDIA does go out there and they're able to get that deal, that $40 billion deal confirmed with ARM?
Well, I think for us, we are absolutely focused on running as fast as we can. We're driving a strong roadmap. We've already built the world's most sophisticated microprocessor. We have 59 billion transistors on our chip. We're delivering much higher performance than the NVIDIA GPUs. We're obviously concerned about NVIDIA buying ARM, not so much for ourselves, but more just because it's not good for competition. We don't think it's good for the industry. We think it cuts off access to this advanced technology potentially for other companies in the semiconductor space. And I think it'll be bad for competition overall.
And then Nigel, kind of going back to the technology itself, I'm curious, maybe for a lay audience. I mean, I don't really know anything about semiconductors and chips and all that. What is the difference between the computing power that's necessary to run some of the AI applications that we hear so much buzz about, and how much different does what you guys are making need to be? How much more power, I guess, does it need to have than sort of what is out on the market relative to the goals, again, that I think the real evangelists for AI kind of see as possible in the next couple decades?
Yeah. Well, I think the big thing to realize is that for 75 years, we have been telling computers what to do step by step in a program. And now the computers are learning from data. And that is a completely different type of compute. It requires a completely different type of processing solution. And you can't just take what exists today and apply it. You can get some performance, but really you need to sit down and create a completely new type of processor for this new market. And that's what GraphCore has done. And that's why we're able to get this much higher level of performance. This is a processor designed to learn from data, designed to support artificial intelligence.
So Nigel, it's Julie here. That sounds expensive, again, to a layperson, both sort of the R&D to develop that kind of chip and then perhaps the production of it. So talk to me about your cost structure. It's my understanding that you are not yet profitable. What would be sort of the critical mass that you would need to reach in terms of your sales in order to get there?
Well, we have about 500 people in the company today. We're growing still very, very fast. We have raised so far since the company started just 4 years ago, we've raised over $700 million, but we actually have nearly $450 million of cash at the bank. So we have all the resources we need to be able to grow our revenues and to, really be able to build a very large business here. And obviously these very large investors who are coming in and supporting the company, they can see the potential behind what we're doing and the huge market opportunity that is in front of us. So this is, very much about running as fast as we can, building this incredible technology and growing to become a major player in the marketplace.
Nigel, you're no familiar to doing deals. You sold a business, I believe, back in 2011 to NVIDIA. What are you more inclined to do? Do you see GraphCore being part of another major chip maker, or is 2021 the year that you continue to build your business and then IPO later in the year?
Yeah, I think 2021 would be too early for us to IPO. We need to really knuckle down and build our business over the next 12, 18 months, and then we'll see, where we are at that stage. But this is a massive market opportunity, and I think there is the opportunity to build a business that is designing and supplying these new types of processors for what will be the most important computing workload on the planet. AI is going to dominate a lot of new application areas, and there is the opportunity to create a specialist company that is focused in on that, just as we saw in mobile, just as we saw, originally with computers. This is a new paradigm and new companies will emerge here. And I think GraphCore is at the leading wave of that.
Definitely insightful interview there. And coming up, the countdown to New Year's Day. I understand if you've already started your champagne, but coming live, we're going to be having Moet Hennessy break down how to make the most and fully enjoy your New Year's Eve celebration. That's coming up next.
So everybody knows that champagne is French, and when you pop the bottle of Moet Chandon, keep in mind that Moet is Dutch. The guy who actually started this back in the 1740s, he was Dutch. Chandon married in the 1800s. But one person who probably keeps her Moet Chandon in her pretty cabinet is joining us now to talk about champagne and everything else we'll be drinking to celebrate the new year. Vanessa Kay, the Executive Vice President of Prestige Brands at Moet Hennessy, is joining us now. And there's a lot to toast the new year with, not just champagne. What are we drinking these days?
Hi, Adam. Thanks so much for having me. There certainly is a lot to toast. I think, are going to be experiencing a New Year's Eve like no other tonight. I think certainly when we were starting off the year, which feels as though it were yesterday, none of us expected that we would be where we are in celebrating New Year's Eve indoors or with small groups of people instead of being able to, to celebrate as we usually do. But we're ready.
And where do things stand in terms of home delivery of champagne? Because we've seen, DoorDash and all these delivery services really prosper as people have, been stuck at home. If you're not necessarily a cook, you need to get it delivered. What has been the situation for boxes of champagne?
Well, I think it's no secret that the wines and spirits industry has really been quite resilient through COVID and through this whole pandemic. I think it's really due to the great increase in e-commerce, notably. And I think before the pandemic, there was not I think not as many people were using these home delivery services or purchasing their wine or their spirits online. I think that with COVID and with everything that we've had to do in terms of shifting our own behavior, we've seen the same thing happen with wines and spirits. And we had pivoted early. We had invested early in these delivery apps, and we've seen great momentum that's continuing. I think probably through until right now.
I am curious, and I think other people watching want to know the answer to this. How long will some of this stuff last? I realize it's alcohol, and I assume it doesn't go bad. But for instance, champagne, if you don't refrigerate it, how long would it last with the cork not uncorked? And for that matter, what other spirits could last a year, 2, 3 if they're not open?
Well, the interesting thing about champagne is that part of champagne's is aging. So champagne actually can age and will continue to age. We have vintage champagnes and non-vintage champagnes, and in the right conditions, meaning not too hot, they can last for many decades and even half a century or more. So I think from a champagne perspective, there's no limit. I mean, we like to think that champagne isn't just for celebrations, but no celebration is complete without champagne. So hopefully today everyone is going to be really celebrating responsibly with a bottle of Moet or a bottle of Boeuf Clicquot. But I think that in terms of spirits, it's very much the same thing. Spirits are very much aged. They're aged in whiskey is aged in casks. Cognac is as well. So age and super premium wines and spirits go very well together.
And many people haven't been able to have the same type of New Year's Eve celebration this year as they did last year because of so many restrictions on restaurants and being open and the fact that it's the winter. And who wants to stand outside in the cold with a glass of champagne when you can enjoy it just as even better, sitting at home, at least it's warm. So what are some of your tips you have for us to be able to enjoy the New Year's Eve celebrations as much as we can from home?
Yes, I mean, I think it's arguably it's really devastating what's happened to the restaurant industry, and certainly as we've headed into the cold weather and the different lockdowns and different regulations, it's been that much more complicated. We have been supporting, I think, throughout all of these months, people who want to celebrate at home. I think everyone has become an at-home mixologist and an at-home winemaker. And cocktail maker, and we have created something called the New Year's Eve Wish Shop that has lots of great cocktail recipes that you can go on and look even now for tonight. It's not too late, but I think that certainly celebrating at home with your your close friends, your family within your protected pod and a wonderful bottle of champagne tonight, a wonderful bottle of anything that you want. is certainly great.
We wish you the happiest and healthiest of New Year's. Vanessa Kay, Executive Vice President of Prestige Brands at Moet Hennessy, all the best to you. And again, a happy new year. And for all of you who have been with us throughout this last hour and a half, the trading session of 2020 coming to a close, just a reminder that markets closed in record territory as we ended the year, looking forward to 2021. And what a good way to do that with some of the fireworks and celebrations which have already brought in the new year in different parts of the world.
America is in the midst of a racial reckoning, fresh off of a wave of protests in the summer and a divisive election in the fall. With tensions at a boil, opponents dig in and dialogue stops. Emmanuel Acho wants to keep the conversation going. The Fox Sports host and former NFL linebacker invites people, especially white people, to talk about race on his YouTube show, Uncomfortable Conversations with a Black Man. His 65 million views and counting have made the show an instant success. And with help from Oprah Winfrey, he just released a book by the same title. On this episode of Influencers, Emmanuel Acho joins me to talk about which questions white people are afraid to ask, why he rejects cancel culture, and whether the perception of the NFL will change after the Trump presidency. Hello, everyone, and welcome to Influencers. I'm Andy Serwer, and welcome to our guest, Emmanuel Acho, who is a former NFL player, host of Fox Sports 1's Speak for Yourself, and author of the new book, Uncomfortable Conversations with a Black Man. Emmanuel, great to see you.
Andy, good to be seen. Good to be talking to you, my friend.
Thank you. So you started this off, Uncomfortable Conversations with a Black Man, as a YouTube show. And it amassed more than 65 million views from when you started it in June. What were you hoping to achieve when you started that? And why do you think it's resonated so widely?
Man, great question, Andy. I was hoping to act as a bridge for racial reconciliation. Andy, I went to an affluent white school from grades 5 through 12, and I was immersed in white culture. But then, Andy, I got offered a scholarship to play football at the University of Texas, and then I go to the NFL. So now I'm immersed in Black culture. Andy, what I've realized is there's a communication difference between white people, white culture, and Black people, Black culture. Because I've been immersed in both cultures, I understand, Andy, there is a difference. And that communication barrier is playing a factor in our racial tension right now, a huge factor. Sure, we all speak English, but make no mistake about it, there are differences in ways we communicate and interpret things. So I said, you know what, Andy? I'm going to preemptively answer questions that I know my white brothers and sisters have, but either are too afraid to ask or don't have a Black person to ask or Black people to ask, such as, wait a second, how come white people can't say the N word, but Black people can? Wait, Emmanuel, but what about Black on Black crime in Chicago? Okay, what's this concept of white privilege? But Emmanuel, what about reverse racism? Black people get a Black History Month, white people don't get a White History Month. Okay, but isn't affirmative action just the same thing as like the Jim Crow laws? So I preemptively said, you know what, Andy, let me answer so many of these questions that are leaving my white brothers and sisters in ignorance.
Yeah, and then you turn into this book right here, which has been really resonating with people as well. And I'm in the midst of it right now, and I love the question format because you're right. So many people, white people, are asking those questions right now, Emmanuel. And so, are you getting the kind of responses that you hope to? In other words, are people saying, "Oh, now I do understand"? And how are you getting that communicated to you?
I love that. I really am, Andy. And the best response I got was week 1 into the episode. It was a sweet woman named Lynn, a 73-year-old white woman. She said, "Dear Emmanuel, I grew up in the South, in rural Alabama in the 40s and 50s. I didn't go to school with any Negroes," she said. "But after watching your episode, I realized my heart still needs to change. Please don't give up on me yet. I love you, my brother and my son." And Andy, after I got that email, I said, wait a second. The hearts are changing. Hearts are turning. This isn't about clicks. This isn't about likes. This isn't about shares. This is about influencing this generation and the next generation. So let's write a book which can be passed down from generation to generation and affect true, meaningful change. I don't just want the spoken word, which is sizzle. I need the written word, which is substantive. And that's what'll really make a change. So the appetite, Andy, has been insatiable, it seems like. The more I give people, the more they want. Emmanuel, make the episodes longer. I wish you could expand on this. And so that's how we're going right now.
On the one hand, we're seeing white and Black people come together. But unfortunately, it's on one side of the political aisle. You're seeing a lot of white people at Black Lives Matters protests, more than a lot of people anticipated in Connecticut and Michigan and Pennsylvania. On the other hand, you have the Proud Boys, a lot of Trump supporters who might not see eye to eye with this still. How can we bring this country together?
Well, I would say the first thing, Andy, is we all have to collectively get out of denial. I said this before to Oprah when her and I were talking. Denial, spelled DENIAL. Don't even know I am lying. And you can't fix a problem, Andy, that you don't know exists. So how can we all collectively move forward? Acknowledge a problem exists. You mentioned it at the top of this. I'm a sports guy. Let me talk sports with y'all real quick. In the NFL, the reason that so many people can be of different races, different religions, different backgrounds, Andy, and still come together is because they're fighting a common enemy. When I walk out onto the field, which is 53 1/3 wide and 100 yards long, I remember that, wait a second, me and my brother to my left and my right are fighting a common enemy. So I don't care what my brother looks like. I don't care who my brother worships, because we're on a goal to beat the opponent. In America, Andy, we haven't yet realized we're fighting a common enemy of oppression. We're fighting a common enemy of racism. We're fighting a common enemy of systemic injustice. And as a result, we're bickering with our brothers and sisters to our left and our right instead of realizing, no, it's us versus oppression. It's not Black versus white. It's not white versus Black. It's good versus evil. It's love versus hate.
social media. I mean, a lot of people are suggesting that's making the situation, the divisiveness, worse. What's your take on that?
Social media does two things. It can make the divisiveness worse because it gives everyone a platform, and they can also hide. And so it gives people a platform, but they can also maintain anonymity. And that's the worst part. Like, if everyone on social media had to put their actual first and last name, it'd be a completely different agenda. But social media also has some pros. Again, my show, my concept, my book, it wouldn't have occurred without social media. And I know that has done plenty of good. So with social media, you have to understand there's bad, but there is also some good involved.
All right, let's get back to that other question, Emmanuel. How optimistic are you about this systemic change that we're trying to undertake?
I'm optimistic, Andy, because I've finally realized that hearts are ready to change. And that's not so much that I finally realized, the hearts are finally ready to change. After the murder of George Floyd, Andy, it was as though our white brothers and sisters were like, wait a second, maybe Black people haven't been lying this whole time. Maybe there is a problem. Maybe like this racial injustice and racially motivated incidents, maybe it's not just a coincidence. And so I think the harshness of that tragedy of George Floyd, it woke everyone up. And now it's just a matter of, now that people are awake and now that the intentions are there, is there direction? See, Andy, intention without direction is meaningless. So there's now intention. And I, with this book and with my series, I'm trying to give people direction.
Hear you there. Throughout his presidency, Donald Trump has criticized NFL players. Do you think the perception of the league and its players will shift after Donald Trump leaves office?
It's a good question. I think that the perception of the players, I don't know that it's so much affected by the presidency. What I mean by that is, one man nor one woman should be able to dictate your feelings and emotions on oppression, injustice, and racism. Like, these are historical contexts with generational meanings. So what one person tells you, whether it's Emmanuel Acho, whether it's a president, whoever it is, that shouldn't completely dictate your feelings about something. Do your homework, do your research, let your own empathy be created through your own understanding. So I don't think one person can single-handedly dictate the emotions about a collective system or organization.
You said the NFL has the right intentions, but needs to take it in the right direction. What concrete steps do you think the NFL should take to support the fight for racial justice?
Well, the first thing is everybody has to understand the fight. I sat down with Commissioner of the NFL, Roger Goodell. Yeah, he's the commissioner, but to a degree, he can have all the authority and no power at times. Remember, there are 32 organizations, 32 different cities, different teams, not 32 different cities, but enough different cities. The need in the different cities is different. So it can't be just one size fits all type of mantra. The need in Dallas is different than the need in Los Angeles, which is different than the need in Phoenix or Glendale, Arizona. The individual owners have to collectively realize, what does my city need? But how does that start? It starts by talking to your players. Roger Goodell said, yeah, I heard about the injustice, but it wasn't until I went on a ride along that I really understood it. These owners, they're hearing things. Oh, I see my players are kneeling, raising a fist. But do they really understand it? It has to go from head knowledge to heart knowledge.
When you had Roger Goodell on, Emmanuel, I think it was in August, he offered an apology to Colin Kaepernick. But Colin Kaepernick still has not been signed by a team. Is this collusion? Do you think he'll ever go back to the NFL?
No, I don't think Colin Kaepernick will play in the NFL, but there's so many variables to this. What do I mean by that? In the NFL, every organization runs a cost-benefit analysis. How much will it cost us to have you on our organization, and how much will you benefit us? So if you're an NFL organization, especially 4 years removed in regards to Colin Kaepernick, now you're weighing the risk reward. Okay, he'll come in and obviously he'll be anywhere from a second to a third string quarterback right now. Is having Colin Kaepernick as a second or third string quarterback worth the questions that every player will now get asked, that we will now get asked? And is it worth the distraction that the media will create? Not Colin Kaepernick necessarily, but the media will create. So because of that, I don't think that Colin Kaepernick would get signed. I also think that, I don't know, sometimes there's an impasse. Remember, let's talk Cam Newton for a second. Cam Newton didn't want to be a backup quarterback. He wanted to be a starter. And as a result, there was only one team that wanted to make him a starter. Eric Reed, someone who has been proudly known to be standing by Colin Kaepernick, very justifiably so. The Washington football team, they offered him a place on their practice squad. Eric Reed turned it down because Eric Reed views himself as a starter. And so just because you want to play doesn't necessarily mean that the position that will be offered to you that you do in fact want. So because of all the nuances regarding that, I personally don't see Colin Kaepernick playing in the NFL.
And as you were saying too, Emmanuel, different cities, different owners, different politics. It's all
Correct.
Part of that equation, as you said. You mentioned the 32 owners. Only 2 of them are people of color, and only 3 non-interim head coaches are black. Wow. Seems like there's a long way to go there too, right?
Yeah, but the issue, Andy, is that so many people think the NFL is a meritocracy. However hard you work, you'll earn your success. It's not. It's really based off nepotism and cronyism. Nepotism, you hire your family, and cronyism, you hire your friends. Historically, if the NFL was founded by white men, and white men are hiring their family, nepotism, white men. They're hiring their friends, cronyism, white men. So how do you think that the NFL will change if it's historically founded by white men who are looking out for other white men? It won't. And so that's why it's not a coincidence when you see only 3 out of 32 coaches full-time who began the season, or whatever the statistic may be, are black. That's not a coincidence. That's just the way in which our world at large works. And the NFL is a reflection of that.
You're talking about these owners, these white men, and a vast majority of their political donations went to Republicans. And some of those politicians, or many of them, criticized the racial justice protests, including kneeling by NFL players. So this is just part of the politics. You have a lot of black players and a lot of owners who are white and have, let's just say, not such progressive political perspectives, correct?
Yeah, that's part of the real problem is just a lack of understanding. And that's what the all of this all boils down to. The nucleus, the crux of the issue is a lack of understanding. Remember, Roger Goodell, he for so long said, I didn't realize what the players were kneeling about. Like Colin Kaepernick, he definitely took some missteps. Definitely. He would admit that, I would assume. Like wearing the pig socks, not a great idea. But at the heart of his issue was protesting systemic injustice and police brutality. What have we seen come to a head in 2020? Police brutality and systemic injustice. So, but it just now took Roger Goodell 4 years to realize what's really been going on. So imagine how many other people who haven't realized that. Roger Goodell is one of the savviest, smartest, wisest businessmen you'll come across. And he didn't realize what it was about. So how can you expect other people to have figured it out by now? Again, it's all just a communication thing and to a degree, a denial thing.
Is it hypocritical if owners who, on the one hand, support Donald Trump over here, and on the other hand, make donations to, say, social justice causes? Or is that okay? Can you do that?
Yeah, I don't think it's hypocritical. Again, support who you support. You have to figure out your motivation for your support, but I will never tell someone what to do. I will tell them why I do what I do and why I think what I do is right. But I can't criticize or crucify people for supporting who they support. I would wonder their intentions behind it, and I would ask them the why, but I won't come out and blanketly offer a general statement of you shouldn't support this person or you shouldn't support that person. It's really just understanding why you're doing what you're doing.
I want to leave the NFL and go over to the WNBA, okay, and ask you about Kelly Loeffler, who is a Republican senator from Georgia who owns the Atlanta Dream, who has criticized Black Lives Matter protesters. Do you think that league should remove her as an owner?
I don't think cancel culture, which is what that is essentially alluding to, is ever positive. Because if you cancel somebody, you don't give them the opportunity to grow. You don't give them the opportunity to mature. You don't give them the opportunity to evolve. I think the WNBA should educate her. Now, if she is refusing, like anyone, education, at that point in time, you have to figure out decisions to make. Again, I don't know all the nuances beyond this with that case, but I don't believe in cancel culture. I believe in education, which breeds growth. Again, there's a difference between Black Lives Matter, the noun, the group, and Black Lives Matter, the adjective, simply saying that Black people's lives do in fact matter. You will not, and you have not ever heard of Emmanuel Acho speak about Black Lives Matter, the group. What I speak about is saying that Black lives do in fact matter. And so I don't believe in canceling people, to answer your question, because there's no growth there.
Right. Makes sense. Let me ask you a little bit about college football and whether the players there should be paid. And some people have compared them not being paid, which is, and they're largely Black players, to sort of a slavery system, or at least being insensitive. Is that right to say?
It's a little hyperbolic, probably a lot of hyperbolic, to compare really anything to slavery. The comparison is having workers make minimal to no money while those whom they are working for are benefiting severely off the labor of the employees. As it's really the same parallel that's been drawn in the NFL. You have your owners making billions of dollars and your players on average are making $800,000. Well, you're making $800,000. How could you compare this to slavery? Because look at 800,000 compared to $1 billion, right? That would be what, 0.08 cents or something like that onto the dollar, or 0.00, whatever the case may be. And so it's always hyperbolic when you're making the slavery comparison, but I do think that college players should be paid.
Right. It's inequity, whether it's inequity in college or the NFL. What about corporate America, Emmanuel? What can business people learn from sports in terms of addressing racial injustice?
Business people can learn to create the common goal. What is the common goal? And you don't even have to think about football. Think about the Olympics. That's something we all get behind. At the Olympics, you'll see people decked out in their USA gear and whatnot. cheering on athletes that they don't know, women's soccer, men's soccer, track and field. Why? Because they're all banding behind the country to win over another country. You've figured out the common opponent. What corporations can realize is, wait a second, what is our common goal? And let's all as a company get behind our common goal. That's the only way people can look past their differences.
Emmanuel Acho, author of the new book, Uncomfortable Conversations with a Black Man. Thank you so much for your time.
Thank you, my man.
You've been watching Influencers. I'm Andy Serwer. We'll see you next time.